A very good morning to each and every one of you. We are going to get started with day 2 of the BFSI Insight Summit in a few moments from now. So all the guests, all the delegates requesting you all to please assemble inside the Chintaman Deshmukh Hall. We are going to get started with the opening keynote address in a few moments from now. So requesting all the delegates to please make their way inside the hall.
Independent and fair, and journalism that is rooted in
Ladies and gentlemen, welcome to the day 2 of India's biggest BFSI summit called the BFSI Insight Summit 2024, its third edition. Ladies and gentlemen, yesterday we unlocked a treasure trove of insights and strategies, gaining perspectives from visionary leaders who are not just participants but actually pioneers in shaping the future of banking and finance. Today, we harness that momentum, elevating those ideas as we delve even deeper into our exploration. Day 2 is actually meticulously crafted to dig deeper into our discussions while encouraging us to question not just the what, but also the how and the why. Together, we will be confronting the most pressing and most relevant challenges and uncover pertinent insights that may interest and intrigue you all are as follows. Firstly, do make time to spend time in the exhibition area where we have a lot of brands which are doing some great work in the arena of BFSI sector. Do take part in the Summit Circuit contest, visit as many expo booths as possible and win a chance to get some exciting prizes. Visit the Ignite Square for more details. If your friends and colleagues couldn't make it here, they can watch the sessions live on businessstandard.com and Business Standard's YouTube and Facebook channel. Have you seen the exhibit featuring the front pages of all Business Standard edition cities? Get your picture on the Business Standard front page in the photo box with a special 50 years masthead. Ladies and gentlemen, this summit is also celebrating 50 glorious and marvelous years of Business Standard. 50 years of sharing an opinion that shapes opinions of people. 50 years of steering conversations that shape the world of finance. 50 years of converting news into economic intelligence. 50 years of substance over sensation. 50 years of market wisdom and not market whispers. 50 years of rendering light on matters that matter. And few of the points which are also worth reflecting from our session yesterday's based on different discussions, deliberations were that NBFCs and banks do not need to compete with each other. NBFCs are vanguards for innovation. SFB serves the most underserved markets with potential to grow even further. Global banks are catering to at least 2 to 3% of India's population, with mining existing clients as a huge factor to grow even further, while making customers feel that they are emotionally invested in the country and serving its objectives and priorities remain their paramount importance. And there were many more insights and perspectives which we will get into in a few moments from now. But moving on, over the past decade, ladies and gentlemen, India has actually witnessed an extraordinary surge in financial inclusion, with over 53.13 crore of Jan Dhan accounts open, including 29.56 crore women beneficiaries. This remarkable progress, driven by leadership represented in this very room, has actually positioned us at the forefront of a global financial revolution. Today, we're going to be hearing from trailblazers who have embraced these changes and are leading the charge towards innovation and excellence. Our agenda, ladies and gentlemen, on day 2 is brimming with sessions designed to challenge the status quo and inspire transformative thinking. Let's approach these discussions with a spirit of curiosity, courage, and a willingness to question our perspectives. Yesterday, we laid the groundwork, and today we build upon it further. This summit, ladies and gentlemen, is more than just sharing insight. It's about actively shaping the future of our industry. I welcome you all to day 2 of India's largest BFSI summit called the BFSI Insight Summit. Ladies and gentlemen, to actually open the session and to render the keynote, we have a very special guest amidst us. Can I request Mr. Anant Narayan, whole-time member at SEBI, to grace us on stage, and please join us on the dais. Welcome, sir. Thank you so much for joining us. And to actually set the context and set the introductory remarks, can I call on stage Mr. Shailesh Dobhal, editor at Business Standard.
Thank you, Ridhima, and good morning, everybody. On behalf of Business Standard, let me extend a very warm welcome to Mr. Anant Narayan Gopalakrishnan, whole-time member of the Markets Regulator, the Security and Exchange Board of India, on this second day of the Business Standard BFSI Insight Summit 2024. Mr. Narayan has over 2.5 decades of experience in the banking and financial markets, a period during which he has served as director on boards of banks like Deutsche, Citibank, Standard Chartered Bank, and several other corporate entities. At SEBI, Mr. Narayan handles several departments like market intermediaries, regulation supervision department, the Alternative Investment Fund, Foreign Portfolio Investors Department, Department of Economic and Policy Analysis, Integrated Surveillance Department, and the Information Technology Department. At SEBI, he has played a key role in developing the new derivatives trading framework. Before assuming charge at SEBI in 2022, Mr. Narayan had held positions of Associate Professor at SP Jain Institute of Management and Research, Mumbai, for nearly 5 years. He also served as a member of various advisory committees constituted by SEBI and the Reserve Bank of India. Mr. Narayan has been an active member of the financial markets since 1993, when he completed his postgraduate diploma in management from the Indian Institute of Management, Lucknow. Earlier, he did his graduation in technology, it was electrical engineering, from Indian Institute of Technology, Bombay. Many thanks, Mr. Narayan, for agreeing to be with us here today. May I please request you to address this audience and thousands who are watching this summit proceedings online and deliver your keynote address on reflections on our market infrastructure institution ecosystem. Thank you very much. Over to you, Mr. Narayan. Thank you.
Good morning, everybody, and thank you so much, Shailesh, for those very kind words. And a special thanks to Business Standard Your exciting sessions will come after mine. As a regulator, my job is to make sure put you to sleep right in the morning and be as boring as possible. But thank you, Business Standard, for once again giving me the opportunity to address your annual BFSI Summit. We live in times where attention spans are at times limited to YouTube Shorts and Insta Reels, and yet where opinions are vehement. Amidst all this, policy formulation calls for informed, calm, and constructive engagement. Media houses such as Business Standard and forums such as this summit have a crucial role to play in this regard. Today, I will offer some reflections on our market infrastructure institutions, or MIIs, namely our exchanges, clearing corporations, and depositories, as a prelude to seeking your considered feedback. This is not a this is a kind of an arcane topic. Normally, one doesn't talk about MIIs. They are the invisible structure which holds the entire capital markets ecosystem, but they're extremely important. MIIs are statutory institutions that have played an admirable role in the development of our capital markets. They're required to put public interest first, serving as first-line regulators and as a public utility, even as they operate as commercial organizations. I will first make the case that we must continue to strengthen their governance framework, ensure that they are staffed by high-quality risk, compliance, and technology personnel, and further strengthen institutional mechanisms to ensure that they can appropriately deliver on the core public interest mandate of the MII. I will also speak about the construct of our clearing corporations, or CCs. They are currently owned entirely by their parent exchange and depend on them for equity infusions, contributions to the settlement guarantee funds, and for resources. There is an argument to be made amongst CCs that operate in interoperable segments such as equities for them to be truly independent and standalone MIIs, both in form and in substance. I will begin with a short background to our MIIs. Our MIIs provide the critical superstructure for our capital markets. Particularly over the last 3 decades, guided by policymakers and regulators, they have played a crucial and pioneering role in growing our capital markets ecosystem. MIIs are the first line of defense charged with ensuring investor protection and market integrity. Amongst other things, they are required to ensure adequate disclosures by issuers of securities, conduct appropriate surveillance to deliver a free and fair market bereft of unfair trading practices, manage risk and operations to deliver smooth clearing and settlements, monitor the conduct of brokers and other intermediaries, and ensure that market technology platforms and ledgers are fair, secure, reliable, and resilient. MIIs have a unique operating model in that they are empowered by law to regulate their own paying clients, such as unlisted corporates, trading members, clearing members, and depository participants. They're required to primarily focus on public interest and ensuring the integrity of capital markets. At the same time, they are also commercial entities, and the larger MIIs in equity markets currently enjoy high operating margins with profits before tax to income ratios of 60% or more, high equity price to earnings ratios, and significant dividend payout ratios. What is the framework that we have adopted to balance the public utility and commercial objectives of the MIIs? Given the primary need for an MII to serve public interest and act as a first-line regulator while staying commercially viable, different jurisdictions and regulators have adopted different operating models for different MIIs. In India, following much consultation and deliberation over many years, we have chosen a model that allows for competition amongst MIIs, allows them to make profits and pay dividends to their shareholders, and allows for public shareholding in and listing of MIIs, except for clearing corporations. There are advantages of this construct. Competition, public shareholding, and profits foster efficiency of MII operations, helps attract market talent to MIIs, and spurs and finances innovation. Competition also creates a natural backup and redundancy in the ecosystem, avoiding of the risk of having all our infrastructure eggs in one basket. Of course, in India, there is a concentration in terms of one exchange and one clearing corporation dominating the equities landscape. Public shareholding and listing can also help improve transparency and enforce better market accountability. There are possible downsides to the construct as well. MIIs are not regular commercial entities. Competition, public shareholding, and listing can create incentives that give primacy to commercial outcomes over the intended core and primary statutory role of the MII as a first-line regulator and public utility provider. There is a risk, an actual risk or a perceived risk, of a potential race to the bottom with compromise on risk or compliance or in their role as a first-line regulator of their members, particularly as MIIs compete for clients whom they must also regulate. There is the potential that investments into appropriate security, technology, risk, and operations are deprioritized over commercial outcomes. There is the potential that products or securities are launched and persisted with without adequate safeguards around investor protection, suitability and appropriateness, and with a view to maximizing MII throughput and revenues. To foster long-term confidence in the capital markets ecosystem and to ensure financial stability of our capital markets, not only must all this be avoided, they must also be seen to be avoided. There are mitigants in place to ensure that these downsides do not materialize. But given the serious implications of any failure, there is always room for review and improvement. The first and crucial mitigant is the governance framework of the MIIs. MIIs are required to have a governing board in which public interest directors, or PIDs as we call them, must comprise the majority. SEBI chooses and appoints PIDs from amongst the candidates suggested by the governing board of the MII. This is a crucial appointment calling on people of experience, competence, integrity, management and people skills, and stature. MII shareholders do not have a direct say in the appointment of such PIDs. Of course, shareholder and executive directors on the governing board of the MII are part of the process of suggesting suitable candidates to SEBI. In selecting PIDs from amongst the candidates suggested by the MII, SEBI tries to ensure that the governing board has appropriate and diverse skills and expertise, including in technology, markets, risk, compliance, management and administration, finance, and law. As a collective majority on the governing board, PIDs are charged with ensuring that the MII operates primarily with public interest in mind, focusing on its role as a first-line regulator and public utility rather than on commercial outcomes. In recent times, SEBI has tried to deepen and formalize the two-way engagement with the PIDs, both collectively and as individual MIIs, so that these objectives are better appreciated and affected. As an aside, we had sought public feedback on whether we should change the process of appointing PIDs to allow for direct shareholder involvement in their appointment. The overwhelming feedback from an expert working group, the Secondary Market Advisory Committee, PIDs and MIIs themselves, and the public at large was to continue with status quo. We will still explore ways to improve ease of doing business for our PIDs while making the process of their appointment more institutionalized and objective. However, PIDs do not run MIIs on a day-to-day basis. While the governing board sets the tone at the top, the culture of giving primacy to public interest must run deep amongst the management and the employees of the MII as well. Besides having a capable MD and CEO who's accountable for the entire MII, including its commercial outcomes, there is a need for able and accomplished heads of the primary MII verticals of technology and operations and of risk and compliance. These crucial verticals must be willing and empowered to operate independent of short-term commercial considerations to ensure that the MII delivers its primary mandate as a quality public utility and first-line regulator. SEBI has advised the governing boards of MIIs to upgrade the KMPs in charge of these key verticals over time as necessary. These are extremely crucial KMPs. We do not mind if the MII actually spends good money to hire the right people. SEBI will also require the Chief Technology Officer, the Chief Information Security Officer, Chief Risk Officer, and Chief Compliance Officers of MIIs to independently interact with the appropriate governing board committee, which would also directly contribute to their annual appraisals. Given the critical need to strengthen these verticals, we are also considering SEBI's own direct involvement in approving the appointment of these specific KMPs, just as we today approve the appointment of the MD and CEO of the MII. We believe that such mechanisms can further facilitate and institutionalize appropriate focus on the core public utility mandate of the MII. Finally, SEBI is tasked with regulating and supervising the first-line regulators, the MIIs. We have upgraded our supervision of MIIs significantly over the past few years and intend to further invest in enhancing and sharpening our tools and skills, particularly by building a specialized cadre of IT supervisors. SEBI's standard enforcement processes can sometimes follow a long and legalistic journey. Automatic financial disincentives are designed to avoid such delays when it comes to supervision of our MIIs. But that does come with the possibility of creating some perverse incentives. For our part, we are happy to consider specific changes that could foster honesty and help sharpen the focus on material rather than peripheral supervisory issues. From the next year, we will also institute independent external evaluation of MIIs once in every 3 years to supplement our own supervision. These are some of the thoughts that we have in terms of how do we strengthen the MII governance ecosystem so that they remain primarily focused as a public utility than worrying about their commercial outcomes. I will now turn specifically to our clearing corporations. Clearing corporations act as central counterparties for clearing and settlement. They play a crucial role as a first-line regulator managing several forms of market, counterparty, operational, and technology risk that accompanies trading and settlement in securities markets. They provide the comfort of novation and settlement finality backed by processes and ultimately by a strong default waterfall. Given the crucial role that they play, in many jurisdictions and markets that have multiple exchanges and trading platforms, such as the US, CCs operate as true public utilities that are owned by stakeholders for their collective good. In India as well, while exchanges and depositories are allowed to be listed, our regulations clearly state that CCs will not be allowed to list. However, there is an anomaly here, in that currently our clearing corporations or CCs are 100% owned by their parent exchange. When the parent exchange lists, therefore, their CCs are also de facto listed, in that the shareholders of the parent exchange consider the consolidated financials of both the exchange and the CC. In the past, this was implicitly accepted and tolerated, since the CC would only clear the trades of its own exchange. However, since 2018, we have introduced interoperability in the equities market settlement so that a CC can clear the trades of multiple equity exchanges rather than of the parent alone. This interoperability has improved the ease of trading and settlement for investors while allowing for better backup and redundancy in our securities ecosystem. It has also materially altered the implications of 100% ownership of a CC by a single exchange. As on date, the dominant equity clearing corporation, owned by the dominant exchange, clears over 85% of all cash and derivative equity market trades dealt on each of the large exchanges. In this context, 100% ownerships of CCs by a single exchange does raise questions of the potential for actual or perceived conflict of interest. The second anomalous feature of clearing corporations in India is that unlike many global and domestic peers, our CCs are dependent on their shareholder, i.e. the parent exchange, for equity infusion, for default fund management, and for other resources such as technology and people. In most jurisdictions, participating clearing members contribute to the settlement guarantee fund of the CC. In India, as on date, clearing members do not contribute to the settlement guarantee fund of the CC. Instead, the CC itself, the exchanges from where the trades originate, and the owner of the CC, i.e. the exchange that owns the CC, must constantly enhance the settlement guarantee fund on their own. There is a need to fundamentally review this construct of our clearing corporations. There is a case to consider making the clearing corporations truly independent and self-sufficient with broad-based ownership and with clearing members having a risk-based skin in the game. All this may be crucial to ensure that there is an actual and perceived level playing field across all MIIs. This may also be crucial to ensure that sufficient resources are readily and independently available to the CCs to invest in appropriate technology, risk management, and people for them to continue delivering on their mandate as a key public utility and a first-line regulator. If we agree on the principles here, the question of how to bring about this change in a manner that is fair, equitable, and non-disruptive for all stakeholders will then arise. We have debated this in our Secondary Market Advisory Committee, where some ideas have been proposed. In a sense, some form of demerger of the equity stock exchange and the equity clearing corporation may perhaps be a way out, though there are some legal and regulatory challenges to navigate. We will come out with a public consultation on all this shortly and seek your considered views in this regard. I will now end where I began, on emphasizing the need for informed, considered, calm, and constructive engagement on policy formulation. My attempt today has been to lay out the contours of our thinking on a possible way forward for our MI ecosystem, on how to ensure that they stay focused on public interests rather than commercial outcomes, and how the clearing corporation construct can be reimagined. We must ensure that our commercial regulators that are to focus on public interest are never seen to become regulatory duopolies focused on private returns. Bertrand Russell once said, "I would never die for my beliefs because I might be wrong." I agree with him. We would be very happy to modulate our own policy views through our consultation process based on the logic and the data presented to us. Once again, I really thank Business Standard for offering this platform for constructive engagement and deliberations. I wish you all the best for this particular summit. Thank you again.
Can we give a huge round of applause for Mr. Narayan for that incisive, insightful, and very impartial perspective on the first-time regulators, clearly delineating the bane and boon, the advantages, disadvantages, and most importantly, the proactive planning mechanism and measures to future-proof the future as well as ensuring the best interest of the public. On this note, can I request Mr. Shailesh Dobal to render the vote of thanks and also summarize?
Thank you, Ridhima, and thank you, Mr. Narayan, for such an insightful and thought-provoking special keynote address. You know, there are many takeaways, but the way you set up how market infrastructure institutions, the first principles of there being public utilities, the first line of regulator and defense, and how they need to be not just above doubt, but seen to be above doubt. And what is SEBI doing about it? There are many news points that you gave Business Standard today here about coming out with a full public consultation paper, how SEBI may be looking at the role in appointment of not just PIDs that you already do, but KMPs, a specialized cadre, independent evaluation of MIs every 3 years, you know, how the conflict of interest needs to be managed, how if there is a change, and that could be a very major change, but it needs to be fair, equitable, and non-disruptive to the whole ecosystem. How doing all this, you would avoid regulatory duopoly. There are many, many more, you know. I'm sure this audience has many more takeaways. These are the ones that I could gather. Thank you so much. Once again, this audience, please.
Can I now request Mr. Dobal to present Mr. Narayan with a memento as our appreciation? Thank you so much, sir. All right, we just heard from Mr. Narayan really delineating about the potential advantages, disadvantages, the risks associated with first-time regulators, and clearly delineating a framework, an action plan, how can we risk-proof them and make sure that a sense of purpose of protecting the customer interest over commercial outcome is reigned throughout. Ladies and gentlemen, now we move into the next leg of our panel discussion. As India's mutual fund industry aims for a staggering rupees 100 trillion, we are actually witnessing an unprecedented momentum. This goal is actually just not a number. It actually represents an expanded financial inclusion, innovative investor outreach, and actually resilient economic growth. Today's panel brings together the CEOs who will be navigating the complexities of market cycles, investor confidence, and digital transformation to reach this milestone. The topic that we are trying to unravel, illustrate, and construe is Mutual Fund Part 2, 100 trillion rupees. Let's deep dive into the insights and the strategies for capturing new opportunities and paving the path to a future where mutual fund actually touches every corner of India. To actually moderate this panel discussion, I'd like to call on stage Mr. Tamal Bandyopadhyay, Consulting Editor at Business Standard. And joining Mr. Tamal on stage are going to be a string of panel members who will be reaching in a few moments from now. And meanwhile, ladies and gentlemen, like I have stated before, we want to make sure that you freeze the moment of the third edition of BFSI Summit in moment in time. So make sure that you click as many pictures at the Ignite Square. You also get an opportunity to win some exciting prizes there. You have to go there, maximize your opportunity to visit maximum booths out there and get yourself an opportunity to win some exciting and enthusing prizes. Please upload all your pictures at the different photo ops that we've actually created in this mammoth exhibit area outside and upload it on social media with the hashtag BSBFSI. So don't forget to click as many pictures, videos, content and put it out there and spread the word because financial literacy and knowing about the future of BFSI and finance is an important construct for our future generations too. I repeat the hashtag, it's hashtag BSBFSI. And like I said, our panel discussion today is gonna be construing and illustrating the topic of path to 100 trillion rupees. So I think it's relevant and pertinent for all of us. We'll be starting the panel discussion in a few moments from now. If I look back on the big insights that had come from our yesterday's session, they also included the fact that fintech is here to stay, as stated by Shashank, because in the next 10 years, our digital payment users are going to increase to 1 billion from the current 350 to 360 million at this point. And his prediction was also that by the next 10 years, we'll be actually hitting a $10 trillion economy. So the future is looking very hopeful. And one of the things that was evident and conspicuous throughout the conversations, whether it was the movers and shakers of public sector and private sector banks, was the fact that institutions which are able to keep customers and consumers at the center of their strategy will win because majority of our customers have transitioned from becoming savers to massive investors. So a lot of banks will need to increase their portfolio of CASA products. And the economic growth of 7% is enabling banks to actually consistently grow at 10 to 12%. So not only these conversations are insightful, they're not theoretical, but actually have a lot of pragmatic information. And we sincerely hope that you use this pragmatic information to your advantage in your application. Our next session, ladies and gentlemen, like stated before, is going to be unraveling the topic of mutual funds. And we have the disruptors from the mutual fund industry coming here and talking about that topic in a few moments from now. All right, ladies and gentlemen, our respected RBI Governor, Mr. Das, said a very interesting thing about the future. He said RBI, much like its emblem, represents the tiger because the Indian economy represents the strength of that tiger, and RBI as an entity represents its agility because of the mechanism in which it's proactively planning for future. And I think one of our endeavor at the BFSI Summit is also to plan for futures by getting the practitioners, disruptors, maverick movers and shakers of industry sharing their perspective in a very actionable format. So this topic is about path to rupees 100 trillion. This dialogue will be navigated by Mr. Tamal Bandyopadhyay, consulting editor at Business Standard. And joining Mr. Tamal on stage are going to be our following panel members. Can I request Mr. D.P. Singh, Joint CEO, SBI Mutual Fund, to join us on stage? And joining Mr. Singh on stage is going to be Mr. Navneet Munot, MD and CEO, also AMPI Chairman at HDFC Mutual Fund. Mr. Nilesh Shah, MD, Kotak Mutual Fund. Ms. Radhika Gupta, MD and CEO, Edelweiss Mutual Fund. Mr. A. Balasubramanian, MD and CEO, Aditya Birla Sun Life Mutual Fund. Over to you, Mr. Tamal.
Good morning and welcome to the first panel discussion. Very interesting. Yesterday's Trump's victory is the backdrop. You have seen how market behaved yesterday. Many of them got very excited that correction is over, but now again tomorrow back to the same. But that's not we are going to discuss. They are the CEOs, not CIOs. So we'll focus on other stuff, fundamental stuff, not exactly how the market behave. We will take a few questions, time permitting, but no stock suggestions, nothing. Where to invest, which fund or which stock, no. Just general question you can ask. Before that, the subject is path to 100 trillion AUM. Just a quick look, I picked up from the AMFI site how the AUM has been growing. March 2010, the AUM was 6.13 trillion. As we speak, we have the latest September number, 68 trillion. 68 trillion, October number will be, soon will come, I think by 10th it should come. So that's the mutual fund AUM has been growing, and these gentlemen represent that segment. They know what's happening there. Quickly, in the last 3 years, it has more than doubled. March 2021, it was 32 trillion plus, and September 2024 is 68 trillion plus. So that's the AUM figure. And look at the SIP, everybody, and thanks to Mutual Fund Sahi, you know that everybody knows what is SIP. I'm not getting to explain that. The latest number which I have is, again, September month flow is 24,509 crore. March 17, I have that, before that I don't have the figure, it was just about 4,000 crore, 6 times. So that's how the mutual fund have been growing, but if we talk about the developed markets, in the as a percentage of GDP, etc., we are far behind. So we would ask this gentleman and ask them to we'll pick their brain that when do they say hitting the 100 crore mark, 100 trillion mark. So first question is very simple. We'll start with the basic thing also. How many years it will take, considering what's happening in the market, etc. We'll go to the other issues, micro issues. But just a flat question, Singh Saab, you are banker, State Bank of India is your, that's how you started, and now you got into this chair for quite some time now. I think State Bank of Patiala, you were there, right?
No, I was with SBI only, but
no.
from Patiala.
Okay. So anyway, Singh Saab, it's a 1 minute thing. It's this, each of you, and then we'll get into some of the other issues, main issues and all. When do you see, how many years it will take? 3.5 years is doubled from 34 in March 2021 to 68 now. When do you see 100 trillion AUM?
No, just to put in the perspective, in the period when it has doubled, the market has given substantial returns. It's in the backdrop of the mark-to-market returns in the market also. It's not only on the net sales or the more penetration into number, but looking at the way the industry is going, I think if it has doubled in last 3 years, so what we are talking about from here to 100 trillion is 50%. So I don't think that it should take more than 3 to 4 years to reach this number.
Okay, thanks, Insab. Nilesh, I mean, you are not only, I mean, this Hindi songs, etc., definitely we'll hear later, but you are also a member of the Prime Minister's Economic Advisory Council, right? So you wear two hats, very important hats. So tell us, when do you see 100 trillion?
It all depends upon DP Singh. If he works hard, it will happen in 3 years.
Huh.
If he doesn't work hard, it will happen in 4 years.
Okay, so between 3 and 4 years. Navneet, you are incidentally chairman of AMFI, and I think it's already in public domain that you are supposed to be ASG committee, SEBI's, there also you're chairing. Is it already announced? Okay, those who don't know that he's a big proponent of ASG, and he is also the SEBI committee chairman. So many hats, again this thing. So tell us your take.
So, Tamalda, first of all, many compliments on this conference. I was telling Tamalda and Sailesh that it can't get bigger than this. And sincere compliments to you for putting this together. And also compliments to Business Standard on the 50th anniversary of serving investors, of serving every citizen of the country. By mistake, instead of 100 lakh crores, I think you said 100 crores initially, and then you said 100 lakh.
Yes.
And it's interesting, Bala, Nilesh and I, we started our career as bond fund managers. And I think all of us individually would have celebrated when our funds crossed 100 crores. Today, the daily flows are more than that. So how the world has changed. Our industry AUM, I remember in 2002, industry celebrated 1 lakh crore. And today we are talking about 67 lakh crores. So we have come a long way. But the bigger satisfaction is when we look at, more money coming in from smaller towns. Bigger satisfaction is that SIP book, which was 4,000 crores in 2017, growing to 24,500 crores, and the 5 crore unique investors. Some of those are much bigger celebration. Wo 100 lakh bhi ho jayega, and then it will become a much bigger
That's all
amount.
looking back, looking forward.
Looking forward, I'm saying. So the pace of growth, if you see over the last 20 years, I have no reason to believe that next 20 years won't look like that, won't look better than that.
But unlike them, Singh Saab bola 3 saal, Nilesh, between 3 and 4 years, you
So
don't have
if
anything
all
in mind.
5 of us work hard, he said only DP Singh, bhai, hum 4 ko bhi to mehnat karni hai. So if all 5 of us work hard, I think it will happen in 3-4 years.
Okay, Nilesh is diplomatic. Sorry, Nilesh, no, not Nilesh. Navneet is diplomatic because he is a part of SEBI committee, etc. I understand that. Madam Radhika, and those who do not know, you have 2 million followers on Twitter?
Something like that.
Yeah, something like that. 2 million followers on Twitter. And I'm sure you must have seen her in the Shark Tank. She was one of the investors, and the kind of questions you're asking, you must see. I'm sure you with the same preciseness, you look at the stocks. So those who have not, go to YouTube and see her on the Shark Tank show. Anyway, Radhika.
See, 3 gentlemen who are a little older and far wiser than me have already given answers.
I mean, you think that only, being a woman, you're talking about male age.
I'll give you something.
People say that women don't talk about, we should not talk about your age. You also should not talk about
Now
their
you are
age.
being very clever, sir.
I know.
You're going to make
Come
me
on.
say something that goes viral on social media. But I was going to say that since 3 gentlemen who are little older, I mean, Navneet can still
Again,
make a film
she's
debut.
sticking to that.
But, and wiser have given you an answer. I genuinely think I am thoda sa young India, or at least I believe I am young. I think aapko ye 100 trillion ka question hi change kar dena chahiye. You should add a 0 and ask these gentlemen when we will get to 10 times the number and 50 crore investors, because 100 to ho hi jayega, 2 saal mein hoga, 3 saal mein hoga.
Okay.
Let's be aspirational na.
So 3 year, 4 year, and she said even in 2 years. And Business Standard, please take a note that next time we should talk about 1,000 trillion, not 100 trillion.
Ask something sensational when you have Nilesh and Navneet. Make
Okay,
DP
thanks.
work harder, na?
Thanks. Bala sir, and now people say, I mean, correct me if I'm wrong, I mean, this is not private, let them know also, that if I want to get the correct tips, I have to go to the Chembur golf course. Yes. Huh? You are pretty regular there. So again, this is not a place.
you are keeping track of my movement.
Yes. So you keep a movement of the stocks, I do of yours. So those who are interested, and if you have any, those who play golf, just get into Chembur track and ask this gentleman for his, whisper into his ears and get into what he recommends. Anyway, sir, so here, tell me, when do you see 100 trillion?
So I must admit, whatever prediction that we made in the past, we were never right. I still remember I was the CII Mutual Fund Summit chairman. It was in the year 2014. We predicted 25 lakh crores will happen in the next 3 years. That time the size was about 16 lakh crores. We overachieved the 25 lakh crore number. Then we put out a report on AMFI only, 50 lakh crore size. That 50 lakh crore size was actually reached faster than the time frame that we estimated. Therefore, 100 lakh crore size also will become like that. As Radhika was mentioning, it's not about 100 lakh crore size, it's about how many number of customers will come, how many households will come into the Indian mutual fund industry. That keeps rising. Therefore, mutual fund industry will remain one of the fastest growing industry in the financial service sectors. Therefore, 100 lakh crore, I think, is not the question of the 3 years or 5 years. I think beyond, I think it will happen for the MF industry. That is what I think is the power of MF industry, which has established the last 3-4 years, or maybe last 10-15 years, giving the best experience possible to the investors as one of the, as the primary investment vehicle for the savers in the country. I think that's something the power.
But because previously you've gone wrong, so you don't want to commit. But just I'm asking you, 68 trillion in October, and in October bank deposits was about 250 trillion, something like that. So do you you see at this point, because, and you are talking about financialization, so you see there will be some point 3 years, 4 years, 5 years down the line, you can go wrong, but just tell us, when you think, is there any possibility mutual fund AUM will overtake the bank deposits?
At least my own belief is the next 3-4 years, 50% of the banking industry size will become the mutual fund industry size.
That's
okay. Unlike US, where you can of course aim to be more than 100 more than one time.
Okay.
But I think India, given the fact that our saving culture is different from what you are seeing in global market, therefore 50% of the banking industry AUM would become the mutual fund industry.
Oh, so right now it is less than 1/3, because 215, I'm talking about October number, since then the bank deposits have gone up a little more, and comparable number is 68, so this is less than 1/3. You are saying it will be half, 50% in the next few years. So anyway, with that preliminary remarks, let's get back to the fundamental things. The kind of API flow we are seeing in the past 1 month or so, it's something we had not seen since COVID, if I'm not mistaken, last 4 years. I'm not getting into the market correction on the numbers, but API flows is pretty strong. And post-Trump returning to this thing, money could be even money flowing out to getting back to US. We have seen how the US yield rose and all. So do you think that, because your empire is built on primarily on retail investors, entire AUM, SIP and all. So do you think that retail investors continue to have the stomach to invest the way they have been doing aggressively? Navneet, each of you, starting with you.
Yeah, so Indian markets have done well, and I think the real hero is not us. The real hero is the retail investor, is the individual investor. Another interesting aspect about our industry's growth over the last couple of years is the rising influence of individual investors in the AUM. And in last 10-12 years, that number has switched from less than 40% of the overall AUM to now more than 60% AUM. All of us 10-15 years back used to get criticized that large part of your money is only institutional. Where are the retail investors? Now it's the other way now. Retail investors have a bigger AUM. And I think this is just the beginning of financialization of savings. We have a very long way to go. I think all said and done, while the SIP flows have gone up, but still as a percentage of the household savings, from the flow perspective as well as the stock, we have a very tiny proportion. In the overall household savings pool, 5% has been invested in equity so far. 50% is still real estate, 15% is gold, 15% is bank deposits. So we have a long way to go. I just give you one number. 24,500 crores per month is equivalent of $35 billion a month. Nilesh bhai, I don't think in last 30 years there has been any year where foreign investors invested that kind of money. That's the power of domestic money we have seen. But I must add that given the growth potential of India and the investment needs, we need both. We need local investors. We also need money from global investors. And I have no doubt in my mind that at some point in time, we'll get larger money from global investors also.
But right now, the retail local investors have the stomach
Absolutely.
to keep on
because
putting money.
this
You don't
time-
see a drop in
If
SIPs.
you look at
and
the
all.
flows in last 3 years, FY23, FY24 and the current, a larger and larger portion of flows are coming in the form of SIPs. These are the investors who are putting monthly savings for long-term the wealth creation. This is not the money that has come to take advantage of the short-term momentum in the market. That gives us more confidence of sustainable nature of these flows.
Radhika, retail investors, will this current situation in the market will not dent their appetite? Nilesh, you can think of which Hindi song you play. I'll talk to you last, okay? So,
till Nilesh bhai thinks of a song. See, I think there is, for some strange reason, a tremendous skepticism on the stability of retail investors. I find it a little strange because every month when the industry's SIP book comes out, and I joined the industry not that long ago when the SIP book was 4,000 crores. Wo 5 hui, wo 18 hui, wo 20 hui. Every time the media asks, will this sustain? I think financialization is structural, and I'll tell you a small story. So I had a group of 20 people get together in my office, and they were of various age groups, and we asked everyone a question: what did you do with your first salary? Now, anyone who was above 35, 40 said, I did an RD with my first salary. We have some young kids. A kid who was 22 who said, what is an RD? He didn't even know what a recurring deposit was. Anyone who was below 30 had started an SIP or was doing something with stocks with their first salary. So I think you have to realize that India is changing and financialization is real. And I always, break India into 3 generations. I also interact with a lot of young people. That's one of the benefits of having a large follower base. There was an India of my father's generation that was born into scarcity. There was an India of my generation that saw a 15-year wait for a scooter or landline. It was a transitional India. This India is the Blinkit generation. So it's a far more risk-taking India, whether it is in their job choices or whether it is in their equity choices. So I think financialization and retail is just beginning. And again, yes, in every cycle there will be 10% of people who do F&O, who make some mistakes, who do all of that, who go out of the market. The story is structural.
Bala sir.
The way I see is the investing culture, I think has undergone a change in the last 5-6 years. Thanks to the strong equity market, backed by strong economic growth, the confidence of investing in equity market has gone up. And especially through the mutual funds have been rising day by day, given the fact that people participation in the direct equity, F&O market, and gaming. Right? All the 3 people are now started investing their money.
Gaming.
And gaming as well.
Yeah.
And increasingly people are realizing the one of the vehicle which has given the most stable, predictable return is actually mutual fund. The confidence is rising. The more you burn your finger in the F&O market and other markets, you come back and say that this is a market in which I have to make an investment. Therefore, SAP is now become actual natural acceptance for people. Second is people also realized the power of compounding in terms of money that you make. Over a period of time, if you make your money remain idle or maybe remain invested in mutual fund, the kind of money that you make there, against your direct investment that you make, I think there is also increased realization that is coming that mutual funds have become a better vehicle. Not only for just retail investors, even for HNIs. Even HNIs, family offices now start realizing that mutual funds are actually better animal actually to invest in their money rather than going direct. That's something which the biggest realization has come. This, in my own belief, will make, you asked about the risk appetite. In my view, is risk appetite for retail investors has gone up of investing in the mutual fund compared to any other investment that they may have, whether it is from a liquidity point of view, return point of view, experience point of view. Mutual fund is the only vehicle which is given one of the best possible experience, irrespective of whatever the sentiment change that you have seen, volatility that you have seen.
So the trend is irreversible. That's
Correct.
what you're saying.
Correct.
And in fact, we have seen the power of retail investors in the just before the election results happened. That the 2 days drama, how the retail investors actually turned the.
So one more point I just want to make as far as the retail investors sentiment point of view. Having spent 30 years in the mutual fund industry with all of us, one of the common questions which used to always come whenever the market turns volatile is that should I redeem? That now it has now completely changed. It is no more redemption, is about investing. Should I invest in the fall?
Okay.
Which actually is a fundamental shift in the attitude of the investors when it comes to the question of their own investment through the mutual fund.
Okay, so every volatility is an opportunity actually to get in. I thought I missed the bus, so now it's slowing, so let's get in there. That's the kind of thing. Singh Saab, boliye.
No, I think this is, as Bala said, it's
You are the largest mutual fund, right? In terms of size, AUM,
Yeah.
State Bank of India is the largest mutual
Yes,
fund.
yes.
Great.
So when we talk about the SIPs, if you look at it, the October month was quite volatile. Even during
It should come down, you think, that your October SIP number...
No,
will
that's
expect-
where I'm coming. In the month of October, the growth in SIP was 4% for a month. 4% growth.
In your case, you're talking about...
No,
State
I'm
Bank
talking
of-
about the industry.
Okay.
It went from 23,000 odd to 24,000 odd, almost 1,000 crore addition. That comes to 4% addition in the book in 1 month.
Okay.
And if we extrapolate to the annualize, it's coming to 48%. Even if you reduce it to 40% and extrapolate it to 3 years, so what will be the number you can say? If in a volatile market, more SIPs are coming, that gives us a lot of confidence that this is irreversible. More and more people will join the bandwagon. Not only more people will join, but they will increase the size of the SIP. The person who started SIP of 2,000 rupees 4 years ago, today is making it 4 SIPs of 2,000 rupees, or SIP size is going up. So that's a very, very healthy sign, and that is going to continue. And that nobody is stopping. This is a way of saving. Savings and investments are now becoming one. I was hearing to SBI chairman yesterday. What he was talking to you, while talking to you, he said only 1.8% penetration to bank customers for mutual fund, 1.8%. And bankers also know that bank accounts are eventually going to be the transactional accounts. Unless and until they add value through SIPs, through investment products, so all the bankers will do that. HDFC will do that, Axis will do that, Kotak will do that, everybody will do that. So the SIP book size, because these are the value-added services, even bankers will push, MFDs are pushing, investors are themselves coming, RIAs and robos are there. There are robos who are doing more than 1 lakh, 2 lakh SIPs per month. So in such a scenario, when the ecosystem has been created, I don't think there's any reason. Now the problem is on the supply side. That's a different point which we'll discuss.
We'll come to that.
But as far as SIPs are concerned or mutual fund growth is concerned, we are very confident there's a multi-decadal kind of thing, and it's going to continue.
Nilesh bhai, you know what they expect. It's not me. Boliye.
So Dada, there was a Lagan movie where local team defeated foreigners. In real life, Lagan is happening in Indian capital market. In COVID, we saw one day international where March, April, May, June, July, August 20, foreigners sold about 80-90,000 crore. An Indian retail investor via mutual fund kept on absorbing them. Once they realized we can't play one day international, they went out and came back to play test match in India between October 21 to June 22. They sold 250,000 crore. And again, retail investors kept on supporting via mutual fund. They realized we can't win against Indians in test match. Finally, they decided to come and play T20 with us on election day. This time, retail investors said, mutual fund wale, aap log sab dur jao. We'll face them directly. They bought 28,000 crore worth of equity on that day. And 4,000 to 5,000 crore worth of equity was still waiting outside to get in. Dada, this was the only day where I saw buyers were more than sellers.
Yes.
Now, in the real life Lagan, this song is appropriate. बार बार हाँ बोलो यार हाँ
Please join him. Join him.
अपनी जीत हो उनकी हार हो कोई हमसे जीत न पावे चले चलो चले चलो मिट जावे जो टकरावे चले चलो Now this is the most important stanza.
Okay.
भले घोर अंधेरा छावे चले चलो कोई राह में ना थम जावे चले चलो. So there will be darkness,
Okay.
which we'll have to keep on walking.
So next time please join him, no? Otherwise there's no fun.
And finally दादा foreigners भी आजकल तो यही गा रहे हैं.
Okay.
तेरे बिना जिंदगी से कोई शिकवा तो नहीं, सिकवा नहीं. तेरे बिना जिंदगी भी लेकिन जिंदगी तो नहीं, जिंदगी नहीं. तो ये फॉरेनर्स भी इंडिया बेच रहे हैं, बट पोर्टफोलियो में फिर रहा क्या?
Great. So that's the fun. You prepare yourself, or it just is come instantly? Like, you were, huh?
Dada, I have realized
Okay.
when newspaper give order, we have to follow.
Okay.
इसलिए नीलेश ने बोल दिया तेरा ही बिना जी सकते कभी.
Bala, we can start an MF, Indian Idol for the MF industry, which Nilesh is going to win the first one.
Yeah. Okay, let's get into a little, little boring stuff and all, that distribution part. The fintech is a meteoric rise has seen, particularly post-COVID and all. And is it a time to relook the distribution of mutual fund? Because, you are primarily, mostly dependent on the banks, and every large bank has a mutual fund, this thing and all. So you have not been using fintech the way, it's been changing this thing. Mutual fund still continue to remain in the sort of, I will not call you that you have become, you are not in sync with time, I would say, when the distribution comes. I'll ask Radhika to start, just giving, but don't contradict yourself, because what you did, first you claimed that you are much younger than others, and then later you said that you belong to that generation where one had to wait for 15 years for a scooter.
No, I said transition generation.
Huh, okay.
I'm in the middle generation.
Okay.
So I did not contradict myself.
Okay.
So
Tell us.
you asked a tricky question, because I'm one of the, I think Bala and I represent two fund houses that are not bank backed.
Yes.
And we are about 6-7 years old since
We'll take one or two questions after this round. Just get the microphone there to cut down time. If anybody has. Yeah, please.
So, Tamal, I'll say this, because for many years, our boards have been asking us, आप लोगों का तो बैंक पार्टनर नहीं है. They almost say you have no reason to exist. In fact, if you talk to private equity guys, if you talk to investors, there is this myth that distribution will happen only through banks, and you people like me and Bala have no reason to exist. And while people like DP, Nilesh, everyone who has bank-backed distribution has built large franchises, the fact is today you have 45 mutual funds and 20 people waiting to get licenses, most of whom are not bank-backed. In fact, every time Rashesh asks me why so many people are entering this business and applying for licenses, I'm like, it must be a very good business if 20 new people want to enter. So I don't think distribution is only bank-backed. In fact, if you look at the guy who is doing the largest volume of SIP book today in India, the first one is a fintech, which is Grow. The second one is a non-bank. So distribution is existing in lots of different cohorts. And over the last 5 years, if you see, actually the MF industry is tremendously disruptive. So I believe that if you are a fund house there who has a good product out there with digital platforms, nothing will stop you from growing, because the consumer has taken purchasing power in their hands. And that's why actually you've seen we've grown from 6,000 to 1.5 lakh crores, and there are many, many such cases. In fact, even if you look at the data, because we keep presenting it to our boards and this is boring, for bank-backed AMs, the bank-backed distribution houses, they do distribution far beyond their banking channels. So bank is one part of distribution, but there's a lot of other distribution that's happening. What we need to do, in my view, is today we have about 1 lakh registered ARNs in this country. Maybe 10, 20, 30,000 are active. That number, I wish you start a panel. When will India have 10 lakh individual financial advisors?
Okay. Yeah, Bala, quickly.
I just
Anything to, huh?
And I just.
But I have a few more things to.
Echo her,
please,
echo her voice, that point she made. So I've been part of Faithullah Group for last 30 years. It's not a bank.
Your rise is from a dealer to the
Correct.
to the topmost.
Same cycles, being part of the same group.
Yeah.
In my entire career time, I never felt our mutual fund is not backed by bank as a sponsor. Okay. The need was never felt that you need to be a bank promoted AMC to build your business. Mutual funds actually built on the basis of the brand, performance, people, and so on and so forth. Of course, the last few years, thanks to, of course, SBI is the one who made the elephant to dance, which is SBI became the largest distributors.
That's the
and who have got 45 crores or 50 crores customer base. They realize the potential of SBI power of customers. Therefore, they actually contributed quite a lot for the industry growth in getting new customers. But having said that, despite the trend that you have seen from a banking contribution point of view, it's only about 23% of the AUM coming from banking industry. The rest of them coming from individuals and national distributors and so on and so forth. My belief is, as we move forward, while of course banking industry will have many of their obligation to them. One is, of course, they will keep changing from, the goal will keep changing. Sometimes mutual fund will become their goal to push. Sometimes it will become insurance. Sometimes it will become deposits that will keep changing. But I think the wealth effect which is rising, you'll definitely see, as Radhika was mentioning, more and more MFDs will come and participate in the mutual fund growth. RIAs will grow in size. My own belief is, as the wealth effect is keeps rising, you'll probably see that one of the industry will become the largest industry in the next few years, the actual distribution industry.
Thanks.
I think so far we have never thought that distribution industry will become very large. The next few years, the distribution industry will become one of the largest industry in the financial sectors, which has never seen the potential of it so far. But I believe the next 5 years will come.
Kamal, one small point. This is for Nilesh Bhai. Since he said that DP must work very hard. Nilesh Bhai, you should not underestimate the power of me and Bala also to work very hard, despite not having a bank.
Okay. Now, I'll just rephrasing the question because you three are the bank led, unlike them and all. And for the sake of time, it's okay with you, right? So the same thing, that SEBI norm now for the distribution charges, etc. Now you talk about that B30 and T30. These are the two milestones you speak about. T30 is the top 30 cities or top 30 centers, and B30 is the beyond that 30 centers and all. So with the SEBI new norm for the distribution thing, is any do you need to relook at the distribution part, or will it in any way impact it, or anything? I don't know. Singh Saab and others and all. SEBI gentleman has gone already, whole-time director, so we can talk frankly.
No, I think T30, B30 is a statistical number only now, because there's no additional benefit which is going to B30 in distributors anymore.
That's what I say.
That's the first thing. And second, I don't think we need to have extra benefit also, because earlier what was happening, actually the investors of T30 were benefiting the distribution community in the B30, but definitely there's a case for looking at the whole remuneration system, which is all trail basis. And when we have to bring in the new small time investors into the market, the acquisition cost is very high. To be fair to the distributors, if they have to do small ticket business, they need to get some remuneration for acquiring those customers. That is something very, very important, which today or tomorrow, day after tomorrow, we have to work on. Because otherwise this dream of making 10 lakh distributors from 1 lakh distributors will never be there, because there's no business model for doing the small businesses. That is number one. T30, B30, one thing is there that even the B30 time, the penetration has grown over the period of time. When we look at the numbers, the additional numbers are coming from B30 towns. The percentages are growing in favor of B30, which was there. It is now more balanced. But at the same time, there's a case for penetration within T30 also. If we are sitting in Mumbai, we can't say that the Mumbai every individual has been reached out. The small ticket businesses and the small investors are yet to be brought in. So T30, B30 for the purpose of statistics and looking at how to make your synergies and how to structure your future plans. That's okay, but nothing beyond that.
Nilesh Bhai and Navneet just want to add anything. And can you just also tell us that when you talk about B30, that's beyond 30, what are the new 1 or 2 centers that had come up which was not on your radar, and now in terms of AUM and massive inflow? Is there any name, any geography comes to your mind? And about the SEBI norm distribution, quickly, so 1.5 minutes each, sir.
banks are contributing only about 30% of mutual fund AUM. 30% is with national distributors and 40% is with individual IFAs. In the top 10 distributors of mutual fund last year, 3 were banks, 7 were non-banks. And today, a platform like Grow gives about 10% of SIP book at 2,500 crore and 25% of incremental investors coming in. My guess is that in a country like India, we will require different model to reach out to customer. Banks will have edge over HNIs and upper middle class. Platforms will have edge at the lower middle class and new to investors. And T30, B30 doesn't really matter. What actually matters is the level playing field. Today, the commission which is paid to various financial services product varies quite largely. And many a times, commission is becoming an incentive to sell the product rather than what is suitable to that customer.
The mis-selling, you're not saying this, I'm saying this, yeah.
So a level playing field is necessary. And we will require both physical and digital channel to reach out to different segments of customer. As a bank, we do get certain head start, but our bank is open architecture. My largest distributor is not my bank, it is someone else.
Some other bank?
No, it's a national distributor. So at the end of the day, we all have to perform and we have to leverage our distribution channel so that we can reach out to every segment of the investor base. Today, SIP and mutual fund Sahi has made an impact. Some time back, Economist wrote an article about how in Jorhat, large number of people were investing in mutual fund.
Assam, right?
Assam.
Yes.
Now, who would have ever imagined that Jorhat could be such a big investor base that it will get covered by the Economist?
Yes.
So today, I can safely say SIP has become from systematic investment plan to sab ichha ki purti, and mutual fund sahi hai.
Okay. Navneet, you want to add anything? So quickly.
By the way, Radhika mentioned that
we'll take a couple of questions after Navneet. So just get the microphone ready. Yeah, sir.
Radhika mentioned that 3 are bank owned. So I became bank owned only a year back. We were part of SDFC Limited for all our life.
But in your previous avatar, you were a bank owned.
But bank was an associate, and SDFC Bank has been a pioneer in selling investment product to its to its clients. And any AMC that has a good proposition for investors has benefited from the distribution network of SDFC Bank. As Nilesh Bhai mentioned that, in fact, Nilesh Bhai, it's only 20% in fact banks in the overall AUM. Now the national distributors and MFDs put together are substantially larger, and fintechs have become pretty large over the last couple of years. So just to complete that point, so if SDFC Mutual Fund has done well, it's because of the track record of decades. It's because of the servicing the distributors and investors and many other reasons. On the B30 point, so in last 10 years, industry has grown 8 times. B30 AUM for the industry has grown 18 times. In the overall AUM, B30 AUM is 19% of the overall AUM, but 28% of the equity AUM is from B30 towns. More than 30% of the incremental flows in equity come from B30. 40% of the SIP book today of 24,500 crores is from B30. 46% of the folios are from B30. More than 58% of new SIP accounts get opened in B30. And for fintechs, that number is more than 60%. India is a country which is underserved in financial services, almost all financial services, but a country which is digitally empowered, digitally enabled, digitally aware. And I think that's a great hotbed of innovation for a lot of people to reach out to a larger and larger population. Over the next several years, I think this trend will continue. And because of that, in the first week of January, Dada, you used to have front page advertisements by a lot of banks opening 20 branches, 25 branches on a single day. You don't see these ads these days. But as HDFC Mutual Fund, we take pride that we opened 24 branches on a single day on 2nd January of this year.
Thanks, Navneet. When you reel out all the numbers from your memory, it's amazing. Yeah, any question from anybody? Just, can this lady has the preference? I mean, just for the gender's sake, she's just quickly.
Thank you, sir.
Very short question,
yes,
no comment.
My name is Arpita Maini. I'm from Millennium MAMS, a group that teaches financial literacy to women. So my question is, now with Donald Trump winning the elections, where do we see the Indian capital market head in the medium term?
We already, I think, discussed in the first round itself, right? So you want to say anything quickly? Anybody wants to say anything? Just one line answer, because of the time sake.
I can see the CIO sitting in front of us. For them, it will be a better question.
Okay. That's, yeah, this gentleman, please, quick, because we have to.
Yeah, I'm a banker, moved to corporate, banker to academic.
Quick.
When you're going towards the path of 100 trillion, and Madam was saying about catch them young, why can't we have HAMFI chapters in colleges and school to reach rural markets, where it can be a big game changer?
We've just initiated one of the most ambitious essay writing competition among the school children. In fact, it's underway. And there are many other initiatives that all of us together are taking an MFI to reach out to larger and larger population, including college and school students.
Thanks, Navneet. Next person, sir, quickly.
Quickly. One, there was some concern by the regulator, SEBI, regarding flow of funds to small cap and mid cap funds. And that particular issue, I think it must be engaging all your attention and things must have been all right. But for the information, if you would like to add.
Thank you, sir. Anybody wants to answer that? Quick, sir, one line answer. Please get the mic behind whoever wants to.
We have been advertising people to invest, one with longer term horizon. Our last NFO had a advertisement, invest with 5-year horizon. Second, we are requesting people to moderate return expectation, and in this Diwali, most of the headline from our side were moderate return expectation significantly. If you combine this two, then I think small and mid cap are fine.
Thanks, Nilesh. Yeah, gentlemen, please.
Vikram Mehta here, representing Lawrence Grant. I just want to ask everyone, yesterday we had a good summit, foreign bankers were there. They were reluctant to open new branches, but they are more keen to invest in India. Looking at today's scenario, what you guided us just now, that investment, they are taking back, again coming, Lagan picture, Nilesh Bhai. Short of that, looking at that, if they are coming back again and we are also investing a lot, so 100 trillion or 200 trillion, what ma'am guided, we might achieve in 1 year or 2 years. I just want your highlights on that. If they invest more on this, how far or how fast we can, achieve that target?
Bala, I couldn't get the question exactly. Quickly.
Yeah, of course.
Thank you.
Unlike a bank, because they always depend on various sources of getting the transactions. I think they depend on one way of building their business. They also depend on the private sector loans. They actually buy it from somebody else. Therefore, they never feel the need for expanding the reach, especially foreign banks when you mentioned about. Whereas the mutual funds, we are the Adivalasalam mutual funds, have been expanding our reach, given the fact you need to be close to the customers. And being our 30th year of operations, we ourselves opened about 30 branches this year. So therefore, this trend I think will continue. At the end of the day, being close to the customers will remain as a trend. Therefore, when you have to look at the roadmap, you'll find more and more people actually being close to the customers. Therefore, branch opening will be one aspect. Second, as Nilesh mentioned about today, the reach is there everywhere. I think B30 cities can be reached with the technology platforms. Even rural cities can be reached to the technology platform. Technology available everywhere. Investors are becoming savvy using technology. Therefore, that concept also will actually gradually over a period of time will change.
Okay. Thanks, Bala. Actually, I'm sorry, unfortunately, because of time, you can always catch hold of them and ask. And as I said, go to Chembur Golf Club, ask Bala. So, the two recent regulatory move pretty big move by State Bank, by SEBI. One is that, the new products. One is that MF Lite is a sort of passive investment. And second is NAC, NAC, which is a new asset class. It's something between mutual fund and PMS kind of thing. I think there the minimum investment is rupees 10 lakh. So these two instruments in the mutual fund space, what's the impact that you see? Any of you, because of the time stake, I can't ask any of you. Madam, you want to answer?
I can take this quickly. I think more innovation is good. I think new asset class is a recognition that MF as a platform is a fantastic platform, but maybe for a slightly more evolved customer set at 10 lakhs, you can offer slightly more niche strategies. So I think as asset managers, it allows us to showcase our skills in a more flexible format to a different set of consumers. Passive light is again a good initiative for people who want to. It reduces cost of compliance. I think net, as I see new asset class, Tamal, I think MF will continue. Pure play MF business will continue to be the dal chawal of what we do. And these are all nice subsidy additions that expand the basket.
Okay. Anybody else want to add something on this passive fund? Navneet? Because you are also the AMFI chairman, so wearing that hat, can you tell us?
We are transforming from a country of savers to a country of investors, and over the next several years, I think this journey continue. There'll be more products, there'll be more vehicles, there'll be more distribution channels. Everything will grow.
Okay. Anybody, Bala? What?
No, I think
because there are a lot of discussion in your circle.
No, this mutual fund is more like innovative way of encouraging people to come to the mutual fund. By way of having a lesser capital, you invest less on people, invest more on technology, and offering a product which are more simple product, which are more index kind of product. That's why I think mutual fund light is being thought about. Of course, it will be subject to discussion, debate, and public opinion, so on and so forth.
And
AMFI
must be educating the investors also about the new products, right?
Yeah.
All the time, mutual funds.
Okay. Okay. Yes, sir. Okay, so actually I had many more questions, including the HR issues, because your every step is been monitored by SEBI, every phone call you make, and people are leaving. They're not that leaving one mutual fund and going another, doing something else. But unfortunately, this time is not permitting us.
Maybe we have 34 seconds if I
No,
can answer that.
I'm using in a different way, sir. The mutual fund sahi hai. This is something has caught on across India and all. Even bankers are now imitating, saying that bank deposit sahi hai. And then, but tell us tomorrow if you've been asked that, I mean, you have not patented it, bank, so yeah, you need to have a different slogan in the current context to sell mutual fund. What would be that slogan? Bala, starting from you. And Nilesh, you have the liberty to answer in the form of a song. And please, everybody else, join him. But Bala.
Mutual fund jaruri ho jayega.
Achha,
Mutual fund jaruri ho jayega.
Mutual fund jaruri hai, not sahi hai. Singh Saab?
I think both will coexist. We need not rewrite.
एक slogan तो बताइए sir क्या?
I think I'll go with the mutual fund जरूरी.
जरूरी है. Navneet, you are the AMFI chairman.
Mutual fund.
नहीं वो बोलते हैं there is some regulatory issue, you can't use it at all. So what else? हाँ?
नहीं वो उसको change करने की जरूरत ही नहीं है.
Madam?
I have two. हर घर SIP सबका investment plan. That is one.
हर घर SIP.
हर घर SIP.
हर घर
SIP. घर घर SIP. SIP is सबका investment plan. Okay. And since Nilesh has been doing a lot of singing, the last thing I'll say, मैं आपको 2 line शायरी की छोड़ दूँ.
Please, बोलिए.
So since you said 100 trillion, I love this poem. I think it's very applicable. कि for our industry, अभी तो इस बाज की असली उड़ान बाकी है. अभी तो इस परिंदे का सही इम्तिहान बाकी है. अभी तो लांगा है मैंने सिर्फ समुंदरों को. अभी तो पूरा आसमान बाकी है.
Wonderful, wonderful. Nilesh, you have real competition from her. Last word or last pair or last song, whatever is yours. And let them dance. No problem at all.
सब म्यूचुअल फंड वाले तो बस यही गाना गाएंगे. बाबूजी धीरे चलना, प्यार में जरा संभलना, बड़े धोखे हैं इस राह में. There will be competition and luring from all financial instruments. But आपको मालूम है म्यूचुअल फंड ज़रूरी है, म्यूचुअल फंड सही है और हर घर में SIP होना भी चाहिए.
Thank you. With this note, we end this thing. We could have gone on and on with all these with this kind of panelists, but unfortunately time is up. So give them a big hand. Thank you all.
Thank you so much, panel members. Can I request Mr. Tamal Bandyopadhyay to present our panel members with a memento? And a big round of applause for this insightful and lyrical panel discussion, I must say. I think inundated with a lot of takeaways in terms of 100 trillion mark being achievable in next 3 to 4 years, and the fact that the real hero, heroine is every retail investor who's contributing to the AUM. And India is now, with the Blinkit generation, needs things very quickly and easier to take risks. Ladies and gentlemen, at this point, I'd like to draw your attention to the fact that we have a Knight Frank report launch, which is happening at Narayanan Vagul Hall. It's a Knight Frank housing report launch, which you cannot afford to miss because it's again filled with a lot of market insights and trends. So I request you all, a few of you to also move to Narayanan Vagul Hall for this report launch, which is going to take place at 11:30 a.m., followed by a panel discussion on housing. With this, a big thank you to all our panel members. Hi, sir. Ladies and gentlemen, once again, let me remind you all that in the Narayanan Vagul Hall, we're actually doing the launch of Knight Frank Housing Report. And after the launch, there will be a panel discussion about banking on bricks and housing. So can I request you all to make your way to Narayanan Vagul Hall? There's a report launch happening at sharp 11:30. In fact, it is in the works right now. Requesting you all to move to Narayanan Vagul Hall, where the Knight Frank Housing Report launch is taking place. All right. Ladies and gentlemen, we have a panel discussion taking place in this very hall, which is going to take place with the mutual fund CIOs, exploring the topic of, is the market in a bubble zone? This panel discussion, ladies and gentlemen, is happening in this very hall. As market valuations soar, the question looms, are we in a bubble zone? Today, leading CIOs delve into the dynamics shaping current market highs, from liquidity influxes to evolving investor psychology. With insights grounded in deep analysis and historical trends, this panel will address the sustainability of these valuations and strategies for navigating potential risks. Let's move into this exceedingly data-backed exploration into whether today's market is overheated or primed for further growth. To maneuver and navigate this conversation, I'd like to call on stage our moderator. But before I do that, ladies and gentlemen, can I request you all to please settle down so that we can get started with our panel discussion right here, right now, in the Chintaman Deshmukh Hall in a seamless fashion and on time. All right. All right. Ladies and gentlemen, to navigate and maneuver this conversation, we have with us Mr. Sami Modak, Markets Director at Business Standard. And to actually maneuver this conversation and build the conversation further, Yeah. Mr. Sammy Modak, Markets Editor at Business Standard. And can I request the following panel members to make their way onto the stage? All right, everyone, before we call the panel members, I'd request you all to please get settled down so that we can start the session in a seamless fashion and on time, and you all are in rapt attention listening to the perspective and outlook of the thought leaders. So can I request you all to please settle down? We're going to get started with a panel discussion with the mutual fund CIOs illustrating and construing the topic of is the market in a bubble zone. Joining Mr. Modak on stage, can I request Mr. Mahesh Patil, CIO, Aditya Birla Sun Life Mutual Fund, to make his way onto the stage. Mr. Rajiv Radhakrishnan, CIO, Fixed Income, SBI Mutual Fund. Mr. Sailesh Rajbhan, CIO, Equity Nippon India Mutual Fund. Mr. Ashish Gupta, CIO, Axis Mutual Fund. Mr. Anish Tawakle, Co-CIO, Equity ICICI Prudential Mutual Fund. Mr. Mahendra Kumar Jaju, Chief Investment Officer, Fixed Income, Mirai Asset Investment Managers, India Private Limited. With this context being set, I think let's get the conversation started.
Yeah, thank you, Ridhima. Welcome to our panel, Is the Market in a Bubble Zone? Following our session on the mutual fund industry's Part 2, rupees 100 trillion, we'll discuss the investing landscape with the help of some of the country's finest money managers. A bubble is when asset prices rise drastically, often defying fundamentals. When we conceived this topic, markets were booming, and now there is a reversal in fortunes with the markets correcting sharply. With that, I would like to bring in Mr. Gupta and Mr. Patil first. I would like to ask you whether valuations are now more compelling, and also with the election results now out, how does this change things for the Indian market?
Sure. So before Mahesh, let me take the first go. So I think, yes, last month we saw correction. I think after nearly 3-4 years, we have seen in a single month the market correcting by about 7%. But I will not really say that the valuation excesses have gone away from the market. Because one prime reason beside the foreign money outflow was also that we did not have such a good earnings season, right? So if you see the September quarter results that came out, nearly 45-46% of the companies missed earnings, and there were earnings downgrades. So if you look on a simplistic price to earnings basis, the market, despite this fall, has not really become cheaper because earnings have also got downgraded. So I don't think the valuation comfort is back just as yet. But again, I would not want to paint the entire market with the same color. There are pockets in the market which are good value. There are pockets in the market which, as you say, is in the bubble zone.
Fair enough. You would like to also answer the election bit, and then we can go to Mr. Patil.
Sorry, which?
The US election, now with the election results out, how does it change things for the Indian market?
So I think we will come to know about the policy direction that actually gets implemented in the coming months. But basis what has been already announced was part of the campaign, I think one thing is very clear, that you are going to probably see higher US fiscal deficit and potentially higher US inflation for longer. I think the market has started estimating this over the last 2 months, and that is why, despite Fed rate cuts, bond yields in the US had actually gone up, and that was the other driver why you saw the foreign money outflow. If this trend continues, if US rates continue to remain higher, I think prospect of foreign flows will remain weak for our market. So I think that is a negative that we have to bear.
Thank you. Mr. Patil, can you come in now?
Yeah, hi. So I would say, clearly market is, we talk about a bubble territory, right? I think it's bubble territory means where you are looking at a market where it is, at the extreme end of the valuation and also at the peak of the economic cycle, right? Where everything at its peak. Your sentiments are at its peak, your liquidity inflows are at its peak, valuation, economic cycle. So I would say that, again, as Ashish mentioned, pockets of the markets are, if you look at Nifty, for example, right? So Nifty, the multiples, right, what was pre-COVID, if you considered market pre-COVID was not in a bubble territory, we are similar to the same multiples, okay, for the Nifty, where it was pre-COVID level. Obviously, the earnings growth momentum has been very strong in the last 3 years. This year is slowing down from around 20% CAGR to now, say, kind of a single-digit growth. And to that extent, I think, I mean, the growth also, what we saw in the market was backed by earnings, at least on the Nifty front. So I would say there it is. I mean, markets are never cheap. Indian markets have always been expensive, okay, because the relative growth differential for India looks still fairly good. I mean, if you look at the world economies, I mean, US, probably after these elections, the growth outlook there would be slightly better, so it will compete. But otherwise, India growth at around 6.5% GDP will still be good. And the profitability, if you look at, right, of Indian companies, what it used to be around 4 years back, pre-COVID, and now the ROC and our ROEs are much superior. So that would also imply that the valuations can be slightly higher, right? If you look at multiples of a company, you look at the return on equity, and also the macro stability is much better than what it was, say, 5 years back, right? In terms of whatever you look at in terms of our current account deficit, in terms of the rupee volatility. So I think in that context, the risk premium, what the market is to get earlier, I think there is a reason for that to compress a bit. So I would say if you take all these factors into consideration, market is, I think, fair. At least the Nifty, I would say. The large caps are fair in the fair zone. And yeah, small cap, mid caps, there clearly we had seen a big rally, a big euphoria there. A lot of money has gone into that space. So there, I think one needs to be a bit careful over there, because now with earnings momentum slowing down, I think lofty valuations where they are, I think they are likely to be at risk. And we've seen that in this quarter, in the last 2 quarters, wherever companies have disappointed slightly now, we've seen a sharp reaction in those stocks, which was not the case earlier, right? So I think in that sense, there is some change. I think post election results, we have seen the character, the color of the market is changing now, right? Clearly the leaders of the earlier this thing are now giving way for some of the other sectors and stocks.
Thank you. Mr. Tawakle, you run a small cap fund. So investing in small caps has been the flavor of the season, and valuations there are pretty high compared to their long-term averages. So would you like to come in here? How does the small cap?
Actually, I run a large cap fund and I run a small cap fund. And my large cap fund is much larger than the small cap fund, fortunately. See, we've actually closed our small cap fund for inflows some time back because we felt that valuations had got out of hand. I'll just use a slightly different definition of a bubble, right? A bubble is when if stocks fall 15% and then people wake up and realize, oh, this was not a great company, and then they come to sell, then you say that stock was in bubble territory, right? A market being 10% overvalued is not a bubble for me. Right? And I do think in the small and mid cap space, there are many companies I would say, where people have not looked at the risks, people have not realized that these companies are not as strong as they are claiming to be. And I would say they are in bubble territory. Now, what one has to be sort of cognizant of is that, look, a lot of, I feel that in India, even corporate governance is cyclical, right? A lot of these companies are coming, raising capital. So when people ask me, why are there are FII outflows? My question is, why are there so many promoters selling? That is the more relevant question. Why are so many promoters diluting, right? So a lot of this, will ultimately have to sort of adjust, and you will find that a lot of companies that are giving lofty guidance today will disappear, right? In the sense, have no communication later, and you will find it difficult to get a meeting with them. So one has to be fairly careful in the small and mid cap space is all I would say.
No, but if promoter selling is a red flag, we often see mutual funds are the counterparties to most of the block deals. So, I mean, how does one read that situation?
So I'll leave that to, I've managed the small cap fund for about 1.5 years. I've managed the large cap for much longer. I have tried to stay away from a lot of these, but people who handled that successfully perhaps can answer it better than me.
Mr. Ban, I would like to bring you in here. You run a large small cap fund, which is one of the largest in the industry. How do you see valuations in that space?
See, the trouble with the bubble is you will know only after it bursts, right? So today, while certain segments are good and sensibly priced, but nothing is cheap in the markets today. And the problem is the bubble may not just be only in valuations, it's also in the mind of investors today. A lot of people are coming in with return expectations which are unreal. And if you look at allocation of money in the last 6-9 months in mutual funds only, a huge amount of money has gone into sector funds which have done well in the last 3 years. So the challenge is, yes, there is certainly euphoria, there is certainly this, and it continues. That's the nature of the market, right? When more money is chasing a lot of, less amount of equity in the market, there's always this valuation challenge. The second question on yours on the promoter side, promoters selling. The promoters are finding their valuation so expensive that they want to reduce their holding, right? And what they are doing with this money is investing in mutual funds so that, they can diversify their exposure to a single company. So clearly, nothing is lying free in the market today. And like Anish talked about, we have to be extremely careful in terms of the kind of companies we invest in. Our basic principle is if you want to invest in a company today, if you can't afford to be a buyer in the company 15-20% lower by design because the business model is shaky or whatever, then those are companies to leave it today itself. They are companies not to chase. Within the small cap space, small cap is a very large space. Other than the top 250 companies in India are small caps, right? Clearly, if earnings don't improve from where we stand today, there will be challenges. So for that very reason, about a year back, we have made only flows through SIPs in our small cap fund, and just making sure that we keep it far more diversified than usual, and obviously working on quality of businesses at all points of time.
Let's get in some fixed income perspective. We have two CIOs on the fixed income side. Given the post-COVID equity boom, debt investments have taken a back seat. Net inflows into active equity funds over the past 12 months are more than 3 trillion. While that in the actively managed debt funds are less than 1 trillion. Also, this disparity stems from the fact that equity returns have been very impressive. If you look at a 3-year annualized return for the equity, large caps have delivered 15% annually. Small caps, the returns are even higher at 25%. On the other hand, most debt funds have delivered returns which even fail to beat the inflation on a tax-adjusted basis. So given that context, I would like to bring in Mr. Jaju and Mr. Radhakrishnan. How are debt schemes, what do they have to offer in the current environment?
Yes, so I think the way you describe, I think the real life situation is much better than that. So let me share some data with you. First of all, the bank deposits grew last year by 23 lakh crores, right? And the mutual fund debt AUM, I'm talking of October to October 23 versus 24. So the debt AUM of the mutual funds grew by about 2 lakh crores. So from 13 to 15 lakh crore. The equity AUM grew from about 20 lakh crores to 32 lakh crores, so 12 lakh crores. The net equity new sales is 3 lakh crore, out of which SIP is 2 lakh 25,000. So all in all, in the best year for the equity market, you have net equity sales of 1 lakh crore. So this entire glamour about equity is shared by very few people in the country. So I think there is a reason to be optimistic, because I think all of us are discussing that the reach of the mutual funds is just about beginning to expand. So we are very positive on the equity side. Now you talk about the debt side, the same thing applies, because today, because of the tax incentive having been withdrawn, or because of the lack of awareness, people are investing 23 lakh crores of fresh money into bank fixed deposits, which not this year, not last year, since the inception of the banking system have never beaten inflation. Whereas the debt mutual funds are the products which are market related. The best possibility of any option, any product to beat inflation is when it is a market related product. So the best option on the debt side is the debt mutual funds, which the investors have still to understand and adopt. So you go back 10 years, there was a lot of, similar situation about equity funds. So in the first leg of the growth of the mutual funds, the equity has picked up. It's a natural progression. So I think that for me, the way I look at things, I think things are looking very positive. Now the second part that you talked about is the return on the debt funds. Now, look, cricket is a very popular sport in our country. So I'll just take a little reference to cricket.
Sure.
There are times when India was losing all the time. Then there was time when India stopped losing. Then India started winning. But when did India become undefeatable, the #1 team, right? I'm taking a few seconds longer because that needs to be heard a little more. So when Gavaskar was there, India was still losing, even though he was world class. When Tendulkar came, India started winning once in a while, right? When Dravid came, India started losing, stopped losing. But when Sehwag came, when Yuvraj Singh came, India became indefeatable. So the point I'm making you is that unless you have a diversified portfolio, right, you cannot become undefeatable. You need a Sehwag to win, you need a Yuvraj to win, but you need a Dravid to not lose. You are indefeatable when you don't lose, not only. So I think there is a space for every asset class, and things are, India is still a growing market. We are still trying to push the debt too hard. Today, there is no difference between taxation of a debt mutual fund and a bank FD. But such a negative impression has been created as if debt mutual funds are having a tax disadvantage, which is completely false. We had an advantage which has been taken away by the. So I think the way, so the point I'm saying is that in terms of the possibilities for future, there's reason to be optimistic than say, oh, my return is poor, or my corpus is not growing. No, this is just the start. We are making the base. Thank you.
Mr. Radhakrishnan, can you also make for a compelling case to invest in debt at this juncture?
Yeah, in fact, so we need to accept the fact that, of course, there have been certain adverse taxation changes in the last few years, but just leave aside that fact, even sort of to connect with our topic here. I mean, debt is one segment today where we typically don't speak about valuation so much in debt, but I think it's time to start looking at that as well. So, how do I look at it? You said real rates. At this point in time, if you're buying a 1-year AAA bank CD, you get it, or maybe a 1-year AAA bond, you're getting something like 7.5 to 760. So you can construct a portfolio with a 1-year duration with high-grade instruments at around 7.5, 760. Even if you are assuming that the next 1 year ahead inflation is not 4.5, RBI's projection is 4.5. Most of us think it could be slightly even lower, but let us stress it, say it goes to 5. You still have more than 2% real return on a prospective basis. And I think that's one clearly compelling argument on fixed income today. And I'm not even talking about any capital gain that may come if interest rates go down. That's just leave aside that. So purely from a very, I would say, HTM or a hold to maturity investment on a 1-year prospective basis, you have visibility of real returns. And whenever in the past, when you've looked at it, when you have real returns being on a prospective basis visible, the outcome from a debt investment has been quite, I think quite attractive. And I think we are possibly in a very similar phase there.
Okay, fair point. Let's now come back to the equity side. We'll delve a bit more into the FPI investments and earnings growth. FPI holdings in Indian companies are at a multi-year lows. And we have seen record selling in October. So it looks like FPIs have been tactically reducing their India exposure. A lot of funds are overweight on India. So is FPI outflows an impediment for the growth of the Indian markets?
So I think if we see last 5 years, that has not been the case. So last 5 years, clearly FPIs, in fact from 2021, have been underinvested in India. Just to put some numbers, I think 20 years ago, FPIs were about 25-26% of the market. Today, they own about 17-18% of the market. So their shareholding has come down because Indian retail and Indian mutual fund shareholding has gone up. And the domestic flow, and we heard all the numbers in the previous panel as well, has been more than able to offset the outflow. I think while near term looks challenging given what's happening on the US yields, on how quickly FPI flows will turn, but I think medium to longer term, India remains one of the best growth stories out there. So I think foreign money will come in. The other interesting fact is that this lack of FI investment in the last 4 years has happened at a time when India's weight in the indices, global benchmarks, has gone up. And if you look at the emerging market benchmark, India's weight in the last 5 years has gone up from about 8% to 18-19%. So considering that, FIIs are actually very underinvested in India, right? So at some point of time, they will have to come back. But if I look at the more closer term, there is the fact that FI investments are likely to be lackluster given what's happening on yields, and simultaneously there is a big increase in supply of paper, as Anish also mentioned, promoters selling that has been happening, the number of IPOs and QIPs that are hitting the market. So I think in the near term, that is a challenge. I spoke about this in another event a couple of days ago, that in the last 3 years, domestic investors were able to offset the FIIs selling, right? But that was because the supply of paper was not large, right? So if I see the pace of supply of paper now, that will be about 4-5 lakh crores over the next 12 months. So we will need foreign investors also, in addition to the domestic equity supply, equity demand.
Yeah, fair point. Would you like to also come in, sir?
No, I just, I wanted to address the sort of latter part of your question, whether it affects economic growth, right? See, we've had a very sensible policy of keeping a limited, restrained current account deficit, right? And ultimately, why do you need inflows? It doesn't matter whether it's FPI, whether it's FDI, or whether it's borrowing. Ultimately, you need foreign capital inflows to supplement domestic savings and to fund your current account deficit. Now, as long as our current account deficit remains in check at about 1 to 2%, we should not spend too much time wondering about where it will come from. 1 to 2%, as long as your deficit is small and restrained, funds will come. And whether they come this month or next month, it doesn't really matter. Whether they come as FPI or FDI, it doesn't matter. Or whether we do a little bit of ECB, it doesn't really matter. From an economic growth perspective, the important thing is that the current account deficit is in reasonable shape and investment in the economy is picking up.
Okay, fair point. Mr. Patil, you talked about earnings growth post-COVID has been, the growth rates have been high, and now the first half has been quite a disappointment. So is that a new normal? With the post-COVID stimulus measures now over, will growth be more challenging going ahead? Earnings growth will be.
So if you look at the growth wise, in the last 4 years, if you look at, right, the earnings growth has been driven by a lot of improvement in the operating margin, right? So if you look at the top line growth in that period, was not very high. It would have been around, say, slightly higher than the nominal GDP growth, right, around 13-14%. It's not unlike in the earlier bull run what we had, right, in 2003, 2008, where the top line growth was like 22%, 23%, right, and earnings growth was around 25% CAGR. So it's been driven by operating efficiency, margin improvement, okay, to some extent improving balance sheets, right, which have deleveraging, which has led to a higher bottom line growth. I think that to a large extent is now behind us, and we've seen that now the earnings growth is converging to your top line growth. And as your top line growth, I think, would be driven to a large extent, by and large, in line with your nominal GDP growth, which will be around 10, 11% or so in that region. So I would say that this year, probably there's some amount of some normalization which is happening, and that's why we've seen the growth slightly tracking below. But I think if the GDP grows at around 6.5%, nominal GDP at around 11% or so, I think earnings growth should probably track in that range going forward. And a lot of sectors, it's not like we're seeing any major challenges in any sector, right? So there is some slowdown we've seen on the consumption side, where last couple of years has been slower. I mean, that is likely to improve. I mean, it's been slightly delayed, but rural consumption and other areas is slowly picking up. So that should support. Whereas the growth has been driven to large extent by the investment side. I mean, government spending has been very strong in the last post-COVID. That is slowing down. So I think some amount of, that rebalancing has happened. I mean, investments were tracking ahead of your pre-COVID trend. Consumption is still lagging. I think that will probably normalize again. So I think I would still believe that India earnings growth for the market, say if you look at Nifty, would still probably grow in the low teens from a medium-term perspective. This year, probably you would see it slightly lower than that because of the strong growth what you have seen in the last 2-3 years.
Mr. Ban, would you also like to comment on whether the post-pandemic growth party is ending? And, what are your views on this?
Like Mahesh said, the problem is the top-line growth is very weak. Not today, now it's about 6 quarters. And we are at reasonably peak margins, because most companies are reporting the best possible margins till this quarter. So I think with a lag of maybe a few quarters, earnings should trend higher than where we stand, because trending below the nominal GDP growth rate as it is for earnings on a sustainable basis may not be easy. Second is the starting point today is a little more difficult for a stronger earnings recovery unless everything recovers. India is no longer so small that you can't, you need a broader global growth to be good. You need many things to work to be delivering that 15% plus kind of growth rate. Earlier, when our bases were very small, we have done 22% revenue growth, 25% earning growth for a long period of time, 3, 4, 5 years. But I think today we would have to work with improved earnings from where we stand, but it has to be the lower teens as maybe between 10 to 15%, 10 to 12% over a medium term is what we think at the moment is possible.
Fair enough. We'll soon open the floor for questions from the audience. Before that, we'll go back to our fixed income CIOs. So now even the older generation is, pivoting towards equity investment. What would be your advice? How does one, approach the fixed income space? If you are an investor, if you want to come in at this stage, how does one sort of approach this space?
I think eventually it boils down to individual asset allocation choices, right? Would you really want to be 100% invested in equities? Quite possible. Some people possibly would have that approach. But I think end of the day, given we did speak about relative valuations on both asset markets. So I think for a normal investor today, would you really want to diversify? I think you need to. And possibly given where we are today in the rate cycle, a lot of fixed income products do provide value that gives you the diversification in your overall portfolio. Or the other approach could, of course, be to approach fixed income investments through the hybrid category or the balanced products. So I think these are the various options that you have. But I think end of the day, it's an individual choice. Whatever allocation that you are comfortable based on your risk tolerance and your timeline, I think that really matters.
Investors generally, when we meet equity investors today, proudly say they are 100% into equities. Right. That itself is a signal that a lot of things are bubbly first.
Fair point. Mr. Raju, would you like to add anything?
No, sure. As Rajiv was saying that for different people, the risk appetite is different and the investment objective is different. But debt at a conceptual level, like we say that we have 140 crores debt investors in India because there is no one who has zero debt in his portfolio. The challenge that we are discussing here in the context of mutual fund is how do we get those investors into mutual fund? Debt as an asset class is not challenged because even when the returns were negative, the bank deposit rates were negative, even at that time the deposits of the European banks were growing. I think the context in which we are discussing debt that needs to be redefined. The challenge that we have as an industry is how do we get those investors who are investing even today at 2% in the savings account when my liquid fund is giving 7.5% return. What do I do to get him to invest in my liquid fund? That is the challenge. To pitch debt as an asset class or as an investment option is not really required because you have 140 crores investors in debt in our country of 140 crore citizens, right?
Yeah, that's a fair point. Our salary gets credited every month,
I think
and there's
whenever we're discussing debt in the context of mutual fund, question it wrongly. The question should be, how do we get these people?
No, there's a lot of inertia, like your salary gets credited and it lies in your savings account. So a lot of us, don't proactively, if you don't want to take the risk, equity risk, at least you can, park it with a debt fund. But most of us.
Yeah, that's what I'm saying. So when we talk about debt in the context of mutual fund, and I think we can see a hint of that even within the panel, we talk of equity versus debt. It's not equity versus debt, because debt is universal. Like there is a lot of debate within equity between active and passive. It's not a debate. You need both. So therefore, I think we need to redefine the way we discuss debt than to discuss if debt is a required, product in our investment universe or not.
Fair point. We'll take a few questions. If anybody has any question, please raise your hands. There's one lady at the back, please.
Thank you, first of all, for such an insightful session and discussion. Manisha here this side. I'm from ISI Markets. We are an economic information company. So my question is that earlier equity was very simple. Either you're going full in or you're taking the mutual fund way of entering the market. But now international funds have also come in, right? Now we want international exposures. So my question is that if we are exploring international investments in form of equity, so what are our view in exploring that horizon for debt market? Or is it already there and we aren't aware about it?
Are you asking whether you can invest in international debt?
So my question is that how easily we have made it available for retail investor to enter into international equity segment, because through ETFs and various funds. The same way, if we have to explore the horizon of debt of international market for retail investors as well as other stakeholders for that matter. So what are easier ways, and is there like a lot of possibility and opportunity there?
So I think through the mutual fund route, the ability to invest in international stocks, it's governed by that overall limit which the RBI and the regulators have provided. And as I understand, the limits are exhausted until the RBI gets comfortable opening up investment limits further for overseas investments. Today, you don't really have a route to invest in international debt. Now, but why did you really want to invest in overseas debt if where yields are? I think India is the right market. In fact, as a domestic investor, you should be really comfortable investing in our bond markets where the yields are relatively attractive, where we are in the face of interest rates. Potentially, you could get capital gains as well. So I think right now, you should not really be thinking about international debt investments. Possibly at some time in future, when the limits are open, possibly you may get some opportunities.
Unless you invest in a high-risk country, the yields are much...
No, I would say that, at times, there are, currently the limits are full, but there are products, right, where you can, we have launched a US Treasury bond fund, around 6 months back, when US Treasury yields had gone up to 5% or so. And there could be some merit over there because there are opportunities, like if you look at the differential between the US Treasuries and India, it's the lowest at this point in time, right, historically. So if you look at, there is the rate cuts, probably what you will see in the US could be much sharper than here, so you could get some kind of gains over there. So yeah, I agree, there is an opportunity there, to invest tactically, I would say. Yeah. And again, you're looking at dollar returns, right? How rupee also. So I think there are, but currently, because the limits are full, but whenever it opens up, there could be merit tactically to play in the overseas, the US, especially in the US debt side, depending how the duration is playing out over there.
Yeah, we have one more question from there. Yes. Please pass on the mic.
Hi. This question is for the equity CIOs. The industry has been continuously talking about moderating return expectations for the past couple of quarters. But thanks to momentum and fund flows, that hasn't happened. What makes you think that those return expectations are going to moderate when the momentum and fund flows continue?
Anybody who would like to take this question?
So I think, see, again, in the, flows, again, we have seen they tend to be a bit cyclical also, right? When everything is good, outlook is good, earnings momentum is strong. We see the flows continue, and also flows to some extent are also governed by the sentiments, the past returns. What we're seeing is that there is clearly earnings momentum is slowing down than what it was in the last 3 years. We talked about that. And the returns also now, as I said, the market returns have, especially broader market, right? Because in this last 6 months, we've seen that while the market is only down 7% or so, there are many stocks which are down more than 20%. If you look at the breadth, it is starting to weaken. So clearly, the returns are already starting to, if you look at on a 6 months basis or 1 year basis for individual investors, will start to slow down. So that could impact the flows also. I'm not saying the flows will continue, but again, as I said, the supply is also coming in, right? We've seen now the supply. Up till now, it was coming in from the secondary side, okay, promoters selling, but a lot of companies would start to raise capital for future growth, okay, which we haven't seen in a big way. And that would, to some extent, match the demand, right, which is coming in from the strong flows. I think supply, as Ashish also mentioned, we are seeing a strong supply of paper coming in. So I think that would address, okay, in terms of the demand-led pull, what the market was seeing. And that was seeing the divergence from fundamentals a bit in a few stocks. I think that could correct, and that could be a reason. We're already seeing that, right, in the last few months. That's happening. So I think it's not given that the money flow into the markets, while we think that we expect that the SIP flow will continue. I think that's the best way the market is coming in. But again, on the other side, you have to see the supply side also, and that can also probably moderate down a bit depending on how the recent volatility and the past recent experience of the market has been.
See, any argument, right, which is investing argument that's based on flows is essentially an argument based on the greater fool theory. We can do a lot of sophisticated analysis to understand the flows, but if you are hoping that flows will continue, you're hoping that there will be a greater fool to cover up for your mistakes. So it's not good to make an argument on flows in the first place, right? The argument should be on what's fundamental valuations that will sustain. Because it's only then, if you've made the argument based on fundamentals, if it falls 15% because of flows, you'll be able to come in and buy. If you've bought on flows and then the flows disappear 15% later, you will want to sell. Right? So don't base arguments on flows because they're essentially arguments based on the greater fool theory.
We're almost out of time. We'll take one last question. Keep it short.
Yeah, I'm Dikshit here. So no particular opinion about any sector, but we are talking about bubble zone. So why does such things happens that when let's say any particular sector, for example defense, where almost all the stocks went up by 5 or 10x, and then we see a sector dedicated funds. Let's say we are not seeing a dedicated sector funds for stocks which have not performed over the last 3-4 years.
I would also like to add here, like you guys have, responsibilities towards the investors as well as the fund house. So how does one balance that? Like the gentleman mentioned, you launch a fund at the peak of, the cycle. I mean, how does one sort of approach
So I think our strategy has been that, yes, there has been both investors ask for sector dedicated funds. Investors have also gotten more sophisticated over time, at least part of the investor base. So our endeavor has been to do thematic funds which are very broad themes. So which is not just one sector, or the investable universe is not 15, 20, 25 stocks. There's not high concentration in a few names. So about 15, 18 months ago, we had done a manufacturing theme. About 3 months ago, we had done a consumption theme. Within that theme, there are about 12 to 14 different subsectors that you can invest in. And really, in every phase of the economic cycle, in every phase of the market, there are some components of that theme that will be doing well. So there are diversified opportunities. For very narrow sector themes, we actually recommend investors who want to take exposure to do it based on passive funds, because there we are not making any active call. If an investor wants to buy one particular sector, say for example, he just wants banking exposure, so there's a banking passive fund.
Fair enough. I mean, let me just add, I think sector sector funds, again, you have to some amount of timing is required over there to do that. And invariably, money comes in, okay, looking at the past returns, right, in a particular sector. So I think the best way to approach investing into sector thematics would be through a sector rotation fund of fund. Now, fund of fund also becomes a very good option for investors to invest, okay, participate in the mutual fund without worrying about the tax. So where we have a framework, right, where we decide, okay, in terms of how each a sector is placed based on the profit pool, the market, the valuations. And I think that can be a good approach for investors to come in and play sector through a sector rotation fund, through a fund of fund route.
Yeah, with that we conclude this session. I hope it has given you enough, it has given you valuable insights into investing. Yeah, thank you.
Thank you, panel members, and thank you so much, Mr. Modak, for navigating this conversation so effectively. Can I request you to present the panel members with a memento? All right, can we give this panel discussion a huge round of applause? Again, inundated with a lot of pragmatic insights, ranging from the fact that the biggest trouble with the bubble is that you'll know it's a bubble only after it bursts. Nothing is lying free in the market. We need to be focused and vigilant to the market's need and where to buy. 23 lakh crores is being invested by people in bank deposit schemes, and India has moved from 8% to 18 to 19% in the emerging markets. I think again a very intense, engaging conversation with pertinent insights for us to act upon. Thank you again, Mr. Modak, and the panel members who are the mavericks in the space of mutual fund CIOs. Thank you so much for this discussion. Ladies and gentlemen, now we'll segue into another engaging and pertinent conversation in form of a fireside chat. Folks, India's market commands a notable premium, but the question is it truly warranted? In our next discussion, market gurus are going to examine the fundamentals underpinning India's valuation, from economic resilience to demographic dividends to global investor interest. They're going to dissect and deep dive into such diverse topics. And they're also going to examine if this premium is truly a signal of strength or our imminent bubble waiting to get burst. Prepare for yet again a sagacious and a compelling dive into the matrices, the risks and potential that actually define India's market position on global stage. Ladies and gentlemen, at this juncture, I'd request you all to kindly get settled down so that we can transition into the next fireside chat with seamlessness and relentless ease. To actually maneuver and navigate this conversation, I'd like to call on stage our very own Mr. A.K. Bhattacharya, Editorial Director at Business Standard. And joining him on stage are again going to be the movers and shakers, the market gurus. I'd like to call on stage the following panel members, beginning with Mr. Prashant Jain, CIO, 3P Investment Managers, Mr. Vikas Khemani, Founder, Carnelian Asset Management, and Mr. Sunil Singhania, Founder at Abacus Asset Manager. So can we give them a huge round of applause, ladies and gentlemen?
Very good afternoon. This is a session with market gurus. And is actually, it's a privilege on my part to have this opportunity of interacting with these three distinguished market gurus. I won't get into describing what they have achieved in their careers, in their investing journey. Ridhima already has listed them out. What I would like to do is in the next 45 minutes or so, we would like to delve into this critical question of is the India premium justified? You know, now historically this has been a question that the Indian market has a premium which is not justified. Is it more than justified or not? So what I would like to do with Mr. Jain, Mr. Khemka, Mr. Singhania, is that in the first round, we'll try to demystify whether the Indian market, the market premium is really justified or not. And also get into the debate of how do you define a premium? Because there is this view that we are, high premium, may not justified or not justified. So let's get into the nitty-gritty of it in the first round, and then we'll go into the specific issues that concern the Indian market. We'll keep in mind the US developments that happened yesterday and will play out. So since you are closest to me, Mr. Jain, let me start with you. How do you see this thesis that the Indian market premium is not justified, or is it justified, and why so?
Thank you, Mr. Bhattacharya, and a good evening to all of you friends. And I think this is a very topical issue, and the PE multiples of Indian markets are indeed about 20-30% higher than longer term averages. And this has resulted in an expansion of the premiums of Indian markets over other EMs also. I think to a large extent this is justifiable because two things have changed in India. One is that India's growth prospects for next 5-10 years appear to be marginally better than the last 10 odd years. So I think given the supportive external environment, which is conducive for higher growth in offshoring of services, and also over time growth in manufacturing, plus a lot of improvements that have taken place in India by way of reforms over the last 10 years, I feel India's economy should grow maybe 1% or so higher in the future. The second more remarkable change is in the cost of capital. If you look at India's decadal inflation over last 4 decades, every single decade the inflation has moved lower. And as a result, the gap between Indian and US 10-year yields is running quite low by historical standards. It is between 2.5% to 3% right now, compared to 4 to 6% gap in the past. And as you know, PE multiples are inversely proportional to K minus G, K being the cost of capital and G being the growth. So K minus G I think has reduced by 1 to 2%. So I think we can justify 15, 20, 25% higher multiples of Indian markets.
So that adds to the earnings growth.
No, PE multiples is basically inversely proportional to 1 upon K minus G. The higher the growth and the lower the cost of capital, then fair multiples tend to go up. So I think we can justify 20, 25, 30% higher multiples compared to the past. And that is where we are trading at. So to a large extent, I think these premiums are justifiable. Also, we must note that India's return on equity is meaningfully higher than most other emerging markets. So, but at the same time, I feel there is very little room for PE multiples to move up in these markets. So our return expectations have to be more moderate, but more on that later probably. Thank you.
Okay, Mr. Jain is positive. He says that the premium is justified, looking at the Indian economy's growth prospects, looking at the capital cost coming down. But the long term, the scope is probably limited. Did I interpret you correctly?
As for multiples to move up, I think bulk of the return should come from earnings growth. That's what I was saying.
So it's a qualified comment where they are justified, but further growth is not probably on the horizon. Mr. Khemani, your take on it.
So I broadly agree with what Prashant has alluded. You know, any asset class valuations are function of only three things, right? The yield, growth in yield, and cost of capital or discounting rate, right? So in case of equities, yield is ROE, right? So which is whether you compare to the historical time or compare to any other market at 15.5, 16%, it is one of the best in the market. Nowhere else you will have that kind of ROE. Growth in yield is earnings growth, as Prashant was saying. So broadly speaking, most pessimist person will be around 15%, optimist will be around 20%, but that's the broad range of earning growth. I don't think any other market, is offering sustainability or confidence in the growth over next, 5, 10, 15 years. That's the kind of promise India has. So that's the second thing. Third is the discounting rate, which is a function of risk-free rate and risk premium. And if you see, India's risk-free rate has considerably come down. Difference between 10-year US and 10-year India is like hardly anything. It's lowest all-time low. And risk premiums are coming down. So I think we very often understand the change in the discounting rate in case of a fixed income very easily understood. That what is the change in the discounting rate has an impact on the valuation. A 2% drop in a discounting rate for a 10-year GSEC is we understand 12% appreciation, right? But in case of equity, a 2% drop in the discounting rate expands equity valuation by everything else remaining same by 30-35%, right? That's the kind of, so if earlier, let's say hypothetically speaking, 20p was there, 26, 27p also become normal with the just change in the discounting rate of any asset class, in this case equity. So I feel that as India is getting repaired or has got significantly repaired and is getting further repaired, as it is getting more and more organized, our tax collections are going higher, as more and more economy is getting formalized, our corporate profit to GDP will keep on expanding. Last time it peaked at around 6.5-7%. I think it will further go to 8-9%. So as that happens, you will see more and more earning growth happening and expansion happening in the further premium. I would probably will not give you a qualified comment. I would say that probably over next 3, 4, 5 years, you will see further expansion in equity premium. And another parallel of this is very much similar to what happened in Japan in 1965 to 1989, where Japanese economy went through a significant transformation. 1945, Japan was kind of broken, and 20 years it took to repair, but 65 to 89, Japan had what we call Japanese economic miracle. In that, significant multiple expansion happened, right? At the peak of the market in 1989, Japan as a single largest market was, as a world market cap, Japan's market cap as a percentage of the world market cap was 43%. Nikkei peaked at the PE of 60 times. Okay. So I am not saying whether Nifty will go to 60 times PE, but point I'm trying to make is whenever any economy goes through a transformative phase, and it is one of the only story around the town, if you see globally, there are very few markets where you can see a sustainability of the growth, sustainability of a structural growth for a very long period of time. More money chases that market and it gets re-rated. So in my opinion, I would dare say that I don't know whether it will happen next 2 years, 3 years, 5, I don't know that, but we will see a significant multiple expansion of the markets from here. It could be 35, it could be 40, I don't know, that's anybody's guess. But I see a significant expansion happening from here based on these logics.
Oh, so lovely. I think, so what Mr. Jan said, he qualified it a little bit, but Mr. Khemani has given almost a clean chit, saying that sustainability is a big issue, risk premium coming down is a big issue. So therefore, India's market premium is not just justified, but actually he sees an upside to it going forward for the sustainability factor, for the future growth, and is one of the biggest, potentially the biggest markets that he sees in terms of premium. Mr. Singhania, given the two have slightly differed, not substantially, but in nuancing, I would say, what would be your take? Will you take this perception to a different level, or do you want to sort of strike a middle path? Mr. Singhania.
Thank you for having me. So while I'll more or less concur with my two friends who are on the dais with me, see a few things. One is only P cannot be an indicator whether something is expensive or cheap. Otherwise, you don't need any of us. You can every day calculate P and then buy or sell. You don't need fund managers, you don't need anything else. So P in isolation cannot be the only factor. Yes, it is important. And as value conscious investors, obviously it's a important, I would say, one of the factors which you have to consider. But if I look at my own professional journey, and I've been reasonably successful, but the biggest mistakes I have made in life is not buying stocks just because they looked little expensive in the very near term. I think jo acha hai na, wo mehenga hi hoga. There are so many beautiful ladies in the crowd. All of you all have bags, right? Now some bags are 5,000, some bags are 5 lakh. Now if you just go by the PE multiple, then LV bag should not be sold at all. So jo acha hota hai na, wo mehenga hi hota hai. And I think at this point of time, India is at acha in a world where nothing else is closer to acha. And if you look at the transformation, from being almost zero in 1947 to $1 trillion in 2007 to 2 trillion in 2014 to 3 trillion in 2022 to 4 trillion in 2024-25 and maybe going to 8 trillion in 2031-32, I think there is no competition as far as that is concerned. And therefore, I think just to say that PE is expensive and therefore, this is not a market to invest, we will make the mistake which we have made for so long. The only one thing is when you are coming in equity, unfortunately, everyone has a sort of, I would say a little bit of greed that we want to make 30-40% return every year. Some want even in a weekly basis 30-40%. But most of the investors are looking at 30-40% every year. That is not going to happen forever. And I think if your return expectation, as Prashant mentioned very rightly, that if your return expectations are in line with the profit growth of the underlying companies, then there is no need to get worried at 19-20 P. And we are not like at 35-40 P where markets have gone up earlier where there was complete euphoria. And therefore, I think we are pretty comfortable. The other thing is that the nature of the economy in the market is changing dramatically. We are not in the traditional old manufacturing and asset-heavy companies whose P's were low. We are in very knowledge-based companies, in faster-growing companies, where traditionally, globally, the P multiples are higher. And therefore, looking at the way the whole country is transforming, I think it is very logical that the composition of the market, the composition of the indices will gradually change, and that will call for slightly higher P. So, while completely agreeing that we are not as cheap as we were earlier, I think returns will definitely be made. And I will repeat again, jo acha hai, wo thoda mehenga hoga hi.
But Mr. Sangania, you also said that return expectations need to be tempered a bit. I mean, does that mean that you are siding with Mr. Jain
I think
and leaving Mr. Khemani alone?
If you see the longer term returns for Indian markets, they have been around mid-teens. And that will continue. So we are not tempering the returns. We are just saying that have reasonable return. Don't come with expectations that last year we have made 30%, so even in the future we will make 30%. You will make on long-term returns. And see, ultimately when you are investing in equity, you are becoming a partner in the business. So the returns when you are a partner in the business is equal to the profit growth you make. And those are the returns we'll make. I don't think you should say that we will temper the returns or not. I would say we are only suggesting that you should be comfortable with the long-term average returns which equities give.
Okay. So, when you said that returns expectations should be tempered, I mean, what could be the downside and what could be the upside?
One is, again, I said, this word tempered is not the right word. Just saying that returns should be reasonable compared to the long-term trend. See, when you're investing in an asset class, obviously, equities, I always say, are like cardiogram. Cardiogram upar niche hota hai, we are alive. I think markets are also like that. They are always going to be up and down. Yesterday they went up, today they are down, maybe tomorrow they will be up again. That is the way the markets behave. Now, if you are wanting fixed returns with no upside and downside, then there are a lot of bankers, they will give you fixed deposits of 5, 6, 7%, where the government of India is your partner to the extent of 40%, so you'll be left with 4%. There will be no downside, no upside. If you are looking at equity returns, if your horizon is 5 years, there is no downside. If your horizon is 5 months, maybe there is some downside. If your horizon is 5 days, maybe there might be bigger downside. So the upside and downside is dependent on what your horizon is. But if you're looking at it from a 4-5 years perspective, our view is that there is no downside. You will end up making your mid-teen returns for sure.
Okay, you explained it very well. Mr. Khemani, you talked about sustainability. Can you come in on a little more about this sustainability factor? Because explain to this audience, why do you think that sustainability is such a big issue? And how do you think the sustainability factor get influenced in the marketplace? In a sense, what are the factors that an investor needs to be cautious, needs to be mindful of to assess the sustainability factor?
No, I think, see, we are talking about the country level. So, of course, whether when you invest into any country or any company for that matter, you assess that, how long this growth can sustain. And so longer the growth, higher the valuation, higher the growth, higher the valuation, right? So these are the two factors which go very well in the valuation of this, right? So at a country level, if you see, the major structural repairs have happened, right? Historically, if you see, there are 4 or 5 factors where the risks have come from in India. One, this is whenever you see our current account deficit or external account gets imbalanced, we become weak. So whether it was 1991
That's
or
right.
2012, we became part of fragile 5 because our current account deficit went to 4.5%. Right? Today, with a lot of government initiatives and all those things, current account deficit will come to around 1%, and in next 4, 5, 7 years, I think it's going to become surplus account. So that repair has happened. In 2012, when the fragile 5 happened, taper tantrums led to 20% depreciation in the currency. This time around, US has raised interest rates by 5%, but our currency is holding very well. So that repair has happened. Second risk always comes from looking at fiscal deficit. Again, we are one of the best managed fiscal deficits around the globe. Tax collections have been going up. I don't need to be, telling this audience, everybody knows about it, right? Third, whenever banking system goes into trouble, right, it has implication on the economy and corporate profitability. This time around, if you see, our banking is one of the best in the health, whether it is asset quality, ready to grow, well capitalized. Again, probably I would say the best in the world, right? So that again is solid. Fourth is inflation. Our country has managed inflation so well. I think most countries are struggling, but we have done very well on that. And lastly, our corporate debt to GDP or debt to GDP or household debt to GDP.
That's
Again,
also
we are one of the, very, very solid. So if you see, our 5 structural points which have historically brought volatility to the corporates earning or markets are right now in a pink of the health. And hence it looks like that over next, and thanks to a lot of initiatives, reforms being done by the government. So that looks like that over next 5, 7, 10 years, these are going to carry us out in terms of having a sustainable corporate profit growth. And other way to think about it, just think about it. Like I said, in 2008, our corporate profit to GDP peaked at around 7.5%, right? Yeah. That time we didn't have GST, we didn't have a lot of formalization of the economy. I think this time around it can go further higher than that. It could be 9%, 10%, anybody's guess. So if you were just, let's say by 2035, if our economy is expected to be $10 trillion, and take a number of 9%, 10%, whatever, our corporate profits would be around $1 trillion. And even if you take a moderate PE of 20-25 times, our market cap will be $20 to $25 trillion. And today we are at $5 trillion. So that tells you the kind of extent of opportunity ahead of us, 5 to 25 over next 10, 12 years, right? Which other market can offer this kind of growth in the corporate profitability, which is today around $180, $190 billion, to, so $5 trillion to $25 trillion. I don't think any market in the world has this kind of potential to offer. And that is what I mean by sustainability, and that is what I also believe, that more and more people figure out India. Ultimately, valuation is also a function of 2 things, earnings growth and liquidity. Earnings growth is solid, and more people figure out India. We will see international flows also coming to India, and that will re-rate India's story further. And we have seen many such examples in the past, in different countries which has happened. So I do believe that sustainability always drives more valuation, and that is my key hypothesis.
Wonderful. Thank you very much for this detailed explanation on the sustainability issue, which sort of cleared up many of the doubts. And, Mr. Jain, let me come to you. Mr. Khemani talked about sustainability and largely used what I would call the macroeconomic numbers and the macroeconomic variables. Are there any worries, any concerns that you see in the micro side? Are there any trends that worry you? Macroeconomists often talk about demand being uneven. Macroeconomists often say that probably this is an unequal growth, so therefore, so these micro developments, could they be a kind of a dampener, or should people be little mindful? And the point that you mentioned about how the scope for an upside in the premium is limited, is that something to do with that, or is there something more that you see beyond the micro side?
No, I think, in my opinion, India's growth is sustainable. And as Vikas rightly mentioned, India's current account, fiscal, corporate leverage, and banking NPAs are in extremely good situation. However, the household debt to GDP is not so low. And we are seeing a increase in the NPAs of the small ticket retail loans. Last few years, I think consumption has been supported through EMIs and through rising household leverage. So I would say that the growth in consumption should be moderate compared to expectations. And I am not surprised because the household leverage has indeed gone up. I think the lower inflation is great, but it also means lower growth in rupee terms, and that is why the cost of capital has come down. So GST revenues are now growing around 9% a year. And I don't think they will grow too much, because the catch up from less formalization to formalization has probably happened to a large extent in the last couple of years. So I would expect, and I could be wrong here, and I'd be happy to be wrong here, I don't think the corporate profits to GDP, what India touched pre-Lehman around 7%, is going to be crossed in a hurry. Because most sectors are enjoying fairly healthy levels of profitability. And we have seen even in the last quarter results that virtually no companies have expanded margins. So, and we are not like US, where you have tech innovation driven businesses. So I would say our businesses are more linear in that sense, and upside to margins, to my mind, is quite limited. So I would again go back to the same point that corporate profits, in my best judgment, should grow around 12% CAGR. And I think that is what is the likely return from Nifty over longer periods. I think one additional point what an equity investor should keep in mind is that yes, while India is in focus and a lot of capital is likely to come India's way, both from local sources and global sources, the supply of stock is even larger.
Okay.
So these high multiples are leading to significant dilution. I mean, look at the IPO pipeline, look at the $1 billion plus issues, that is very large. So I would say this demand for equities is more than demand, it is matched by supply. And I think this supply will keep on rising, because entrepreneurs would want to raise more and more capital if you offer them, if you allow them to dilute at expensive valuations. So I would somehow not agree with this narrative that India's PE multiples can go up. I mean, they may go up, but I don't think they will sustain. Yes, it has happened in many other countries. Even in India, it has happened in the past. PE multiples have reached higher levels, but the key is, will they hold on to will it lead to sustainable creation of wealth? I think those multiples may not hold. So I would again agree that, suggest 12% CAGR to Nifty is reasonable to my mind. And small mid caps, I would be quite worried because I see a lot of excesses in that space.
So is that, in other words, are you worried about the micro sector concerns?
No, I don't think there are any concerns. See, demand slowdown is temporary. It will come back. You grow slower for 1 year and your leverage is fixed in retail home loans, and again you will grow. So I think 6-7% growth longer term in economy is doable. I don't think there are concerns. These concerns of, and you can see the retail loan growth has slowed down sharply post the steps taken by RBI. It is growing out, I think, around 13-14%.
Absolutely.
So I would not worry, but I think the key is to have realistic expectations from these markets in my judgment.
So, and also a very interesting point Mr. Jain raised was that the limited scope for further formalization. In a sense, it has already reached a point where further formalization benefits would be limited. Did I get you right?
See, I don't know. The exact answer is very difficult, but I would assume if you look at the top line growth of companies this year, if you look at the margin expansion, then you are not seeing them growing ahead of the nominal GDP growth. So there is no reason why they should not have grown faster if formalization was further taking place. So I would give lot of weight to the data what we are seeing currently. After all, why are profits not growing in the current year rapidly? If everything is so good, then you should have grown 15-20%, but that's not the outcome.
Okay, Mr. Khemani and Mr. Singhania, I will come to both of you on this issue. Would you like to add to this the perspective that Mr. Jain gave on a slightly nuanced assessment that he gave? Actually it has become even more nuanced from his earlier, the preliminary statement that he made. Would you like to come in on that, and would you agree or disagree or add to his assessment?
No, I think, see, I completely agree on the point that you should always invest with a low expectation, right?
Yeah.
There's no doubt. Because especially when the years when you have a great return, it is very natural to have high expectation, and then if you raise your expectation, you start taking more risk and stuff like that. But I would probably still slightly,
you are more bullish.
I am more bullish. I am, of course, and probably my sense is that what Prashant's view is little bit more near term or medium term. I am more coming from a long term perspective, because when we are investing into equity, I think we look at 8-10 year perspective. And I have a reasonably, I believe that as India is more and more formalizing, today the work which is happening in MSME, which I think a lot of people, according to me, are misunderstanding. In India, MSME is growing really, really well. And as I see, as this scale up in times to come, more and more formalization will happen, and a lot of formalization has already happened and is underway. And interestingly, what is happening, historically, India did not have manufacturing as a very big base. Today, manufacturing is going to be very big base for India in the times to come.
But it is still very low in terms of GDP.
But think,
so there is an upside, I agree.
It is 16% of GDP today, roughly about $500-600 billion. But this number, let's say if you look at target is around 24-25%. Now that number from $500-600 billion going to $2-2.5 trillion is a massive jump. And when this kind of things happen, you obviously have significant contribution coming towards sort of corporate profitability. So again, jury will be out, and we all see directionally we are all saying same thing, right? Whether it is 12% or 15%, that's the argument, and that I think probably only time will say. It's not. I think what we are saying is structurally India has got repaired. There are lots of positive India. There's no other market like India in the world. Keep low expectations. If you target 12% and 18%, nobody will be complaining. But if you target 18% and 12% comes, then I think there's disappointment, right? So it's always good to do that, and stick to basics principle, avoid excessive valuation, avoid fads. That's the, I think, point we are making.
Mr. Singhania, your take on it?
So I'll just put forward in a little bit of a different way. So I think, see, post-COVID, you had a couple of years of super growth. And I think last 1 year, maybe people realized that they have bought more of everything. So a little bit of held back is there in terms of spending, which we are clearly seeing in the first 6 months. Second is a lot of prices have fallen. And therefore, value growth to that extent has got impacted. So if you see a lot of companies, they say that, they have grown in volume terms maybe 7-8%, but value growth is almost zero because prices have corrected. So that is the second thing. Third is our view is that because it was an election year and because there has been a little bit of climatic change, we had a very aggressive summer, and then, the monsoons sort of dragged for maybe 15-20 days more. I think everything has got back-ended. So the proof of whether we should be super bullish, or reasonably bullish will be in the results which come out in December and March, because that will actually indicate whether this consumption slowdown is for real or whether there will be...
so till that time, the jury is still out.
Sir, we are always optimistic, and people who have been optimistic in India last 25 years have had good smiles, good health and good wealth. So if you want good health and good wealth, you have to be optimistic on India. But coming structurally, I think India is a young economy. We are, almost like 30 years of median age, and therefore there is no reason for us to believe that the natural growth in India will be 6-7% real and maybe 10% nominal. And I think that is a base level growth of companies' profit. Maybe if you add some efficiency and our little bit of skill in picking some companies, we can inch up to maybe, mid-teen kind of returns. But two things will change this for the positive. One is we are still dependent a lot on many products which are imported. And this whole move towards Make in India and supporting India, electronics is a very, very key indicator. So I think with the same GDP, just import substitution can add a little bit of growth. And second would be the export opportunity. Right now, last 2, 3, 4 years, the world economy is going through a very rough patch, particularly Europe. Even US has not been growing that much. And now with this whole rhetoric of China +1, again resurging with the change in guard in US, it is possible that a lot of Indian products and a lot of Indian companies will be able to make or take advantage of the export opportunity. And it is possible that 1-2% growth also is because of the export opportunity which Indian companies are able to extract. So while agreeing with Prashant that the base level 11-12% growth looks likely, maybe these two things, which is import substitution and some exports, might inch it up to maybe a 14-15%. And see whether the market gives return of 12 or 15 or 20, or whether the PE is 15 or 20 or 25, none of us can say for sure.
Sure.
Ultimately, beauty is in the eye of the beholder. आपको ये बॉटल 10 रुपए में अच्छी लगती है, मुझे 20 में अच्छी लगती है, किसी और को 50 में अच्छी लगती है. Abhi, at least for the next 3, 4, 5 years, P can be 30, P can be even 5. We have seen times when P's have become 8 and 9 also. So I think it's not only about India particularly, but also how the world sort of behaves, what are the equations which come in. It's a volatile world, we have to accept that.
Sure.
There are 40 odd small conflicts and wars going on in the world. Something might blow up at some point of time for the negative. On the other hand, the world has not been growing. Suddenly, if growth comes back, you might have an uptick. So I think there are a lot of factors which determine this P. We can only assess what the profit growth can be.
Fair enough. Fair enough.
The best thing to do is expect a reasonable return. ज़्यादा आएगा तो कोई वापस नहीं करने वाला है. You enjoy that, but expect a reasonable return. I think that is the best way of going ahead as far as your long-term investment is concerned.
Okay, thank you. No, I think we have managed to guide ourselves into a further discussion on the external sector, and you were hinting at that, and we have reached a very interesting stage, and we will come to the audience for some questions from the floor. But I wanted to finish this external sector bit, and maybe I will ask Mr. Khemani that, Mr. Singhania talked about West Asia. I will add to that what is happening in Europe. There is a US regime change. So how do all these factors, and as he rightly pointed out, there are 40 incidents, conflicts, small conflicts across the world. In this kind of a situation, how can you probably be as bullish? Because uncertainty is very large. So, so would you like to respond to the external sector uncertainties and how we should really deal with it from the enjoying the market thing?
I got it. So, sir, I think in my 25, 30 years of career, I don't know any period when there's no uncertainty around, right? Let us look at in last 20 years. You know, we have had 2002, I remember Nifty was 800 points. Today we are 25,000, right? In this period, we had multiple government changes, UPA 1, UPA 2, NDA. We had 2008 financial crisis, 3G scam, coal scam, Fragile 5, demonetization, GST, you know, Ukraine war, Israel war, pandemic. You can think of crises which would have happened, could have come. So uncertainty is the nature of the, you know, this thing, right?
The bad animal.
Always will be there, right? And despite all these uncertainties, India has delivered 15-16% CAGR return over a 20 years period, being the best performing market around the globe. So uncertainty is going to be there. So if you are worried about intermittent volatility, you should not be equity investor. But if you look at longer the horizon, lower the risk, as Sunil was saying earlier, right? So currently also, let's say we have been going through the war for last 1.5 years. Why it has not impacted, you know? Simply, historically, wars impacted economies only for one reason, nothing else. Because other than that, no other reason, oil prices, right? War happens, oil price go up and, you know, we start panting. This time around, thanks to our government's bold move of importing oil from Russia, oil price didn't go up. And as a result of that, it didn't impact anybody. But if we, let's say, didn't decide to import oil from Russia, we would also probably be in a different situation. So I think oil price, which is one of the critical factor, is very, very, so hence today ongoing conflict. In general, war is good for business because you need rebuild a lot of things and, you know, that happens. And I do believe that with Trump coming in, probably the geopolitical tension will go down. Now, I'm not an expert, but whatever little I understand based on his comments and all those things. So having said that, I think what works for India, and again, the thing we were saying that structurally we are very solid, right? But risk will come. So the analogy I like to give is that if my vitals of my body are strong, which is the 5 factors I said, viral attacks will happen. If viral attack happens, I will be down for 2 days with fever, but I won't be in ICU, I won't go down. Same way, our vitals of our economies are strong. These externalities might bring, little bit of volatility in the market, but eventually will come back. We had SVB crisis, Silicon Valley crisis, we had Ukraine war. Markets react and then come back because our vitals of the economies are strong, our structural growth is strong, our drivers of the stock growth are very strong. So I think that is the perspective every investor should keep in mind. Whenever there is a little bit of crisis, risk comes. And by the way, risk always comes from, if you ask me what are the risks, I can give very intelligent sounding answer. But risk always comes from sources you don't expect, and it always comes when you don't expect. Unpredictable. I mean, it's nice to predict, but it is unpredictable, right? So all you can do is prepare it through the quality of the portfolio, quality of your investments you do, and then live through the volatility as and when it comes, and keep the horizon long. That is the at least perspective I have.
Okay, Mr. Jan, before you throw it open to the audience, your perspective on how serious is the external sector challenge? Mr. Khemani is suggesting, and justifiably, that uncertainties have always been a factor to be considered. So, do you think that the current spate of uncertainties arising from these conflicts should worry an investor in terms of India premium?
No, I think I agree with what Vikas said, that there have always been external challenges of some sort or the other, and they have seldom impacted India's economic growth, except when oil prices spiked up. And fortunately, this time oil is quite reasonable. So I don't expect the economy to suffer. India has structural growth drivers, and this growth should sustain. In the past, our markets have suffered around crises like 9/11, Lehman, tapering, COVID. I think this time around the impact on markets should be much lower, because this time around the domestic flows are very structural. And we have seen the clear evolution of the domestic investor. In 22 and last month, these periods saw massive selling by FIIs, but the local flows are quite structural. So I think the impact on markets this time around should be even lower. And that is visible if you look at the last 20-year plot of India's volatility, it is structurally on the way lower.
Okay, wonderful. Let's have some questions from the floor. Please go ahead. Please identify yourself and ask a question if you don't mind. Yeah.
Sir, this is Shweta Singhal from Millennium Mams. It's a non-profit for women empowerment. The question is for Mr. Jain. Sir, you mentioned about consumption will be in moderate, to expect consumption to be moderate. Could you elaborate on that? Why do you feel so?
Mr. Jain.
Madam, all I said is that the consumption last few years has been supported by rising household leverage, small ticket loans, not the home loans. So when you are growing ahead of your income growth, supported by EMIs or whatever loans, there is a limit to how much leverage you can run, and a stage comes when that leverage becomes unsustainable, and there will be a correction phase. So I am not saying that consumption will not grow in India. It should certainly grow, right? It should grow faster for consumer discretionary products and less for staples. But in the near term, as you can see in the growth of small personal loans, that's slowing down very sharply. Central Bank has been writing about it. So I think consumption will grow, but we should not expect it to grow at a rapid pace.
Okay.
And see, 6, 7, 8% growth longer term in real terms is a very healthy rate of growth.
Thank you.
Any other questions? Yeah, please. Please identify yourself.
Hi, I'm Sameer Agrawal. I'm an investment banker by profession.
Sure.
A question to panel members. We have seen in last budget, government tinkered around with the taxation rates on stock market returns, capital, short-term, long-term. How do you foresee this as you all run a large PMS? How does it impact investor sentiment, short-term, long-term? And is it good to tinker around with rates, or is it better to have a steady state so that people are aware that what kind of returns they're going to generate?
Mr. Kamani, you have a chance to criticize the government now.
Well, all of us want zero tax, but fact is that that's not going to happen. We had a zero tax earlier. It came 10%, then became 15%. So I think if we are making money, we should pay tax. I have no reason to believe that why should we not pay tax, because we have to contribute back to the economy. Of course, to create culture of equity, government supported for a very long period of time equity culture, which I think has worked very well. So I think now ideally I want 10%, 15%, right? Ideally, if you ask me, I don't want the tinkering around to be happening. But I'm saying government has its own approach and policies, and only thing I would say, make it simple. What is this long-term, short-term? Just have one rate and finish it off. Whether it is 12%, 15%, take one rate and just say finish it off, and then continue that for a very long period of time is what I would say. But my core philosophy has always been, भाई मधुमक्खी शायद है तो मधुमक्खी आएंगी. अगर पैसा बनेगा तो हम लोग सब आएंगे मार्केट में. पैसा नहीं है तो as long as markets are giving returns, all of us will invest, whether tax is 15%, 20%. Now post-tax return across all asset classes will determine like we have seen why money is not going to bank deposits, because post-tax return doesn't make sense to deposit. So that government is discouraging, according to me. If you ask me, ideally I would want government to encourage that part as well, because this is also creating a lot of delusive flows towards equity market. The balance of both is required, and my expectation was that government probably would give some incentives to the fixed income so that the post-tax return doesn't become abysmally low.
Yeah, I'm sure the finance minister is listening to you, Mr. Kamani, and this is being webcast live. So please, next question.
Hi, this is Yasir Pitalwala. Sunil, you mentioned that essentially equity investors are partners in the business. Now, when we are seeing stake sales by the majority owners, it's not dilution to raise capital. What is it that the controlling shareholders know that minority shareholders don't know?
See, I think there are many considerations which go when any shareholder, whether majority or minority, decides to invest or disinvest. I think there are companies where maybe, there is not the next generation which is interested in the business. I think that is motivation. There are a lot of times the price offered is so exciting in the near term that you end up selling. And I always give this example, at least I have grown up drinking Thumbs Up. And that company was sold at 300 crores. At that point of time, 300 crores was a huge sum. Today, Varun Beverages is what, 2 lakh, 2.5 lakh crore without its own brands. So, sometimes the price offered in the near term is so mouth-watering. See, ultimately we are human beings, boss. भगवान ने हमको सब कुछ दिया है, but और भी गुण दिए हैं ना, लालच और ये और वो सब तो कभी-कभी हो जाता है वो. Obviously, you know, this huge selling by promoters and you know, majority shareholders is a little bit disturbing. And frankly, I am a little bit put off by foreign companies coming and dumping their stake here. So car company came in, the Indian government had offered them land at 1 rupee. अभी उन्होंने यहाँ फैक्ट्री लगाया, बोरो भी हमारे पैसे से किया, बेचा भी गाड़ी हमको, and they have taken $3 billion away from this country. But you know, we are in a connected world. We can't say we will not allow this, we will not allow this. नहीं तो P जो 20 का है वो 10 हो जाएगा. So I think we have to live sometimes with this. As an investor, आपको तो choice है ना, 6,000 company listed है. If you are not happy with someone selling stake, don't buy their company. There are so many others. But we have to accept that in a world, everything is not ideal and everything has a different reason. And we should not even go into that reason. We should just be ourselves in terms of determining whether we want to invest or not.
Okay, we are running out of time, so I think we will take that question. Yeah, please.
Hi, sir. This is Balram here. I have a small question. We have been talking about this equity market. Is it in a bubble phase or is it the premium justified? Also, we do hear that Warren Buffett, he is also sitting on $235 billion, and also here.
Yeah, come to your question, please.
Yeah, AMCs are sitting on cash. So, is it the right time for the retail investors to sit for some time and look at the market, then enter? Thank you.
It's advice on what he should do with his money. I'm sure he's sitting on some money. So,
my view is, boss, and I think you can add that पैसा कब invest करना है जब आपके पास हो. Because ultimately, if you have a long-term 5, 10, 15 years horizon, like all of us said that India is one of the best growth market. You can't compare with US and take decisions on India, right? US as a percentage of world GDP, US market cap as a percentage of world market cap right now is 62%. India is at 3%. So I think US consideration and India considerations are very different. And I mean, if you are a long-term investor, you can invest any time, don't worry.
okay, we'll come to the end of it, but you know, I had 3 quick fire questions to each of you, one each. And you have to give a very quick, short answer. To Mr. Jain, sectors you must avoid.
I would be cautious on small and mid caps in general, not in individual companies, but in general I would be cautious.
Okay, Mr. Khemani, do you believe there is froth in the small and the mid cap segment?
Depends on what you're looking for. There are definitely pockets of excesses. There's no doubt about it, and you know, one should avoid them. But in small and mid cap also, there are extremely great companies right now, which we are invested fully, I can tell you, in small and mid cap, and where we have confidence that they will become, you know, bigger from here.
Okay.
So it's the pockets you have to identify. Don't invest in the fads, and don't invest out of FOMO is what we say.
Mr. Singhani, my final question. Is there any domestic issue that worries you?
See, issues will always
Domestic issue.
Yeah, issues will always be there. But at least on the macroeconomic front, I don't think there are any issues which worry.
Non-macroeconomic front?
That will always be there, you know.
Okay.
Yeah,
okay.
but you know,
Okay,
because we are in the midst of conflicts across. So, but you know, it's like a sigma 8, sigma 10, sigma event.
Okay. I think we had a lovely interaction, and the market gurus were not just playing the role of a market guru, but they were frank, they were open, they took all your questions, and with the clarity, with the frankness that I think few market gurus show. Once again, thank you very much, Mr. Jain, Mr. Khemani, Mr. Singhania, for being there. I hand it over to Ridhima.
All right, thank you so much, panel members. Can I request Mr. A.K. Bhattacharya to present our panel members with memento? I think again a very riveting and invigorating conversation. Big takeaways that no other market offers sustainability and confidence in growth as India. As India gets more and more prepared, our corporate profit to GDP will keep on contributing higher and higher and move towards 8 to 9%. The expectations of returns should always be reasonable and comparable to long-term needs. Ladies and gentlemen, we are going to convene back in this hall at sharp 2:25 p.m. because at 2:30 p.m. we'll have the address by respected Deputy Governor at RBI, Mr. T. Ravi Shankar. So I request you all to convene back at sharp 2:25 p.m. And I hope you all have received your event passport, get maximum stamps from the different exhibit booths, and get an opportunity to win something exciting. ये मैं 20 small हो गया Biggest BFSI summit called the BFSI Insight Summit, where market leaders, thought leaders, influencers, policymakers, decision makers from the world of BFSI share their perspectives and outlook that has tremendous potential to actually shape the future of BFSI. At this point, I'd also like to reinforce the fact that we're also celebrating 50 years of business standard in existence, 50 years of sharing an opinion that actually shapes opinions of others, 50 years of steering conversations that shape the world of finance, 50 years of converting news into economic intelligence, and 50 years of substance over sensation. Ladies and gentlemen, coming up next, we are joined by the company of a leader, and we're very privileged and honored to be here with the fact that he's here with us today. At this point, I'd like to call on stage our Honorable Deputy Governor of RBI, Mr. T. Ravi Shankar. Sir, if you could please make your way to the dais and join us. He's known for his decisive insights and strategic thinking. He offers a rare view from within the RBI on evolving priorities that impact every corner of India's economy. And to actually render introductory remarks for his address and set the context further, I would like to call on stage Mr. Shailesh Dobhal, editor at Business Standard.
Thank you, Ridhima, and good afternoon, everybody. On behalf of Business Standard, let me extend a very warm welcome to the Reserve Bank of India Deputy Governor, Mr. T. Ravi Shankar, on the second day of the Business Standard BFSI Insight Summit 2024. Mr. Shankar is an MPhil in economics from the Jawaharlal Nehru University. He was appointed as Deputy Governor of the Reserve Bank of India in May 2021. Mr. Shankar is a career central banker, and he joined RBI in 1990 and has worked in various positions. Before his elevation to the Deputy Governor, he served as Executive Director, overseeing the Department of Payments and Settlement Systems, Information Technology, FinTech, and Risk Monitoring. In these roles, he contributed significantly to strengthening India's financial system infrastructure, particularly in areas related to digital payments, technology, and risk management. Mr. Shankar's expertise extends beyond RBI. He's worked as consultant for the International Monetary Fund from 2005 to 11, focusing on developing government bond market and the debt management strategy. Additionally, he is the chairman of Indian Financial Technology and Allied Services and serves on the board of directors of Reserve Bank Information Technology and Governing Council of Institute of Development and Research in Banking Technology. Known for his in-depth understanding of financial markets, Mr. Shankar has managed areas such as exchange rates, reserve portfolios, and public debt management. His role at the central bank has also included contributions to monetary operations and the development, regulation, and oversight of financial markets. Many thanks, Mr. Shankar, for joining us today at the BFSI Summit. May I please request my colleague, Tamal Bandyopadhyay, to please start the fireside chat with the Deputy Governor. Over to you, Tamal. Thank you.
Good afternoon. Just 15 minutes back, I went down to receive him at the lobby. So he greeted him saying that, "Here is my torturer." A.K. Bhattacharya, AKB, who's the super boss of Business Standard. He says, no, he's not a torturer, he will go through inquisition. So it's neither torture nor inquisition. We'll have a very frank chat.
Thank you, that's relieving.
And actually, they set the context over a cup of green tea. You are discussing Kafka, Camus, Sartre, myth of Sisyphus, James Bond film, etc., etc. In fact, I forgot what to ask you. So relax and nothing, no torture, no inquisition. The first thing is obvious. I think everybody would like to know that Donald Trump, in market, some dealers call it dollar Trump. You have seen how the dollar rose yesterday versus any other currencies. Dollar index rose and all. a rupee hit a new low. So tell us, what would be on the financial sector, currency, kind of impact you see on Trump coming to US presidency?
Firstly, of course, there would be short-term volatility in most markets because we are seeing a change in government in what is the largest economy in the world and what is the most powerful country in the world. It is going to have some impact. But if you move away from short-term volatility, which we are already seeing in terms of the dollar index rising or the US stocks doing very well or the US interest rates rising and all that, if we go beyond that, I think eventually the impact will depend a lot on the shape that US involvement takes in terms of global tariffs, because in the run-up to the elections, there were a lot of discussions on those. In terms of what how US manages its fisc, because there is expectations that there would be tax cuts, there would be expenditure increases. So if US debt goes up, what impact it has on global bond markets, it depends on that. It depends also on how US engagement with the geopolitical issues pans out going forward. So it depends on all of these things. So it's very difficult to say how things will work out or how it will impact the financial market in the medium term. But I think what we can say is, from the point of view of India, that as far as impact on the exchange rate is concerned, I think we are well equipped to handle or tackle any impact on the exchange. We'd be able to manage any excessive volatility in the exchange rate in terms of our reserves and in terms of the health of our banking system, in terms of the health of the economy. We are well placed there. Impact on interest rate markets here, if there are there's an increase in issuance of US debt, that could raise to an increased interest rates, which could affect us as well. But I think with index flows coming in, half of it is gone, another half is coming over the next 5 months. India is going to get included in the FTSE Russell as well. And I would expect that in time in the Bloomberg index. I think even that volatility we should be able to manage.
Mm-hmm. I was just hoping, like Dr. Reddy's famous October 1997 talk on rupee, you'd say something and there'll be impact on market, but you're very diplomatic, you don't want to say. So let's talk about something which is very close to your heart, and UPI. It's an amazing thing that India has done, and in the world there's no comparison. Anywhere else in the developed market we have this kind of payment system. So tell me, what next to UPI?
What next for UPI?
Yeah.
As you yourself said, it is an instrument. It is a payment instrument that has caught the world's attention in terms of the efficiency with which digital transactions happen, in terms of how it is catching on among our retail and business users. The number of UPI transactions every month are going up. I think the latest number is some 53.5 crores per day now in terms of UPI transactions. That's huge. So what we have to ensure in terms of UPI is that this should continue, this level of growth should continue. It should get into areas of the economy. It should be used by those sections of the population where it is currently not being used, so that not only will payments become better for these sections, but also our economy's efficiency will grow. So from that point of view, we'll have to ensure that UPI can be used, even in offline modes, even for temporary purposes. We'll have to look at UPI being used for by people who have feature phones. But particularly important is that the benefits that we are seeing for UPI in the domestic space, we should be able to see that transfer itself to the global space. We have already started, our efforts in terms of linking to other countries, Singapore, Mauritius, and so many other countries. We should try and get that use across the world, so that any Indian with a UPI account, wherever he or she goes to the world, should be able to make a payment using UPI. There are discussions at this stage with various large and advanced economies. I'm just hoping that those things pan out and this thing becomes a reality.
There are two questions on that. With the increasing, the rise in the use of UPI, do you think that the currency in circulation actually will go down? Are you seeing any signs? We have not seen any signs of that. So that's one part. And second is, we understand that there are too many frauds are happening. They're not reported, they're not in public domain because the amount is small. It's not, people are not losing 50 crore, 100 crore, but people are losing 5,000, 10,000 rupees, etc. And it's pretty frequent. In millions of cases, I hear that. It's not reported. So is there something we need to address address it at the UPI? There's certain things are there.
First on currency, impact on currency in circulation, and then on frauds.
Yeah.
No, we are not seeing the currency in circulation go down, notwithstanding a substantial increase in the rate of UPI adoption. But what we are seeing, and this is not a trend which is, for a time period which is long enough for us to draw any conclusions, definitive conclusions, but we are actually seeing that the rate of growth of notes in circulation is slower this year than it was in the earlier years, and noticeably that slower as well. So maybe something is happening there. We'll see. But the straightforward answer to your question is no. We are not seeing currency in circulation go down. Now, is it something that should be expected? At some point of time in the future, maybe, but it will probably be too simplistic to expect that as UPI goes up, usage goes up, currency in circulation could come down, because UPI is only a payment instrument. Currency in circulation is about money. You hold money not just for payment, but for various other purposes, a store of value, and as for many other reasons. So it depends on the demand schedule for money, whether the store of value demand is higher, its use for other purposes is higher. It depends on a lot of other things.
And the identity, of course. In
yes.
UPI, I am identified. Money, I am not identified.
Money. So from that point of view, I wouldn't read too much into the fact that it's not going down. To be honest, as long as UPI and digital payments keep going up, I don't think I'll spend sleepless nights if currency in circulation also keeps going up. So that's on the currency in circulation part. In terms of frauds, yes, the number of frauds, retail frauds, the absolute number is increasing, the amount involved is increasing. But just to put it in context, I'm not saying the frauds is something that we shouldn't deal with very seriously. But just to put it in context, of late we are seeing a reduction in the number of transactions per one fraud, which means the incidence of fraud is in a sense either stabilizing or probably coming down a little bit. So that's something that we need to keep in mind. There are many reasons for these frauds. Many of these frauds are because credentials are by social engineering and by carelessness maybe. The credentials get revealed to these bad actors. We have to attack this on various fronts, and the primary front is awareness. We have to keep talking, keep making people aware that be alert, be cautious. In this digital age, things can happen very quickly. So be very alert in terms of who you are sharing your passwords with and so on and so forth. What hygienic, digital hygiene measures everyone should adopt, which links you should click or not click, all these measures. We have to increase that awareness. On the other hand, we also have to develop digital power to identify these frauds even before they can happen. And that's possible. That's possible if we can have a database large enough where past trends, past use, incidences of these frauds can be studied, preferably by an AI system or something, which will be able to identify or rank the risk of some transaction being a fraudulent transaction. Now today, many individual payment system providers have it, banks, credit card companies, many of them have it. But we are looking at, and we had announced, and that work is going on, having an AI-driven database on which all these systems can be trained. For example, if you can link this database to the database of telecom operators, it's very easy for a system to identify that if this is the number from which a fraudulent transaction originated earlier, then the chances of it being a fraudulent transaction higher. I'm just giving you a simple example. So it is possible to leverage digital technology and the new emerging ones like AI to be able to reduce all these things. And then, finally, we have to make sure that when these frauds happen, after these frauds happen, if we can recover, how quickly can we recover? So there are various ways of doing that. Many of those things are under discussion internally. I wouldn't like to discuss them right now. But that is another way of reducing the incentive to do a fraud if the fraudster cannot get away that easily. Thank you.
Yeah, I had some follow-up questions, but before that, since you raised about AI, use of AI and all. In a very recent speech, Governor spoke about how the AI and ML could pose very serious risks to the financial sector stability. And what can you just explain this? What is the concern?
Governor obviously, had his own thinking, but I think what he might have meant is that this artificial intelligence technology, I think almost everyone globally agrees now.
And machine learning.
Machine learning, AI, ML, and machine learning, deep learning, and all of these technologies are unlike any technology that we have seen in the past. In many ways, but primarily in terms of two aspects. I will try and put it in my own way, the way I have understood. One is that unlike when electricity came in, it took decades before electricity was adopted completely in the system. Printing, when it came in, it probably took centuries before printing became common everywhere. And these were transformative technologies in our history. The thing about artificial intelligence is that it gets adopted at such a fast rate in the system that it does not give the economy or the society adequate time to adjust to the new technology, adjust your systems to the new technology, adjust your cultures to the new technology. In that sense, this technology is very different. The other way it is very different is that most other technologies reduced human effort, in one way or another. This is a technology that has the potential to completely replace human involvement. It's possible to imagine an AI which writes a program for another AI, things of that sort. So in this sense, they are very different. While the benefits are immense, no one is questioning that. You can imagine anyone can write a program which will defeat the world chess champion or something. So benefits are immense. Benefits in terms of financial system, in terms of fraud prevention, in terms of customer service, in terms of investment advice are huge. at the same time, we have to be very careful of what other impact this technology can have at a systemic level, at an institutional level. So that is those are the things that we have to be careful about. Almost all AI systems are trained on data sets. Every data set will have its own bias. Now the AI system might pick up those biases, and if you tend to trust them too much, you will be perpetuating those biases, whatever those biases are. One specific thing about AI, and the first AI system that showed the possibility of how good AIs can be, is when a system defeated the world champion, in the game Go, right?
Yes.
You might have heard of that, I think Move 37 or something, which was the turning point for AI. So the point is that not only did the AI engine generate that move, none of the experts sitting around could understand how it could have arrived at that move. That brings us to a crucial aspect of AI, explainability. So if you want to use AI and the AI engine gives you a decision, as a human being, I would find it very difficult to apply or take that decision unless I'm able to explain it. So this is something that we need to understand. There are many other issues with risks like this. I think the approach to take is be careful, take a sandbox approach to implementing AIs, implement it in a short sphere, watch it, find out how it's working, and then take it on fully. So you have to be careful about that. Maybe AI engines themselves can have programs at a top level looking for biases and correcting them. But those are technology issues. I'm no expert on that.
Okay.
But which is why, powerful as it is, we have to be careful about how we adopt AI ML technologies.
From UPI, logically I should go to CBDC and all, but before that I'm tempted to ask one question, because yesterday there was a very intense discussion here. Is RBI the right regulator? I mean, can it actually regulate the fintechs technology? Because you said it's very difficult to understand. You are 90 years old. Meaning, not you, I mean RBI I'm saying. RBI is 90 years old, and this fintech, this new technology is not even in their teens. So, I mean, do you encourage the idea that we should have a separate regulator for that? Or RBI, you have your innovation hub, you are developing yourself and learning and getting ready for it. What is the thing, if you can tell us? Because entire audience, they participated in the discussion that should there be a separate regulator for fintechs and all. There is no conclusive conclusion there, the discussion, but the discussion did happen.
Good, because I can give an answer that's not conclusive, but before I give an answer, I think I'm not that far removed from 90, so it's all right. You see, we are, a financial sector does a basic economic function of enabling payments, moving funds from the savers to the investors so that economic activity can take place smoothly. And since public money is involved in this, financial sector everywhere is regulated. So financial sector will always be regulated. As long as there is movement of funds, it will be regulated. Whether the regulator is RBI or SEBI or IRDAI or PFRDA or someone else is a matter of detail. Now, fintechs, if there are financial entities that use innovative technology or largely technology based, but there are fintechs who deal with funds. As long as they deal with funds, they will be regulated just like a normal, if they are in the space of lending, RBI will regulate. If they are in the space of mutual funds, SEBI will regulate, and so on and so forth. So as long as they are part of the financial system, they will all be regulated. Therefore, I think when you ask the question, you basically have in mind those fintechs which are not handling funds, because then they would be regulated anyway as intermediaries, not handling funds. Now, that is purely technology. Now there, our approach has been, fairly straightforward. Since they are not handling funds, we don't want to directly regulate them. I don't think any financial regulator would want to directly regulate them. At the same time, because they provide services to financial sector entities, and the innovations they do, the services they provide are, becoming of more and more importance in the financial sector. Now think of third-party app providers, in UPI space. In a sense, they don't handle funds, so they're not directly regulated by us, but they play a huge role in the way payments happen. So when, when the role that fintechs play in the system becomes more and more, I think every regulator will have to take a call on, what is the best way of ensuring that the financial sector remains well ordered and well behaved. At this stage, our approach is that it's important that people who provide services to the financial sector understand that there are certain rules of behavior in the financial sector. So it is probably a good idea if this understanding comes from within. So self-regulation is probably the best way to go about it. I have clearly seen over the last 2 to 3 years, in the way they behave and in the way the fintech sector is coming up, that their appreciation of legal or regulatory requirements is clearly far better than what it was 2 years back. So in a sense, that process is going on. The sector itself is learning. We are conveying, we are engaging with them through RBI Innovation Hub and directly. They are engaging a lot more with us from the fintech sector. So, and once we have started this SRO, this engagement will only become stronger. So I think for the moment that should be good enough to meet our basic objectives, which is that innovation must happen. We must, under no circumstance, stifle innovation. Innovation should have the incentives required for it to thrive. But at the same time, there should be an ordered marketplace or in the financial space.
Yeah, you already approved the first SRO for that segment. You are also in the process of setting up an institution in Delhi, I think, to approve the white leveling the loan apps, right? Those who can actually get and lend us, they need to have a sort of approval. Is that correct?
I'm not directly dealing with it, but there is there is some discussion going on that from our regulatory divisions.
Okay. Going back to the UPI and the next stage, not the next stage, but the parallel thing is the CBDC. Yesterday we discussed with Governor also. For UPI, there's a very smooth takeoff and there's no looking back. But CBDC, we kept on hearing. Governor said that there's some pilot project is on, we are waiting for that and all. So can you just give us a sense, because you are hands-on there, what's happening there?
No, I think I heard what the governor spoke yesterday. I think it was quite clear that, that impression is not very justified. You see, there is a reason we introduced CBDC as a pilot. And there are in fact more than one reason. Primarily because we wanted to see how the technology pans out, which technology is best for introducing CBDC. We have no global benchmark to go with in terms of CBDC. So the technology, the way of distributing, the how banks can be used, all these are things that we have to learn as we go. The second thing, and this is more important, is that so far in our modern economies, you had two types of money, right? You had bank money, which for a few decades now is largely digital, or you have paper money, which is currency issued by central banks. These are the only two types of money that you have. So everyone understood that currency has its specific uses, bank deposits has its specific uses. Bank deposits can be moved in large numbers across distances because it's digital. Currency, it is not possible. It is difficult. We cannot say it's not possible. At the same time, moving bank deposit, all digital payments are moving bank deposits from one place to another. Moving bank deposits would involve settlement risk and other risk, which costs money to the system. Now, imagine CBDC, which is currency, but it has become digital. It has all the advantages of digital money, and it has all the advantages of paper money, central bank money. So conceptually, there is no doubt in my mind whatsoever that it is a matter of time. This technology is going to take off in the future. But we have to be very careful because we need to understand how it will affect the current financial system you have. For example, how it will affect the use of money by people. How will it affect deposit mobilization by the banking
because
system?
I'm not getting interest on CBDC. Right?
If CBDC
if
is
I'm
currency,
keeping money in
you will not
yes,
get interest.
So why should I keep there?
Precisely.
Rather keep it in bank and use UPI.
Yes.
As simple as that.
Understood. So how will it affect credit creation in the system? If it becomes very efficient, just like bank money, which I can move through UPI or similar systems very quickly, then why should I have cash in my pocket? So the currency demand might come down. So how it affects currency demand? We understand none of those things now. We are trying to understand that. Globally, there is no example or no precedents that we can follow, which is why we are quite happy going so slow. We are quite happy continuing with the pilot scheme as it is, and try out new technologies, how it can be used offline, how it can be programmed and used. These are uses that bank money cannot be used for. We want to establish all that. I understand the impatience many people have because they have seen UPI grow.
Yes.
But UPI is merely putting a technology together. Here you are creating a new form of money.
Yes.
So we have to be a little more careful.
Yeah, quickly, I have many more questions, but we are running against of time. So with the permission of the House, a few minutes we can take, right? So just one extension is the ULI now that recently announced and all, and I understand the pilot project started, and that will have a huge impact on the credit market because it actually will substitute all the credit bureaus in some sense. Right. So can you just tell us where are we in the sense where is Reserve Bank of India and how long it will take to take off and what's the benefit of ULI quickly?
Very quickly, the Indian model of digitization has been this simple arrangement.
This is ULI is going beyond payment system, going beyond currency, actually to ensure that I am giving money to the right person. ULI will help that, right?
I'll come to that. The reason Indian model of digitization is so successful is that we have followed this particular arrangement where infrastructure is created in the public sector, whether it's Aadhaar, whether it's UPI, any of all these infrastructures. Private sector is given democratic access, equalized access to this infrastructure to innovate with products. UPI is one such example. There are many innovations on UPI. Similarly, ULI is being thought of. It is a digital public infrastructure. What we are creating is an infrastructure which will put lenders in touch with all the information they need, all the sources from which they take information, the information they require to make credit decisions. That's all it does.
Yes.
It's a system that puts, let's say, a bank on one hand with land records or GSTN data or climate data, anything, crop patterns on the other side, so that it can take a decision on whether I can give a loan to this farmer. So it just digitizes that. This infrastructure will not be created in the private sector. It can only be created in the public sector. No one will spend and it's not profit driven. Once we have the ULI system in place, It is open to everyone, and in fact, some in the private sector already have products that can be used. It's open to everyone to innovate on the system. I think the way to look at ULI is that it is another digital public infrastructure which will probably do in the lending space what UPI has done in the payment space.
Absolutely, but how long it will take? And it will change the entire contour of, say, MSME, agriculture lending primarily, right? So when do we see this, you think? How long it will take to come?
They are already happening. In fact, I don't know, about 6,
Some
7 lakh.
pilot- Yep.
But in fact, the largest loans happening on the system in the pilot mode is for personal loans, is for Kishan credit cards, is for housing loans, is for MSME loans, and so on. It's already happening. Once we, get more states into it, more banks into it, we have to get almost all banks, non-banks into it. Then, it will start off on a proper level.
Thank you, sir. One last question. This is on behalf of entire media, I'm asking you. In fact, one of my colleagues asked you this question, you are not very comfortable. It's not a torture, but I want to know, and everybody wants to know. This is the last question, is this. This is that ISMA thing I'm talking about. ISMA. This October 2022, European Securities and Market Authority, the ISMA, derecognized Clearing Corporation of India, which plays a very critical role in our clearing system, and which is the platform for entire Indian government bond trading thing, they recognize. Now, this created a problem for all the European banks trading in India and all. And why this derecognition? I'm sure most of us follow that, but if anybody else is not aware of this, this authority derecognized CCIL, which is the central platform for trading all government securities, is due to Reserve Bank of India's refusal to allow ISMA to audit and inspect CCIL. You said, no, we are not. It's our jurisdiction. And it's now 2 years, 1 month. And CCIL is the primary platform for the entire bond dealing. It is inconveniencing all the European banks and all. So can you tell us what is the status report?
Yeah, if you allow me, I will disagree.
Please, sir. Please go
If
ahead.
you allow me, I'll disagree with the way you put it, that RBI refused to allow it. The issue is simply this, I think the best way of conveying it to everyone is this.
Please,
you
sir,
have
go
2
ahead.
neighbors, right? Let's say we are neighbors. My child, goes to your house to play, right? And I tell you that since my child is going to your house to play, you have to have these following gadgets in your place to ensure the safety of my child. And not only will you have all this, I will go and inspect them periodically so that you meet those standards. What will be your reaction? Right.
The house is yours.
Yeah. So the issue is not refusing anything to anyone. The issue is that we have taken a very consistent stand that ESMA is being extra, jurisdictional in telling us how we should do regulation. We were even willing to accommodate that if they had trusted us as a regulator. They are probably constrained by their law. So the law itself is extra jurisdictional. Anyway, that discussion is going on. There is no way we can agree to that. It is not possible to agree to that without compromising on your sovereignty of policy making. There is no way anyone can agree. If other countries have agreed, I do not understand how they have. Anyway, the issue now is that the deadline 2 years back has passed. The country regulators of European banks had given them some more time till the end of October of this year. But they have come back and they said that you work for work to ensure that you adhere to ESMA requirements. As long as you give us updates and that work is progressing, we don't have any specific deadline for you. So there is no specific deadline now.
Okay, thank you. I mean, the way they clapped and even somebody whistled, so you know that the entire house is with you. So thank you. Yeah, I had many more questions, but unfortunately ran out of time already. We've exceeded by a few minutes. So, and we absolutely appreciate and stand by what you are saying on behalf of Reserve Bank of India. It's a phenomenal authority. I don't think you have too many institutions in India which can come, of the stature of 90-year-old Reserve Bank of India. Thank you, sir. Thank you. Thank you.
Thank you so much, Mr. Sankar. Can I request Mr. A.K. Bhattacharya, Editorial Director at Business Standard, to present Mr. Sankar with a memento? What an insightful discourse it has been. 53.5 crore UPI transactions per day is a gigantic growth, should grow and be used by population who are yet to use it. Look for UPI offline or UPI with feature phones and have it transfer globally. Every Indian should be able to make a UPI payment anywhere in the world, and to curtail frauds, we need to keep people aware and make them cautious, including digital hygiene methods. I think Mr. Sankar was irrefutably at his candid best. This is the power of BFSI Insight Summit, presented to you by Business Standard. Ladies and gentlemen, for all of you who are interested in understanding the different nuances of NBFC, we have a session starting in the next 2 minutes, a panel discussion in the Narayanan Vagul Hall, 2 minutes from now. So I'd request all of you who would be interested, thank you so much, sir, thank you, would be interested in knowing the facets of NBFC, you can get into the Narayanan Vagul Hall. The panel discussion will be starting in about 2 to 3 minutes from now. इसके बाद है All right, ladies and gentlemen, can I request you all to settle down? And for all of those who would be interested in knowing about NBFC, there'll be a panel starting in a few moments from now, happening at Narayanan Vagul Hall in about 2 to 3 minutes. Right here, right now, I think we are at the cusp of launching and unveiling something very important. We now turn to the much anticipated the Business Standard Everest Group BFSI Tech Report, a collaboration that unveils groundbreaking insights into the forces shaping India's economic and business landscape, specifically for the BFSI sector. This report will be actually revealing critical findings and projections that impact industries across the board. Now, to do the honors, I'd like to call on stage the following people, beginning with Mr. Shailesh Dobhal, editor at Business Standard, Mr. Ashish Sehdev, Vice President and Head Asia Pacific at Everest Group, Ms. Pranati Dave, Practice Director for the Everest Group. With data-driven insights and forward-looking analysis, this report actually offers a very thorough and intricate roadmap to the opportunities and challenges that lie ahead for India's growth story. So I think without further ado, we should be actually launching the report. Can we have the report? All right, let's give it up for this impeccable launch, the Business Standard Everest Group BFSI Tech Report. Thank you so much. I'd now request Mr. Dobhal to share a few words about his perspectives on the report with us.
Good afternoon, everybody. You know, of late, in a lot of discussions, and these are private discussion with a lot of bankers, you know, bank chiefs are asking themselves very existential questions, you know. And it's not just a matter of savers turning investors and that eroding the traditional banking's bread and butter business, which is essentially CASA, the current and saving deposits, or everything else in banking is built, you know. The BFI sector is already spending big on technology, specifically on artificial intelligence, digital banking, modernizing the back office, trying to become the digital bank 2.0. They are using technology to create products and services, engagements that were not possible in the analog world. But in their desire to stay relevant to customers, banks are embracing technology to transform at scale. In the process, they're asking themselves whether they'll become tech companies themselves, or should they at all? How will technology upend the traditional role that banks play as intermediaries and risk managers? Will the new challenge for them come from tech giants like Apple, Meta, or Amazon? What happens if Google were to be allowed a bank tomorrow? Clearly, banking is no longer limited to the domain of finance. It is increasingly becoming intertwined with technology. And already, a lot of people are speaking about a concept called Finternet, you know, that's proposed by Nandan Nilekani and the BIS's Augustin Carlston, which envisages multiple financial ecosystems interconnected with each other. This promises to revolutionize but also disrupt financial services industry as we know it today. There are many more such tech questions that the BFSI industry is dealing with. So in order to start this journey, to assess how industry is feeling about these questions, Business Standard and the Everest Group partnered this year to bring out a survey-based thought paper, which is called the Technology Advances in the Indian Banking, Financial Services and Insurance Sector, Trends, Challenges and Investment Opportunities. And we intend to continue this in subsequent years of the BFSI thing. There are lots of findings, and I'll leave it to Ashish to do the honors there. In short, to say that this paper is tracking technology adoption, maturities, BFSI sector firms, large and small. It has a special focus on generative AI, adoption maturities, how big enterprises are working with fintech companies, the FNME model, so to say. We hope you find this report useful. I'll now invite Mr. Ashish Sehdev from the Everest Group to please take you through the detailed report. Thank you. Ashish, all yours.
Okay, so thank you, Sailesh, for firstly the opportunity to partner with Business Standard for this very important piece of work, and also to have actually a dedicated half day focused on tech. I think again, great vision. As we are moving forward, we can't separate tech from the business. So I think it's a great initiative. For those who don't know Everest Group, we've been around for almost 30 years, headquartered in the US, but in India for almost 20 years. And we focus on research around tech and tech services, research with the enterprises, helping them to think through their adoption of tech and sourcing of tech, as well as work with the technology vendors and service providers, helping them with their strategies on how to serve enterprises better. So, yeah. Okay. So, I'm joined with my colleague Pranati, who will be supporting me in some parts of the section. What we'll try to do today is to cover some key aspects and perspectives that we learned from our research. The research paper is about more than 40 pages, but what we try to cover in the next 20-25 minutes is some key perspectives that would give you some snippets, and of course, we would encourage you all to get the paper and go through it, and then reach out to us if you have any comments or questions around that. So what we'll start with is what's the future of BFSI? And I think the conversation yesterday and for the most part of today has been around this shift from banking as a product to banking as a lifestyle or lifestyle orchestrator, right? So if you think of traditionally, the banks would provide more transactional, standardized services or products, whether it's your accounts or loans or credit cards and so on and so forth. But now we see the banking services being embedded into all the platforms that we use daily, whether it is our social media or e-commerce or ride-hailing apps or wherever. But it's basically embedded in what we do. What we also see is if you look at a lot of the banks also have now subscription-based models where they are where they have wellness assessments, travel rewards, or things around helping you with budgeting tools and so on and so forth that again help you to manage your finance better. So it's really this shift from the traditional products and services to more helping consumers achieve their life goals and orchestrate around the lifestyle that we live. So that's where the banking is moving, and as you see, this requires of course a fair bit of technology, whether it's APIs, microservices, cloud, data, AI, ML, and other technologies, and we'll talk about that in the later part of the presentation. But that has been made possible through the advent of technology. And a lot of examples, so if you look at SBI's, or Axis Burgundy or ICICI Mobile and Yes Robo, these are fair good illustrations of how these banks are embedding themselves into day-to-day lives of people, making sure that they have features and benefits and offerings that would talk to their preferences and talk to their behaviors and help them to achieve their life goals. So with that context, as we just look at the demand for tech globally, if we look at it, India and Asia Pac, we see has a very strong growth for tech, and this is of course fueled by a lot of things. There is digital transformation, a growing middle class, internet mobile penetration, you have inclusive government schemes, supportive regulation, and so on and so forth. So all has led to the growth in the industry and therefore the demand for tech. So great time to be in India, in Asia, if you are a tech professional, especially wanting to serve the BFSI industry. And that's, as you can see, the growth rates are fairly aggressive, much more than other parts of the world. Now, one of the things that we asked the respondents, and again, we almost interacted with more than 80 plus CIOs, CTOs, CDOs, IT heads of the BFSI firms in India. And we asked them multiple questions, and you will see that in the full report. But one of the questions we asked them upfront was, what are their strategic objectives as they move into 2025? Of course, given the growth rates of banks and also, the more recent profitability numbers, the focus on growth and margins still remains. So that's a laser focus. Everybody wants to focus on growth and optimizing costs. So no surprise there. But I think what really stood apart in the responses was three things. So one is focus on customer centricity. So all this that you see, keeping customer at the center and building the whole ecosystem around that customer. Just that we talked about, embedding finance within the various platforms that customer touches. All that is because of the focus on the customer, and I think that's great. And so everyone is thinking about the customer, trying to evolve as the customer is evolving in their journey. The other thing that stood apart was the investment in technology. And almost every bank has a deep focus on investments in technology. They understand that if they have to evolve and if they have to go into the 2.0 or a 3.0, as you may want to define it, but either ways, the technology investments are necessary. So much so that 80% of respondents believe that they would up their investments by 8 to anywhere between 8 to 20% more than what they were doing in previous years because of this journey. And we will talk about what are those buckets of technology investments in a bit, but that was very pleasant to see that there is commitment from the boards and from the leadership towards that investment. And the third one is, of course, focus on regulatory compliance and security. That's a big one. Almost everybody feels the challenge to comply. There's a lot of this technology investment is also going towards security and compliance. So that's very clear. The good news is that only 12% of the respondents said that the compliance is actually slowing them down. So it seems like the banks have found a way to continue to invest in innovation, yet try to focus on compliance. Of course, it's an area that is an ongoing journey. As new regulations keep coming in, the banks will have to comply and invest in the technology around compliance. So some of these things, again, I wouldn't say there are any surprises, but good to see some of these come through. One of the big challenges, and that's another question that we asked, so what are the challenges? And amongst multiple challenges, the big one was around talent, especially around tech. Given all the tech investments, whether it is AI or blockchain or analytics, data, or around cloud, around AI/ML, building the models, part of it, or Gen AI, I think all those investments require talent, and this talent is not just the tech talent. They also need to have context of the domain. So based on that, I think there have been a lot of challenges. Whether it's about culture, when you're bringing tech talent from other tech firms to the banks, there's a different way this tech talent is used to working in the tech firms. So how do you align them with the culture? Once they are in, how do you retain them is another big one. So acquisition is one challenge, but retention is another challenge. Mind you, the competition of this talent is not just with the peer BFSI industry. An Amazon would want it, a Google would want it, a TCS would want it, a small startup would want the same talent. So there is war for this kind of tech talent, and it's definitely one of the big challenges. Of course, a lot of firms are investing in reskilling, upskilling, repurposing talent based on their current needs. A lot of them are also hiring fresh from campus and then training them on those cutting edge skills in their context and growing them with the firm, because sometimes it's easier to just build out talent over time than just hire from outside, given the cultural and other aspects. So a lot of things going on there, but this is one of the biggest challenges that we are seeing. What I would do is now invite Pranati, my colleague, to just give you a bit more deep dive into what are the technologies that we are seeing evolving within the BFSI sector. What are some of the use cases? What are some of the nuances that we are seeing from a challenge perspective? And then probably we can open it to a bit of Q&A. Pranati?
Thank you. Thanks, Ashish. So I think, we like to call it the ABCDE of technology. If banking, financial services firms, if they really want to survive or thrive in the future, What it essentially entails is that, you invest across all these different pockets. When we asked several of these, leaders, financial services leaders, needless to say, blockchain and DLT was not on their radar, but all the others are, something which they believe is strong, and, that we're making strides into it. Very interestingly, if you look at the averages against the global peers, if you look at the investments that Indian banks and financial services firms are making in AI or data for that matter, it's slightly above the global average. So that was something which was very striking, and it intrigued all of us. Very interestingly, I think the Deputy Governor also talked a lot about experience and ecosystem. That how do you facilitate more and more partnerships? How do you make sure that you're interacting with the fintechs of the world at the same time? So that's the the last pillar in terms of that will propel banks to grow in the future. Now, when we do a deeper dive and try to look at one particular challenge, I think Ashish alluded to the challenge around talent. The other challenge is around legacy. How do I manage my legacy estate? We asked, several banking financial services leaders. I think we got above 80 responses. That what are your plans around modernization? What are you looking at? Are you trying to re-platform? Are you trying to take a big bang approach? What came out as a common denominator was that we really mainframes are here to stay, so they are there, but at the same time we are looking at some sort of a balance. I think the Deputy Governor was also alluding to that. We really want to have innovation, but at the same time we need security. So how do you ensure that there is a right balance in the overall ecosystem? We observed that at least 60% of banking financial services and insurance institutions within India, they are keeping their mainframe estate. If you also compare it to what is happening around in the market, IBM that has the that they own the mainframe systems. They are also collaborating with the larger public cloud providers in this space. So again, alluding to the E of ecosystem, how do you sort of marry with the ecosystem and create a growth opportunity for you? Keeping us moving, as I mentioned, that how do you ensure that you have a mainframe system, but you also take certain workloads onto the cloud. So the workloads that are going onto the cloud, as per our research, are mostly horizontal in nature, non-core workloads, as you call it. In the banking world, we would say that the CBS system, your core banking, central banking system, is still on the mainframe, but the peripheral is what is going on cloud. And that is somehow enabling things such as UPI, which we just had a wonderful discussion about. So all of that is because of certain portions going on cloud, enabling your UPIs through web services APIs. Keeping us moving, I think no conversation is complete around technology unless and until we talk about AI. So, how is Gen AI impacting us, generative AI impacting us? One example that I think a lot of us are using is ChatGPT, but what we have seen is across the globe, these are some of the global numbers that we are presenting. We've seen an uptick in the kind of investments coming into generative AI. So enterprises are increasing their targets in terms of AI investments. More than 74% of the respondents suggested that we are looking at AI from a high impact standpoint, that what are these high impact use cases that we need to bring aboard. Broader AI strategy, I think this is very well illustrated in our report, but I'll just give a brief summary that if you have to win in the AI market, what is the approach you need to take? How do you do that? First and foremost is define your goal. What is your goal? As a bank, are you looking at just growing? Are you looking at compliance? Are you looking at efficiency? Are you looking at experience? So what is that end objective? When we align to the end objective, we try to marry them to the typical use cases that have to go on generative AI, or you will take that kind of an AI-based transformation. The next comes selecting the right kind of partners. So what are the different ecosystem partners you need? Because this is not a journey that can be done alone. As we were talking about, talent-specific challenges, legacy-related challenges. Hence, selecting the right kind of partner is going to be very crucial. And last but not the least, how do you sort of monitor the SLAs? How do you sort of tie it back to your original goals? Once you've selected the use cases, you've selected the partners, how you go back to, and then the rest of the things around training, testing, retesting, all of that, can accommodate gradually. Keeping us moving, we also gave a view on, what are the different use cases across, the value chain of banking, financial services, and insurance, which must go on generative AI. So this is just a snapshot view. What we want you to look at is the top right, which are the quick wins. So if you want to win in the AI market, the quick wins where, these are these high potential use cases where the ease of adoption is going to be higher. So those use cases are the ones which you should take first on generative AI versus some of the others where, the win rate could not be as high. If we've studied over 80 banking financial services use cases across, lending, payments, within insurance again, reinsurance, retirements, all these use cases are very well covered within, within the report. This is just one of the snapshot views that we've been able to create. Last but not the least, want to leave you with this thought around agentic AI. As generative AI is moving forward. Last 6 months, the buzzword has been around agentic AI. How generative AI needs inputs from a human, but how agentic AI is actually creating action-based, self-created inputs. The maximum impact for financial services is happening on the experience side. So, your hyper-personalization, things around, how do I optimize my portfolio? That's where we see an uptick happening. So within the Indian market, Indian financial services sector also, we've seen some bit of, interest or rather relevance of agentic AI as part of, our survey exercise. Let us leave you with the thought around what is going to be some of the pillars of success that will empower Indian banking financial services world. One is how do you infuse data into your operations? How do you make sure that the data estate is robust? When we say data, why we are alluding to that, it is because things around AI, things such as moving forward into the journey of AI, be it around fraud, compliance, or around customer experience, all of that, for all of that, data is going to be your bedrock. So making sure that your data estate is powerful is the very first step. The second is going to be the modernization journey itself. Rather than having a big bang modernization journey, can we look at a continuous step-by-step modernization journey? What does that estate look like? Again, it will vary as part of your charter, as part of any financial services organization's charter. And leave you with this thought around technology debt and sprawl. We are talking a lot about, there are a lot of as-a-service applications in any small organization itself. Now here we see, huge banks, several organizations, several platforms. How do you, create synergy between these platforms? How do you make sure that some of these platforms are, not relevant and, they have to be decommissioned? So how do you select some of those? So this is going to be the future of financial services centered around customer, which Ashish alluded to, centered around data and overall technology. Yeah, I think.
Yeah. So while we painted a picture on the tech investments, but the fact is that we are still far away from what is high maturity when it comes to even data, for that matter. There are still a long tail of banks, financial services firms, insurance firms, where still we are grappling with some of the basic issues around data, around security and others. So I think this is a long journey. Even generative AI for that matter, we've been a part of so many different forums and people keep asking us what's really happening, how do we, what's the state of the art in Gen AI. And what we are seeing is a lot of firms are just doing pilots, and there is almost death by pilot. So there is a pressure from the board, pressure from the leadership who want to look at Gen AI use cases, and then you have some vendors or some startups who have some interesting use cases, and you do a quick pilot and you want to show that yes, we are doing something on Gen AI. But then to really make it a very business focused, sustainable and a program requires a different thinking and a different lens. Of course, a lot of work has to be done at a data engineering layer, which is the hard work, the plumbing and making sure that the data is high quality, relevant, and starts with data storage and so on and so forth. But so there's a lot to be done out there just on the data side for us to then get into more advanced analytics and then to build models on top of it and then to use Gen AI applications. So that's a long journey. Of course, there are some banks who are more mature than others, but we still believe there's a long road to cover there. The another part that we also realize is that it's hard for the CTO and the technology leadership to get a lot of these investments. Also because at a board level, you know, they need to get some of those approvals. Some of these regulations are kind of evolving. These investments are long-term investments, and some of them are big bets. So therefore, even for example, cloud. I think we've been at it for probably last 7 to 8 years now from a cloud journey perspective. And even till date, maybe 60% of the banks are saying that they only moved 70–80% of their non-core workloads to cloud. So there is still a lot of journey that is pending to happen, even from a journey to cloud perspective, right? And then of course the application estate modernization, and then a lot of other initiatives. So I think that it's a very interesting time. A lot of innovation and a lot of interesting work in this space. Very fast evolving. Great place for tech talent to be. Of course, the report lays out a lot more considerations, a lot more findings. We wanted to just leave some time for any Q&A, if any, but that's all what we thought we'll share as a teaser to the report. Thank you.
Thank you. My name is Amol. I am from Prolifix Limited. I'm working there as a sales director. Thank you for showing the report. Now, the question over here, I'm not sure whether it has been asked or not during the research, that what the CIOs or the business leaders feel in terms of outsourcing the work of AI or doing that in-house.
So we did ask that question around outsourcing, and that's why, you know, the whole construct around ecosystem has been mentioned. We ourselves are sort of recommending that the way forward could be an ecosystem-centric approach, because banks, financial services firms do not have the answer. You know, they are marred with a lot of challenges, especially when it comes to technology.
Yeah, and then there are certain areas which are very core on data, right? So there are data privacy, data security issues. So there is some part that, yes, can be outsourced to build certain platforms and others. But I think when it comes to some of the core, a lot of banks are keeping to themselves. In fact, in one of the recent, another research reports that we did, we saw this trend of insourcing and not outsourcing. So you can see a lot of the GCCs, the global capability centers of global banks. We have probably over 100 plus of those within the broader financial services industry. These are global banks having their in-house centers in India. And one of the reasons they are growing very fast is because they're insourcing some of the work. And some of the work is actually coming as to be the high-end work around what you're talking about. Yeah.
Hi, thanks again for the insights into the report. My name is Viren Reshamwala. I represent MBM Newtech. We are a tech company. My question is that in our experience, a lot of banks, especially, there are a lot of silos. They do implementation, and you alluded to that in whatever one startup coming up and doing some quick pilot. I thought one good way of doing what I understand would be setting up COEs or Center of Excellences. In your experience, on your whatever questions that you, in your research that you were throwing to the CIOs, did you come across customers willing to set up COEs around AI? Do you think that's a kind of a concept that exists?
Yes, that's a very common conversation right now in terms of how do they really plan the org structure around this. So again, there are models where different teams have been asked to look at how they can embed AI and data within their various teams, but then you need to have a horizontal capability also, which makes those horizontal technology investments in order to make sure that you have the right data storage and data sets and all that, the models and the technologies around those. In fact, we were talking to one of the CIOs, and this was not in India, but it's a global CIO, and they were pretty frustrated that they have a team sitting in Australia and they are doing some nice experiment around AI, and then they have a team sitting in Europe doing some nice experiment, and how do they govern all this? How do they make sure? And probably the answer they were thinking was around a COE that would kind of orchestrate centrally the technology investments and some of the business objectives around what each teams can do. Yeah, thank you. Okay, I think we're already top of the hour, but thank you so much for your patient listening, and look forward to hearing any comments once you read the report. Thank you, and have a good rest of the day.
Thank you so much, Ashish. All right, again, a very insightful report, clearly delineating the priorities of BFSI. Ladies and gentlemen, I'll see you on the other side. We'll start our next set of sessions in this very hall at 4:30 p.m. And the topic of that panel discussion is going to be navigating the future of finance services in India, the tech roadmap. And for those of you who will be interested in the fintech space, there will be a session starting at 4:30 about navigating the future of fintech in and about innovation, regulation, and growth. So we'll see you on the other side. Thank you. with the next leg of our program here at India's biggest BFSI event called BFSI Insight Summit, where we actually discuss everything that has the potential to impact the future of BFSI in India. Ladies and gentlemen, in the previous session, we actually launched the Business Standard Everest Group BFSI Tech Report, which was inundated and riddled with many interesting perspectives, which are of the interest to the BFSI industry, including the ABCDE of technology, which is the arenas where BFSI organizations are actively investing in technology, which had the components of AI, blockchain, cloud, security, data and analytics, experience and ecosystem. And most importantly, it had one fundamental insight that banking has moved from being a product-led transactional kind of industry to a lifestyle where customers are expecting embedded finance. Moving on, ladies and gentlemen, it's now time to get into a panel discussion which actually discusses, deliberates and delineates the topic of navigating the future of finance services in India, the tech roadmap. To navigate and maneuver this conversation, we have with us our moderator, Ms. Nivedita Mukherjee, Executive Editor at Business Standard. And joining her on stage are going to be our following panel members, beginning with Mr. Ashish Sehdev, Vice President and Head Asia Pacific at Everest Group, Mr. Shrikant Subramaniam, MD and CEO, Angel One Wealth, Mr. Saurabh Tiwari, CTO at Policy Bazaar, Mr. Girish Krishnan, Director, Payments and Merchant Services, Amazon Pay India. In a rapidly transforming digital landscape, technology is actually rewriting the playbook for finance, reshaping customer experiences, regulatory standards, and operational efficiencies. This discussion will bring out and elicit tech pioneers and finance leaders to outline the roadmap for India's financial sector, highlighting the innovations, challenges, and strategies that are paving the way forward. With this note, over to you all.
Thank you. Thank you, Ridhima. Good afternoon, everyone. We've had almost 2 days of so much of brainstorming already on banks, mutual funds, insurance, NBFCs, everything. But I think we've come to the most exciting part now, technology in financial services. So listen in carefully. It's going to be a very, very exciting session. So welcome all of you. You know, we've had so many generations, baby boomers to millennials, and now we heard it's the Blinkit generation. So for the Blinkit generation, what is it that all of you are looking at as, you know, the roadmap ahead in financial services? What is it that the Blinkit generation actually is looking for? So can we begin with you, Girish from Amazon Pay?
Hello. Hey, first of all, thanks for having me here. You know, at least at Amazon, you know, we don't look at competition at all, right? But I think the customer is very important. So the Blinkit generation, I actually mapped that to 2 parts. One is, you know, the young generation who are super hungry, who will kind of out-execute everybody else and then create disruption. I mean, that's what the Blinkit, you know, at least the value proposition stands. And then there is customers who are ever more demanding than earlier, because earlier we used to be, you know, happy with like a 2-day speed. Now you're getting things much faster, right? So I think the customers now are more and more demanding, yeah? So when you look at like the landscape, how it is evolving, the building blocks can be disruptive. For example, it's blockchain or UPI. Fundamentally, the building blocks are changing, and that's a very important part where the disruption happens. And when that disruption happens and the network gets created, you also have customer expectations change rapidly. Right? Like, so that the Blinkit generation kind of maps to how the customer experiences are evolving, because this building blocks fundamentally has changed the game for you. and applications of that building block manifest as, new solutions or application for customers which cater to a new set of unmet expectations, which was probably not there earlier, right? And if you, beyond that, like, this also has to kind of function within all the regulatory guardrails and all the compliance requirements we are having, right? So I think from a company perspective, I think it's very important to kind of embrace these trends and then plan ahead in terms of how are we going to kind of solve these customer requirements. And at Amazon, we always work customer backward and not capability backward. So while the trends are there, right, I think it's very important to kind of understand the customer needs, go deep into it, solve the problems, and then I think the results will speak for yourself. So I think that's how at least we have operated. And of course, the trends are new, but I think the solution or how we approach the problem and the market, I think that doesn't change.
I'll go to Ashish next. Ashish, you just came out with a very interesting report from the Everest Group. So, you told us about some of the key findings, and customer focus is one of the findings that you said is the most important that tech can bring about. Another is investment in technology, security, and compliance, and another thing that you mentioned is the talent part, the top tech talent, that is a big challenge. So can you tell us, and all our panelists, how, the road ahead will be easier and much smoother if, we deal with technology better? And from your findings, from the survey that you've done on so many CXOs, what is it that one should do really?
Yeah, I think that's a pretty big question to address. But that's a pretty big question to address. But let me maybe 30 seconds spend on your previous question on the Blinkage generation, right? So, and as we see it, they require speed, convenience, completeness of transaction, and continuous kind of support. So, right. So how does the whole ecosystem then kind of get together to offer that? And there are different pieces of the ecosystem, and then that's enabled by tech. So I think what just Girish mentioned, I thought, let me just think through the framework that we have just to put that in perspective. But in terms of the question around the tech roadmap, we did talk about the ABCDE framework, and it does have all the tech jargons. But I think really it's about thinking from how is the customer preference evolving today, right? And what we are seeing is that the customer is no longer just looking at a standardized transaction. They are looking at being able to access finance and payments and lending and all kind of financial products in any platform that they are engaging with, whether it's a social media platform or an e-commerce platform, or it's a ride-hailing app or anything, right? They want to make sure that they're able to quickly access that, and therefore the APIs, microservices, cloud, all the technologies are able to enable that, right? So I think the ecosystem play becomes again very important when it comes to the future of tech. In terms of the technology per se, I mean, we've been at it with cloud for now 6-7 years. Still, there's a long tail of banks that is still has adopted only probably half of their workloads. That is also non-core workloads to cloud. We still have a fair bit of workloads yet to be moved. Of course, there is the core that is still yet to be modernized, and there are motions there. There is a whole set of data engineering problem, the basic plumbing of data to make sure that the data is ready for AI and then Gen AI use cases. There are security and regulatory developments that happen, and one needs to address that. So I think it's a much more broader question, but I think some of these key elements one definitely needs to look into.
Yeah, thanks, Ashish. I'll come back to you in a bit. Shrikant of Angel One. So for wealth management, what are the things that you're looking at from tech perspective? What does the road ahead look like for the Blinkit generation?
Well, firstly, thanks for having me on the panel. Look, I think from a wealth management is a very highly personalized services because you're dealing with one of the most sensitive ingredients, which is money. So one will do well to sort of recognize the fact that it's a very high emotional quotient transaction, and nobody likes to part away with money without having established trust and credibility. And actually, one of the points that Ashish made, I 100% concur. The completeness of transaction, what he mentioned, and the way I look at it is slightly different. I would use the same analogy, but to say that this is also how we've started redefining trust. Let's say 20 years ago when I started my career, trust was defined by conduct, trust was defined by the brand, trust was defined by governance. Today, trust means all of that, but also trust means that if you push a button, the transaction should go through end to end. If you do a purchase transaction, if you do a redemption transaction, it should not get stuck in the middle. So if you jump into an app and you don't get a completeness of transaction, the Blinkit generation, as you call, or the Gen Zs or the Gen Alpha, they're not going to wait too much, and they're going to be jumpy, they are agile, they want the transaction. So technology is also to ensure that you're able to fulfill transactions at real time in a fast manner, but also you're able to complete an end-to-end transaction. Apart from that, in a traditional industry like wealth management, technology can do a lot in terms of bringing in efficiency. A lot of services like client servicing, and prime example being Amazon. I think it's part of folklore that all of us being Amazon users, very few of us, very few times do we ever feel the need to call a customer service agent, right? Because the backend works so smoothly. So I think customer service is ripe for an automated journey. Operations is ripe for an automated journey. The entire onboarding of a customer, the entire consolidated view, and we were just chatting while walking here. Today with digital public infrastructure like account aggregation, availability of the entire data layer in a single place is as easy as a click of a button authenticated by a consent of a customer by OTP. So having a consolidated view all in one place. Portfolio analytics. Someone asked me a question, what do you mean by AI in wealth management? I think before we rush to unleash AI to customer, I think the first leg is, for us, AI is defined not as artificial intelligence. AI is defined as automating all the intel that we have. So we intend to use all the AI ML tools that we have, but firstly to automate all the intel that a combined team of, let's say, 100 years plus experience have, and to see what kind of market cycles have seen what kind of behaviors. So multiple roles technology can play, and what has been started by great fintech companies by way of financial inclusion, I think many of us can use it responsibly by now taking it to a wider audience as India grows from a 2,300, 2,400 per capita GDP onwards and upwards towards 5,000 and 7,000. So I think without embracing technology, either deeper or wider penetration of services like this is almost impossible.
Saurabh, from wealth management to insurance, Policy Bazaar, what is Policy Bazaar doing to make things better using technology, whether it's AI, Gen AI, whatever?
Yeah, I mean, before I start, I was just wondering, I wish something like account aggregator did exist in insurance. I think one of the biggest challenges that we have, there are various products, there are various providers, and it's been a traditional journey which is being converted into a modern digital landscape. It has taken a time. I think we have spent almost 15 years to at least automate certain processes where people can come and buy and have the insurance digitally available on an online platform. It has not been a smooth ride. It took a lot of effort to work very closely with the suppliers to automate certain stuff. What we are looking forward is largely we want to make sure that while someone who has purchased from an insurance product should be able to get a seamless service also.
That's a very, very important aspect of our thought process. We have almost invested 3 hours in that journey, and we believe we have to still invest another 10 years to make the entire experience seamless. And if I just want to take some examples around Gen AI and how we are actually trying to solve these things, let's say when you're looking to buy motor insurance, one of the ways when your policy has expired, you have to go through a process of inspection. And traditional way of buying has been where some surveyor used to come and inspect your car, and after inspection he used to share the report. This entire process used to take the 2 days, 3 days effort. What we have been able to do, you take the video and send the video back to our system. Our system will run the entire AI over it and see where are the problems. It will revert back to the customer saying that these areas you have to recapture to ensure that your policy can be generated. So the work which used to take 2 to 3 days now can actually help customer and having a policy within a couple of hours. And how can we actually further streamline and bring down that? That's the goal that we are looking at. There are other examples. It's a very involved category because you're making a promise to someone. You're giving a piece of paper when you're issuing a policy. There's a lot of fraud which happens in the entire segment. So there's a lot of effort which we have put in using AI to automate the process of anomaly detection, where we flag cases which can potentially be having issues. There had been scenarios where people are dead and on their name someone has tried to basically book a policy. So those things can only be done using the AI and Gen AI piece, largely AI I would say, because at a scale where we are operating, we can't run it through rules. It has to be AI automated, and we have used that to capture certain cases which have been flagged to the suppliers and partner ecosystem, and we eventually have been able to bring down our risk ratios and loss ratios. So there have been plenty of examples. We'll talk as we move forward on this line. Yeah.
In an earlier session, we were talking on the relevance of CTOs or CIOs, or the tech team basically. So my question to all of you would be, how relevant are CTOs or CIOs now, and have things changed? I know, Girish, you are not a CTO, but even then, you are looking at the business side, and you know how has the role of a CTO or a CIO changed in an organization? Has the corner room dynamics kind of, taken a change?
Yeah. See, I think whoever runs a company and takes responsibility, right, to kind of solve the customer problems ultimately and show business results. I think what is most important or most close to them would be the various levers they will have to influence the customer behavior as well as show business results, right? So I think the question in terms of how important a CTO or CIO is mapping directly to that. So as you embrace technology more and more, right? I think the dependency on technology to kind of run large businesses just goes up significantly. And with all these different stacks coming up, new technologies, Gen AI, all of that stuff coming up, right? I think we are getting in an era where there's a lot of interconnectedness and dependencies on systems, on concepts. So I think somebody who understands all of that interconnectedness, right, and especially in a more complex and regulatorily challenging environments, I think the role of the leader, if I may call, who understands technology really well, I think it's probably the most important role, right, in organizations. Because without technology, right, it's very difficult to survive. Because earlier, there could be some companies which are very technology focused. But now I think the ecosystem or the network or the government or the country, that itself is moving to a system where, right, technology is running it. We don't have, businesses which are completely on paper anymore, right? The government itself is a big enabler of technology, enabler of platforms on which things are built. So I actually feel that the role of a CTO, CIO, whatever you want to call, right, the technology leader, and I think the leader, the CEO has to kind of be very close to them, right? More than any other time in the history of businesses, right? So I think that's where we have evolved to.
Ashish, from your various surveys that you've done, what is it that you found out from the CXOs themselves? Are they looking at the tech team, the leader of the tech team differently now? Are boardrooms different?
Yeah, I mean, a lot of it is also very contextual to what business you are in and also what stage of business you are in. So, but then we've all heard the statements, right, that you know, we are, so there are business companies and now they're saying that they're in the business of tech, right? So therefore that itself highlights the importance of technology. And if the business is tech, then if you're a policy bazaar and you're doing modeling and credit writing and underwriting and other, the banks are doing that. So are banks or are they tech companies with a large you know, acquisition, service, other parts of business? So I think that's the but I think the heart of the question is that tech, of course, is critical for any strategy today. You know, we talk of business model reinvention or innovation, and a lot of that is again driven by tech. You know, while we do look at how the customer is evolving and changing, but I think the advancements in technology has made things possible that were not even imagined by the customer. So do customers even know what they want? But when they see or when they experience something that is enabled by tech, then they all want it. So I think to that extent, yes. Now, of course, between CIO and CTO, there are two different roles depending on the organization. Some places they can blend together. CIOs may be more of running the business with incremental improvements, whereas CTOs would be looking at more the technology stack, more disruptive, building platforms and so on and so forth. So there are some of those nuances which would differ from org to org, but yes, technology, absolutely, it's a boardroom conversation. In fact, last 1 year or so, you know, and I think we were at the lunch and we were talking about that 2-3 years back it was all about ESG and now it's all about Gen AI, and that's a question directly being asked to the CIO or the CTO org.
Shrikant, any example from your own company, how the company has changed in terms of the perspective on tech team, actually?
So yeah, I was hoping you asked that question because I think, see, look at how the landscape has changed. There are companies who are born as a tech-first company, and then there are companies who are successfully trying to transition to be able to use technology in a progressive manner. The tech-first company, the answer calls itself out. It is a tech-first company, and hence tech is always in the epicenter of everything they do. But the magic is happening also when a lot of established incumbent companies are now trying to embrace technology, come from behind, leave their legacy systems behind, and are actually looking at making that leapfrog approach. Most of the incumbent companies rather, are now realizing that a vendorized approach in all cases may not be the right approach. So I think there are a lot of boardroom conversations which, for example, since you asked for a specific example, we have this whole philosophy that whatever we define is core to our customer journey will be owned by us, which means that tech will be written by us, the code will be owned by us, so that in case there is a problem, in case there is a breakdown of journey, we don't have to go looking out for the vendor. You take about a week to diagnose the problem, and then somebody, by the time the loop comes back, it's already taken 7, 8, 10 days, and there is a trust deficit. So anything that you define is core and at the heart of your customer journey, you have to self-own. And what is the meaning of self-own? It means that you have to have a considerable workforce of yours, which is an engineering workforce. So that is trend A. So clear trend that I'm seeing in Indian corporate boardrooms with established incumbent companies is the nature and the color of the workforce changing from non-tech with a skew towards tech team. Of course, there are progressive discussions and there are very public domain discussions of should you have a lean tech team where you can sort of have an overlay of technologies like Gen AI, or should you have a larger tech team? But I think that's a matter of a very unique behavioral aspect of each business. The second trend is of cybersecurity. Now look, I don't know about each one of you, but for me, one of the biggest worries is when I wake up is not to find my account being whisked away. I think today we are living in an era where if technology has given us 10 convenience features, it has also given you 10 different hack mechanisms of various degrees of risk. And as somebody called me out when I had blogged a few days back, that risks also existed pre-technology. That's not the point. The point is those risks were well known and mitigants were well identified. These kind of risks we don't know. I'm sure so many of us would have received a WhatsApp message from someone in our contact book asking for money. And then we realized that it was a WhatsApp which was hacked. Now, how long before not only are we getting a WhatsApp from a known, but the AI has also made sure that the tonality of the WhatsApp is such that you will have very little to doubt about it. And if I'm stuck in a panel discussion, my wife sends me a text saying that I'm stuck, and if it's a small amount of 4,000, 5,000 rupees, I may not even think and I'll just send the money out. So the nature of risk is changing, whether it's a DOS attack, whether it's a hack, whether it's somebody just taking data away. So cybersecurity is the other big trend which I'm seeing as having a very large share of most of the discussions in the boardroom. So those are some of the examples.
Right, right. So Saurabh, is it easier for the tech team to convince the tech head to convince the CEO now to invest wherever he's asking for? Has the convincing become easier?
Most certainly, I think. I've been lucky. I just want to quote something which happens in my organization, and that makes me a lot easy in dealing with tech initiatives that I do. My boss, my CEO, takes full interest on what is happening in technology. He, in fact, goes to the level of what ABI you're going to expose to a certain extent. So imagine, and it has really changed with the advent of AI, ML, etc. Because a lot of problems which you can't solve at scale with in an offline manner, you have to anyway get involved and understand how your business issues can be resolved using AI, ML. So with the technology, as the technology is evolving, and as our management team has started taking a lot of interest in how technology can help them in doing the businesses, and as the businesses are being pivoted around technology, it is becoming easier. If you go to and talk to any person, any investor, and tell them that this is the business that you are looking at, and this is your core team, and these are the people who are actually they are good experts in building a stack from scratch, and they have ability to understand the latest technology. I think there is a possibility where you will get attention and you will get time from them. It has certainly changed, and last 5 years have been amazing for such kind of investment trends. I'm sure a lot of us have been investing in various technologies, so they are the best people to answer that as well. Yeah.
That's quite heartening. So I'll talk a bit about the regulatory piece, the governance. So Girish, how has the regulatory space changed with the evolution of new technology and the fast pace of technology, the changing technology, and how does a company cope with it?
Yeah, I think, first of all, I feel like, regulation and compliance, is very important for businesses, because at the heart of it is to, at least in the payments space, to protect the customer, right, from the data getting leaked, from the customer, not having to kind of, go through pains in terms of bank account being hacked or losing money. That's all bad things, right? So I actually feel compliance is the core of the business running and like serving the customers well. And in India, especially, I feel like the regulator has done a fabulous job in terms of, understanding the key challenges and then like, enforcing them as well, right? And then helping the entire ecosystem to kind of mature to a totally different level of servicing. So I think that's great. Now the question is, as these regulations keep coming in, right? How do you prepare yourself to kind of rapidly evolve and be compliant? So I think there are two viewpoints we can take over there. One is to say, am I compliant or not? Second is, hey, you know what? This is actually good for business. Hence, doing this is actually going to help our customers. And then how do we take that offering, not just from a compliance standpoint, but as a good for customer feature, and then, see if that has got implications in terms of, fostering your business. And then when we started this journey, especially like, at Amazon Pay, we have PPI license, right? Like we do UPI, we do gift cards. So there are multiple areas where we deal with regulatory compliance and then the evolving landscape. I think initially, of course, like everyone, we also had like a kind of a learning curve in terms of how to kind of do this. But I think over a period of time, one of the things we have done, I feel really well, is to take it really seriously. And then at the heart of everything we do is the trust to the customer, trust to the merchant, trust to the partners. So right now, I feel like from a culture perspective, right, like that information about, hey, these regulations and compliance is like really important. And we need to think through these upfront when we design the systems, right? And we have also kind of re-engineered and reorchestrated our systems to suit the regulatory compliance. Data localization is a great example, right? We had to localize a lot of our systems when that regulation came. But I think it was quite thought through. So now I think with more and more regulations coming in, I think the base foundation is set. And I think the people have the culture of thinking about compliance upfront before we jumpstart a new initiative. So I think that culture is set, and I actually feel that it is actually working really well. Even though the upfront investment and like the learning process, a lot of people felt like it was quite sudden, and then like it had its ramp time. But I think once it is set, if you think through that really well and orchestrate your systems and also percolate the learning and like tell people that this is very serious and the entire organization culture changes, I think overall I am actually seeing this as a very positive trend.
Just to take it a bit forward, Ashish, do you think compliance has a very huge cost and it's also stifling innovation that is required?
Yeah, no, a very interesting question. So I think from a cost and investment perspective, yes. I think, and in fact, in the research that we just did on behalf of Business Standard, that was a very clear answer that the respondents said that almost 50% of respondents said that they are having disproportionate more investments going into compliance and security kind of investments around tech. So that's for sure. I think the question around innovation, yes, I think that there's always a challenge, right? I mean, both needs investment, right? But compliance and security is something which is critical for the business right now. It can get you into trouble. But then innovation is also important to compete in the marketplace, to build new products or services, and to kind of differentiate yourself. So I think that's a balancing act. However, from all the respondents, we did gather that a majority of them did not feel that the compliance is actually holding them back in a major way, because I think that the industry is right now trying to understand the intent behind those compliances. And as Girish, you mentioned that it's important for our industry to sustain. If we do not have some of those policies and those compliances in place, then it could significantly impact or detrimental to our industry. So I think to that extent, it's good to know that the companies are taking it in a positive stride, I would say. Yeah, but yes, of course, a lot of investments are going into it.
Shrikant, your thought on this, the regulatory and the compliance piece. What is it like? Is it a burden? And have we innovated enough?
So look, I've been in a heavily regulated industry for 23 years. So we learned to live with the way regulations are defined and the boundaries are there. But I think as Ashish rightly mentioned, if you look at most of the regulations have a single point agenda, which is consumer protection and investor protection in our case. So I think as long as everyone embraces to the fact that these are being done not to stifle innovation, but to ensure that there is no mis-selling, the investors are well protected, information arbitrage is minimized, I think it will do well for all of us to play within those regulations set. Now, we speak of innovation. I think while most of the credit goes to early fintech companies for financial inclusion, but in some sense, the entire thing was also paved by much more progressive regulations and the work that the government did in terms of innovating technology. India's DPI, the entire public infrastructure, in my mind is second to none. So many people who come to India are just amazed by what a UPI can do, and now India is actually exporting the UPI technology to many more countries. We just saw the magic of Aadhaar. We call Aadhaar India's social security number. Even in parts of West, social security number can't do so many more things as what we can do with a 140 crore population and trying to get almost all Indians connected through a single document. We are now seeing what the power of it can do with the new technology called account aggregation, which is going to squarely put the onus of data to who it rightfully belongs, which is the customer. So otherwise, everybody believes that they own the data, but the regulation's heart says that the data belongs to no one but to the end consumer. So unless and until the end consumer shows value in what you can do with his or her data, he won't give you consent. So which means in one stroke, you are going to make primary and third-party data very fungible. And now incumbents who have been sitting on the same data for 20 years will have to ensure that it is not just enough for you to be sitting on data. You need to massage that data for the betterment of that customer. So I think there are multiple such examples which has paved the way for a very innovative culture. We know that most of the regulators have a sandbox in which a lot of new technologies are coming, but it's a tightrope walk. They're also well aware of the fact that everybody is 2 steps ahead to also try to exploit it in the wrong sense. So sometimes a tonality of a regulation can feel a little pinching, but if one understands it well and understands that it's uniformly applied to all, I think it's a much easier playground to accept.
Saurabh, is the financial sector, especially related to tech, is it very heavily regulated and should it be eased?
No, I think we all are running our services for the customers largely. And what is needed for the customer is something which we ought to do. And we realize we are a kind of a scaled up business right now. And if we just want to basically not follow the compliance, not stick to the rules which have been set by the regulator, I think it would only create harm for the end consumer. So we do feel whatever is happening in the sector, especially in our insurance sector, the kind of regulations which are coming, it is actually helping the customers. And wherever we feel there is a bit of improvement that is needed, we can come and we can go and discuss. But generally so far, whatever has been done, that has been done in the interest of consumers. And especially I will just name what Ashish was saying for security. I think this is one piece which is causing a lot of heartburn among a lot of CXOs and CIOs, because no matter how hard you try, you got to be just wrong once. If you are wrong once, you are just out of the game. And that's where guardrails, compliance, which have been kind of a standard, if you follow them very religiously, they certainly help you. And we did that for a couple of years so far. And we felt that it has only improved and improved our ecosystem, and we have actually become stronger over a period of time with respect to compliance and security. So I do feel whatever is happening, whatever is coming from the regulator is coming for good so far.
So whatever is happening from the regulatory side is for the consumer good. On that note, we can take a couple of questions from the audience. Is there any question for this panel? Yeah, I can see someone there. Yeah, gentleman over there.
Hello, I'm Gajendra Singh.
Brief question, please.
Yeah, I'm Gajendra Singh. My question is that to all the panelists, that what are the top 2 use cases you are trying to apply as far as the artificial intelligence and machine learning is concerned in your organization? Because we heard a lot about it, but if you can practically tell directly from your mouth, we will be able to know that actually corporates are using it.
Shall I take?
Thank you.
Yeah. So I think I do remember 5-6 years ago, there were 2 technologies that we used to talk about among technical setups: blockchain and AI/ML. And a lot of times people used to talk about them in a very fancy way. But what has changed in last 3, 4, 5 years, that it has become the part, AI/ML has become the core of every technology company. I'm sure, I mean, those who are sitting here, they would have been using in some form or another. And recent advent of Gen AI has kind of basically changed the game. So I would just give you some cases that you are talking about. I think there are three larger areas where we use machine learning and AI for us. One is enhancing the user experience, which is largely through chatbots and chat. If you want to be very clear in understanding the intent of a person while he's having a conversation and straight away taking him to the place where he can get the support without involving a human being, that's one area. And second is working on the productivity, efficiency part of it, where we use, we have a large contact center, so we have a lot of conversations that we do with the customers, and people generally take 3 to 4 months to buy a product. These conversations have to be transcribed and they have to be put in a compressed format, in a summary format for the next conversation. So this summarization has come up very good recently to help the conversations to become a lot easier and swifter. And that's really adds up to the efficiency part. And third part, which I just briefly talked about in the beginning, is fraud detection and risk management. This at a scale where we operate is impossible to be done through rules or data mining. It has to be run through a machine learning intelligent system where anomalies can be detected very fast. Having said all this, these technologies are good, but still we believe you always need to keep human in the loop to do this stuff, because you can't be just completely dependent on technologies to take over. But most of the cases get handled very swiftly. The cases which don't get handled swiftly, you have to bring the human in the loop immediately. That's what.
Does anyone else want to speak about any use cases?
Yeah, I think I can chat about a couple of them that come to mind. So at least Amazon Pay, we're trying to use Gen AI, and we always used ML and AI, right? Like across the board, in terms of personalizing customer experiences, reducing cost to serve, because payments are typically like high scale, low margin. So I think cost to serve is a very important aspect to optimize. And of course, the cybersecurity, I think we've talked about the risks, right? So if you look at personalized experiences, both on shopping as well as on payments. So on the shopping, like on detailed pages of Amazon, you get the personalized assistants, right, which help you understand the context and helps you make the purchase decision. On the payment experience side, we recommend the right payment instruments based on your previous usage, your need for an installment, right? Like so, and even like we always use AI and ML, and now we are using Gen AI to kind of give you a credit score, give you a pay later line, right? Like so, all of those are experiences which we do. On the cost to serve part, I think there is a lot of focus in terms of how to simplify the customer support, right? Like how do we use the data which you have gone through in terms of shopping journey and payment journey, and when you are asking a question, right, how can we resolve that quickly? And that's a win-win-win for the customer, for the internal cost to serve, right? Like as well as the overall experience gets much better. And lastly, on the risk side, right, I think we have models which detect fraudulent transactions, thousands of variables, and as these technologies are evolving, not only are our technologies evolving, but I think the MOs or the modus operandis are also evolving, right? I think so. And trust is kind of the cornerstone for Amazon in terms of dealing with customer, merchants. We want our systems to be very, very high on trust. And that's like the cornerstone of everything we do. So I think that's a big area for us in terms of using all these technologies.
Last question, yeah.
A lot for your insights. How is the technology insight for the last mile reach in the rural pockets? What is that investment you do? One is technology towards financial literacy. Any insights from your organization?
Can you
I said, how is technology advancement for the digital and financial reach in the rural pockets? What is that you are doing?
Rural pockets.
Rural markets.
Rural market. Rural market.
I think, look, there is no bigger leveler than technology, right? Because technology doesn't differentiate whether you're an urban consumer or a rural consumer, whether you're a rich, poor, whether you are from this demographics or that demographic. So I think if each one of us who have been in a D2C sort of a business can make sure that by using technology, we can take our trade, craft, product, services now to a wider base in India. As I said, it's very difficult in today's cost to serve economics to go without technology. So I think one of the best ways in which we can all participate in this growing financial inclusion is to use technology and take products, services, and goods which have otherwise been relegated to only, let's say, the top cities to the lengths and breadths of India. So it's a very simple answer to that question. And two, I think it's now well known that the smartphone penetration in India is second to none, which also means that most of the population in India across, beyond the top 20, top 30 cities are very comfortable in using smartphones, smart technologies, and hence the marriage of the both points will mean that you will be able to cater to some of these consumers in a much more sharper and a much more productive way. So I think that's the way at least we are positioning.
Thank you very much. Thanks a lot for a very good panel discussion. Thanks a lot, everyone.
Right, can I request Nivedita to present our panel speakers with a memento? I think, again, a very insightful and incisive discussion, with few of my personal learnings being the definition of AI transitioning from artificial intelligence to automation of all intelligence in terms of people and their expertise and exposure. Technology becoming a boardroom conversation, transitioning from ESG to Gen AI. The use cases of Gen AI to actually detect fraud cases in the realm of insurance, and talent hiring in massive companies skewed towards tech teams and hiring tech talent. And the fact that compliance is good for consumer and investors. So I think, again, a very candid and incisive conversation. Can we give this panel a huge round of applause, ladies and gentlemen? Ladies and gentlemen, at 5:45 p.m. in Conference Hall 2, which is the Narayanan Vagul Hall, we are going to have another panel discussion, which is going to be banking on technology. For now, we have an interesting fireside chat coming up. This fireside chat is going to get exchanged between Mr. Tamal Bandyopadhyay, Consulting Editor and Business Standard, and Mr. Bandyopadhyay will be joined by Mr. Nitin Chugh, Head Digital Banking and Transformation at SBI. With his vast experience and visionary approach, Mr. Nitin Chugh has been instrumental in reimagining banking for the digital age. And I think, again, we can expect a lot of use cases, anecdotal references on digital banking and transformation from SBI perspective. So I think let's get started in a few moments from now. And we've been told that few of the ladies here are missing their bags. So some of the bags have been kept at the Lost and Found at Geo Convention Center. So in case you are realizing that your bag is not around, it would be a good idea to visit the Lost and Found and get your bags back. Are we ready? Can I request my audience to please move towards the right so that we can make space for our next panel discussion? All right, Mr. Tamal Bandyopadhyay and Mr. Nitin Chugh, can I request you both to join us on stage? Can I request you to please usher the audience towards the right side? All right, ladies and gentlemen, can I request you all to please settle down and give a huge round of applause for Mr. Nitin Chugh and Mr. Tamal Bandyopadhyay, who are going to be talking about the digital transformation at SBI.
Yeah. Almost, yeah, half empty hall. Now it's challenge on you. Just 1 second. You have heard that every day. This is what, and Nitin, I'm sorry, I mean, Ridhima spoke about, we will talk about State Bank of India and all you have done. I think I got the idea, let's talk about cybercrime. Huh?
Whatever you say.
Smile. ठीक है. Good. No, seriously, I mean, all of us during the COVID days, I think the Jamtara that on Netflix, all of us have seen that, sabka number aayega. But that Jamtara, that phishing scam is passe now. And trust you me, if you are interested what is happening in cybercrime, you must see this film. It's a 2024 film, is The Beekeeper. Just get it there, The Beekeeper. There you will see a school teacher, Parker, how she became a victim of fraud. She lost everything, and plus $2 million which she was saving for a charitable work, etc. That shows the new face of cybercrime. Nitin, I mean, I'm serious about it. Just tell us this, the so-called social engineering. Every day we are hearing different kind of cybercrime. Even Prime Minister Mann Ki Baat, he spoke about that. So what's happening all around?
I think we're just seeing new variations of how fear is now being used more than greed. So in the earlier years, maybe a few years back, predominant theme was greed, that you won a lottery, you got a job, there is something that your inheritance kind of scams. So that was largely driven from greed. What we're seeing now is a lot of intimidation and fear, where people are being threatened, people are being told that something wrong has happened, we've intercepted something which was meant for you, it's got contraband goods or some such thing. And that is where people are succumbing to, and well-educated people, completely aware people are succumbing to the intimidation from calls like these. And it's a new trend. And no matter how much we make people aware that don't entertain these calls, don't give away your credentials, the circumstances in which these calls are being made, sometimes they will even fake a family member who's been held in custody. And you can actually hear the family member asking for help, saying that I'm under arrest, and a cop is sitting next to me, or it's a video call and you can't see that person, but yeah, it's a family member's voice. And people don't usually, in a state of panic, apply their mind rationally. So they give in. And we have seen instances where over a period of 3 days, 4 days, people are willingly going to branches and making RTGS and NEFT transfers because somebody has threatened them, saying that if you don't do this, we've placed you under arrest.
In State Bank of India, you're seeing this.
No, I'm talking about industry. I'm not talking about State Bank of India in specific. But cases like these basically tell you that there are vulnerable human emotions which the fraudsters are obviously playing around. And this is yet another form of social engineering, and this is relatively new. And that's why I think the Prime Minister also spoke about this whole digital arrest kind of scams which are taking place.
Yeah, this social engineering in cybersecurity, that's the relatively new thing that we are hearing. What does it actually mean is this, I picked up from Google or whatever you call it, a psychological attack that involves manipulating people into sharing sensitive information or taking action that compromises security. So that's what is happening.
Yeah.
And you were saying the earlier it was greed, like I am being tempted to get some money, I've been lured into that. Now it is fear.
Fear.
And some real life incidents we have been hearing much, but sitting in your perch, what do you see? how it's evolving?
So we are seeing different kinds of modus operandi playing out right now. Wherever small ticket values are involved, you will not find the scamsters making an effort to go through this whole process of intimidating, threatening, pretending to be dressed up as a cop and having a video call. They don't do that for small value transactions. They will usually do that for high value transactions, and high value could be as many as a few crores. For small value, these are usually the traditional phishing-based scams where people willingly give away their credentials or an account takeover or those kind of things.
That's the Jamtara model.
That's the
small
Jamtara.
value Jamtara.
Yeah,
On how do they pick up their victims? Just for our understanding.
So that is almost like...
Is it like because everybody can keep a tab on the data? I mean, which flight I am taking, if I am a business class or I'm an economy class passenger on flight, what kind of hotel I am checking in, what I am buying, everything is available. So is it I mean, that's how they gather information and that's how they find their victims whom to attack? I mean, can you tell us more?
We would like to believe that they do.
Can somebody ask the outside stall to stop them making the noise? Yeah, please.
We would like to believe that that is how they do it, but I think the way we've figured it out so far is that it's almost like a cold calling, carpet bombing mechanism. That you call 100 people, you will get 2 or 3 victims. So this movie that you referred to, Beekeeper.
You have seen that?
I've seen that movie and I've been recommending to everybody to watch that movie. There are organized contact centers who will just keep making calls.
No, Nitin, I'm just trying to use this platform to educate us, all of us, because you are the tech head of India's largest bank, 20% of banking system. So you have a much better perspective than anybody else, any of us. You just educate us. How does it happen? How does a victim fall prey? And how does he or she forgets whatever it is for the time being under a spell? What's all about?
See, there are hundreds of ways that this can happen. What we were talking about in terms of social engineering is the simplest, that somebody gets a call saying that I'm a policeman, I'm calling you for XYZ reason, and this is what you need to do. The old-fashioned way is to actually, like if you watch this movie Beekeeper, it actually starts very simply by this old lady that you referred to. She gets an alert on her laptop saying that it is out of service, call this number. She calls that number and it's a fake number, obviously. So even today, if you search for customer service handles on Twitter, X, or you search for contact center numbers, there is always so much of generation of these fake call center numbers also that the scamsters are doing, that customers will end up calling a fake call center. The fake call center will give them, send them a link and say that this is where you do and this is what you do. Exactly what happens in this movie also, The Beekeeper. So she actually ends up downloading a malware. The malware on her laptop, which compromises her laptop, and then the account takeover happens, and that's how the money moves out, because the credentials get compromised. So she hasn't given it away willingly, but because it's a malware that's got installed on the laptop through a link. Now that link can come through hundreds of different ways. We believe that it's only an email that you should not click and this and that, but what if you get a call? Or you have called a contact center saying that, believing that it's a genuine contact center. I mean, we've had cases where full-fledged branches have been set up in some small towns of banks.
Now,
so there is a lot of innovation in this space. No matter whichever way you look, I think there are probably very smart brains behind figuring out what to do.
Other part also is happening, that the use of in the deep fake, somebody calling in some other's voice, that can be intimidated, or I'm getting a phone call on my WhatsApp which is actually showing your face but not you and all. And I am told that once, I would not like to name, but one ex-central banker, a very senior person of Reserve Bank of India, became a victim of such a fraud. That person lost a lot of money on this. So how do you prevent that? And it's becoming a rampant. I have come across one incident. Of course, this ex-RBI person, very senior person, I would not reveal the identity I'm talking about. Even that person could become a victim of this thing. Very recently, another person, I found that got a call from his friend, the US number, got a call, that person landed up in Delhi for some work, needed some money, transferred the money, and after that when he was calling, actually his friend in New York woke up because the call is the wrong time. He said, no, I have not been to India at all. So his voice was, the deep fake happened, his photograph happened and all. So what's the way of preventing this? Tell us.
See, we live in a world which is now proliferated with tech everywhere. And I think it is everyone's individual responsibility. Rather than believing that, yes, my bank is keeping my money safe. Yes, the bank is a fiduciary, it will keep your money safe. But then what if you on your own compromise your credentials? And that is where even the law doesn't help you, beyond a point, right? Everybody should have a basic idea of what technology is being used. People sometimes just take pride in saying, I don't understand. And, because I don't understand, I'm better off, doing things in a certain way, which is fine. But when it comes to matters related to your own personal security and financial and money in your own hard-earned money in your bank account, I think it is important to at least be aware that what can happen. So when somebody actually calls or messages using a DP of a known person on a WhatsApp with a different number, and you don't make the effort of actually verifying that whether it's the same number or coming from because the number is not stored in your phone book. So you're not getting the name, you're only getting the DP. So why would a known person make a call to you from another number? It should trigger some alert trigger some suspicion in your mind to say that, should I even take this call? Should I call back to confirm? And every time I've received calls like those, you don't take the call, but when you return the call, the guy will immediately block you because they know that, you figured out that, it's a fake call. So I think some basic checks which are required, basic awareness, and most importantly, taking the responsibility for your own actions is very, very necessary.
I'll come back. I'll ask you your suggestions and advice to all of us how to not to fall prey to this kind of thing later. But a few things I want to understand from you. One is this: we keep on hearing at various conversations whenever there's cyber security is mule account. Okay. Now, correct me if I'm wrong. What I understand is this: I have become a victim of a fraud. Suppose I lost 5 lakh or whatever I will. Now this 5 lakh left my bank account, right? And at stage 2, what happens is this is 5 lakh maybe cut into some hundreds of pieces, and 5,000 rupees gets into some 100 accounts or 200 accounts, depending on how it's kids and all. And these are called mule accounts. You can't do much about it because those accounts have the KYC and other things have been done and all. And those guys in some villages somewhere, they have become a party to it, probably knowingly or unknowingly. So can you tell us, educate us again, what is this phenomenon of mule accounts? Everywhere we hear this. And how does it operate? And is there any way to prevent it or catch them? I understand it's very difficult to catch them because I spoke to relevant authorities also. They said, look, they are all KYC compliant. On what basis I will suspend those accounts? Tell us.
So as a concept, mule account is somebody who lends his or her account for a...
And I understand that many of the Jan Dhan accounts are being used like many, meaning I'm not saying that 10% or 15% or something, but maybe lakhs of such accounts are being periodically used as mule accounts.
I wouldn't say only Jan Dhan or largely Jan Dhan, because anybody who believes that there is an incentive for letting their account being used and succumbs to the fact that, okay, I will let my account be used for, let's say, transacting 5,000 rupees, but I will get 500 rupees out of that.
Oh, that's how it works.
So that is how the mules are recruited. It's not like, somebody gets money in their bank account out of the blue and then they get a call to say, listen, you got money in your bank account, now please withdraw this money, somebody is coming to collect. It doesn't happen that way.
Okay.
Mules are pre-recruited and it is part of an organized setup. They don't know what they're recruited for. Okay, so they are recruited, loosely calling it almost like a sleeper cell. So they are kept in readiness to say that at some point in time, you will get a message that there is going to be a transaction in your account. The only thing you need to do is to go withdraw that money, and we will tell you where to bring that money to. And this is the money that you can retain. So the way to prevent this, because the money has left, for example, from your account and gone into 100 accounts.
Yes.
Okay. Now there are technology-led ways to prevent this. For example, for cross-border payments, Interpol has a setup called iGrip, okay, which is something called Global Rapid intervention for payments, which is cross-country. And recently enough, in the month of July, they actually stopped a $43 million scam, which happened because of a business email compromise. Now, what is business email compromise? That I'm your supplier, and you are my client. Instead of me, somebody sends you an email saying that instead of this account, you credit to that account. And this is exactly what happened with the Singapore firm. They remitted $43 million to a fake supplier account. But when they reported this to the Interpol IGRIP, they went to the beneficiary country's police, and they have a protocol where they can stop the funds from moving out. So in India also, through I4C and the National Cybercrime Portal, the next set of things which are happening is actually be able to stop. Because once the money moves from your account, you get alerted, or the bank's risk management system will generate an alert. So before the money moves to those 100 accounts and the 100 accounts withdraw it, there has to be an ability to stop it. So that is the new thing that is hopefully going to help us.
That Interpol is working on it.
No. Interpol is working on cross-country.
Yes.
What we need, something similar, is also within India. But to identify who can become a mule account is another science by itself. That who's likely to become a mule account, who's likely to lend his or her account to something like this. But that is, that is something which has a whole lot of...
Typically, I hear that it's all happening in the rural India and the farmers and
it can happen anywhere.
Unemployed people. I mean, essentially, I am being told that, look, 5,000 bucks will come to your account, and you withdraw the money and give me 4,500, and 500 is yours. That's how it works. Right?
See, there is...
Give a real-life example. I'm sure you have come across many.
I don't want to name a city or a specific case, but we've even come across students of good colleges getting involved unknowingly. Because
unknowingly kaise hota hai, boss? Because when you are telling me that Tamal 5,000 bucks will get into your account and you keep 500 and giving me for 4,500.
Because the same people in general, invariably, are always deal hunting for something or the other. Can I get 100 rupees off here? Can I get 200 rupees cashback here? Okay. So the mindset becomes very, very small ticket gratification.
Okay.
That, oh, today I made 500 bucks.
Okay.
It's a big thing to flash in your social circle. Okay, maybe it's happening with the uneducated, the uninformed people as well, but we are seeing that anybody who gives into the temptation that I have to do nothing, I have to basically withdraw and I can make 500 rupees in a matter of 5 minutes, anybody can give into that temptation.
So as a bank...
This is where greed plays in. The mule invariably gives into greed.
Okay. Now, but as a bank, what can you do? It's because I am a genuine account holder. I have my KYC, etc. done, but I am being used and I have become a mule. So what can a bank do? Can you suspend my account, or can you report it to the police and I am a guilty person? How does it work?
So the first thing we ask customers is to report if you would find anything unusual in your account. Okay, if you find an unusual credit in your account, report back to your bank. A lot of times in the past, we've seen people thinking that, oh, I've been blessed and suddenly money has come into my account and must be my good deeds of the past, so let me go and spend this money. It doesn't happen that way. Somebody is using your account. Okay, so that is something which is...
I am told also in some cases, I would not name the geography, that people are being told that it's the PM's money, PM's relief fund is coming to your account. Is that also?
Anything is possible. You can be told it's a scholarship, it is something, some inheritance that you're getting, some long lost relative has sent you this money. Anything can be there. But finally, it is unusual. So what banks can do is, one, we are letting our customers know that please report something like this. But even to be able to preempt that this kind of a transaction can actually take place, there is data science which can help us in pre-identifying that who are the people who are more vulnerable to something like this. One, who are the people who are more vulnerable to being or susceptible to fraud, okay? And who are the people who are more vulnerable to being used as mules. Right? So two different categories. Yes. Now this is where we are now actually having a discussion that in our desire to make everything seamless, frictionless, very easy, very quick, why don't we bring in some amount of a new term that I learned only 2 weeks ago, something called happy friction, that builds some bit of necessary friction, at least for vulnerable profiles, so that they have to go through some step-up authentication, some more checks before they can actually move their money, willingly. If they're doing it unwillingly, then it's obviously an account takeover which can be through a malware or some other thing. But if you're willingly giving away money, there should be some more checks for some vulnerable profiles, which usually will not be as part of your regular pattern of spending money.
So that's prevention. But once you identify me as a mule account holder, is there any way you can punish me?
So we obviously can't punish. As a bank, you can't punish an account holder. But you can report.
In a sense, suspending my account or reporting to police.
So you re-verify the credentials of the account. You ask a few questions. If the questions are not satisfactory, you report the account as a suspicious transaction and a suspicious account. And then the law takes its own course. You can obviously go ahead and block a few accounts, and we've recently done that in a different kind of issues that came up, which was around merchants, where we saw customers raising, chargeback complaints. Okay, and we did see that there were very specific, a few hundred customers who were raising these chargeback complaints again and again. And then we found that this was a fairly organized sort of a...
No, that's what I'm just, you have taken away my question actually. I wanted to understand that bit. So this is one account where I lose money, I become a victim of fraud, then the money leaves my account, and then stage 2 mule account, etc. happens, or my money can also flow to cross-border Nigeria or somewhere else. You have to find out. But the chargeback fraud, those who are not familiar with the term chargeback fraud is like this. Suppose I go to a provision stores and I buy rice and atta or anything like that, and I pay theoretically 500 bucks or say 5,000 rupees and all. I pay through UPI. And then I say, look, I don't need this thing, you just take it back. I give it back to the shopkeeper, and the shopkeeper returns that 5,000 rupees to me. But then I go back to the bank where UPI I have been using and all, and I tell that, look, I have paid this money, 5,000 rupees, but I have not got the stuff. I have not got my rice and atta and etc. etc. I understand that in Jaipur, Rajasthan, it happened and became like thousands and thousands of people have been doing that. Is that correct? I heard that recently, maybe a local newspaper or something. This is called chargeback fraud. I have not heard anything in Mumbai, but I can distinctly remember in Rajasthan, particularly in Jaipur and all. So tell us about that.
So the modus operandi is exactly the same, that customers will buy something or pretend that they're buying something, return it back immediately, take the money, and yet raise a dispute saying that I did not get my goods and services. So there's a category.
I paid the money. I don't tell that I have taken the money back, and I said that I have not got my stuff what I wanted to buy.
So there is a subcategory in chargeback which says goods and services not received. So they raise a complaint under this category.
Yes.
And invariably the complaint gets ticketed to the acquiring bank who has acquired the merchant. And after some checks and controls, the banks will perform and they will refund the money back to the merchant. Okay, but effectively it's a fraud because no transaction took place. So you've effectively taken this money from the bank by saying that I did not get what I was intended to get, and then it's up to the merchant and the bank to keep figuring out what to do. So we did find.
And the amount is much smaller. So the bank also doesn't raise much hue and cry, just paisa de do usko 5,000 6,000 jo hai.
Correct.
And in Jaipur, I think thousands of such cases happened.
No, not just in Jaipur. We saw that across the country, and this happened last year. But there was increased prevalence of cases in some cities, including Jaipur.
Yes.
And so when you were asking this question as to how do you punish account holders, you can't punish, but you can create some checks and controls. So wherever we saw that, let's say one customer is raising 500 chargeback complaints in a month.
One person, 500 chargeback.
Hypothetically, or 50 also. It is unusual. So you will ask some questions, you don't get the answers, obviously you don't get any good answers. So what is the next thing you do? You go ahead and disable the account and tell the customer that I'm blocking your account for any transactions. So that is and of course report the account to the suspicious transaction unit or whatever. But that's all that you can do.
Okay. Nitin, I don't know whether it's in public domain, but if you know something, I think RBI is working on something called digital intelligence platform for this educating us and all. Can you throw some light on that? If you're aware of this, because I don't think it's been publicly announced. I'm not very sure about that.
I think the only
I wanted to ask the DG was here, but time did not permit me. So what is it all about?
No, I'm not completely aware of this, but I also picked this up, I think a few months back when RBI set up a committee. So that is when some media had reported this, that RBI has set up a committee to examine setting up a digital payments intelligence platform.
Yes.
Because the real-time payments, as much as they are beneficial and good, are also being misused for sending money, very quickly, whenever it's a fraud, proceeds of a fraud. So there needs to be a collective intelligence. So the usual thing that's happening, and that's why I give the example of Interpol, this iGrip is working with 186 member countries, okay, or some such number of countries. Interpol works with 186, so I'm assuming that iGrip also works with that many countries, or maybe not sure about that. But shared intelligence is going to be very key. Intelligence not from just banks, also from other digital economy players, e-com companies, telecom companies, or all kinds of other regulators, so that this collective intelligence will help us in also finding out and narrowing down on some of these patterns and deciding that, okay, if one part of the industry is getting hit with one sort of frauds, it's only a matter of time when it spills over into another industry. So most of the themes right now are really around collaboration, that how do we collaborate and bring a collective intelligence so that we can keep pace with the way the fraudsters are thinking.
I have a couple of questions more, but let's ask audience if anybody here has become a fraud, financial fraud of serious nature or different nature, and you want to ask Nitin, this lady there, can Acha, this gentleman, and then after that, this lady. Just make it quick, huh? Very, what is the question? Because we don't have much time.
Question related to this conference only. I paid on 6th by my SBI credit card, 10,000 rupees. I got the successful payment message. I did not get the QR code when I arrived over here, and my name was not registered. I did not get the ID card. I raised the dispute in the SBI card. I also paid GST payment, goods and service tax. I get failure message, so I again paid in the 30 seconds. Both amount was debited. I raised immediately dispute, but now SBI card told me that you bring the Kotak card statement. I don't have any Kotak card statement. So under this surveillance mechanism, actually genuine customers are harassed every day by blocking the customer.
Thanks. No, so it's not about SBI credit card. Let's not make it any grievance redressal thing and all. But in this kind of situation, what is your advice to him? Suggestions to him?
No, my advice is very simple. I mean, this is very transaction specific, and I don't see any malified player in this whole transaction, because he's trying to pay the conference organizer through an SBI card. The payment is not going through, and therefore his QR code is not getting generated, and maybe he's paid twice. They have not received, or whatever the issue is.
Anyway,
so specifics obviously can be taken, offline. I don't have an answer to that. But the real thing to do really is to resolve this with the issuer, with the credit card company or the bank who's issued the card, because somewhere the truth lies somewhere there.
Madam, yes, please.
Sir, this question is specifically on authorized push payment fraud. Now, foreign banks have very clear policy on authorized push payment that most of the foreign banks, that we will take 50% of the burn after some investigation, and 50% will be taken by consumer. In some cases, they also take complete responsibility and pay back the customer. What is the stand of SBI on authorized push payment frauds?
Sorry, authorized what?
Authorized push payment fraud, where you share your details
she is saying
either in a
that,
call, in a SMS, or whatever. OTP, etc.
Where you willingly shared your credentials?
Willingly share, yeah. That's what is authorized push payment.
So we don't have a stand different from the rest of the industry per se.
Okay.
We are obviously telling customers that please don't share. When you have shared willingly and your money has moved out through an account takeover or transaction specific, there is a workaround to that, and that is where this whole 1930 that we started the whole conference with, and there is a mechanism to at least address it and see whether we can stop the money from moving out. But if customers don't report to begin with on 1930 or the National Crime Portal, you can't really take action because the system may not have picked it up as a fraudulent transaction. It could be just in pattern of your usual transactions. Yeah.
Quickly, Nitin does not represent SBI credit card. Okay,
Yeah,
he is
yes.
State Bank of India. So
Yeah.
please restrict your questions to technology and tech fraud. That's we started. Nothing to do with any particular individual entity. Fine. There are
Yes.
too many
I'll talk to you
questions.
separately.
We'll not be able
yeah.
to take so many, but quickly, gentlemen, we'll get it to you. So please get the microphone there,
Yeah.
and before that, this person. Yeah, please quickly.
Quickly, my name is Sachin Deshpande. This question is related to the customer category, which is senior citizens. So I would like to know, this is about not only SBI but across the whole industry, because they are the ones who are the easy target for all these fraudsters. So what kind of efforts have been taken by the industry to overcome that?
So that is
about senior
where,
citizen. Yeah, please tell us.
So not just senior citizens, any vulnerable or potentially vulnerable segments of customers. This is where we are talking about this whole concept of happy friction, that you bring in some more checks and controls. Okay, and that is again needs to be more collective in the industry. Any bank is free to take their own call, saying that I will do this with my senior citizen customers or do that with my senior citizen customers. For example, in SBI, we don't give digital access to our financial inclusion customers, the Jan Dhan accounts. We don't give that by default. Okay, and even when they come and ask for it, it's a very, very detailed process to make sure that they understand what they're getting into. In my previous bank, we did not give funds transfers facilities to senior citizens by default. They had to come and ask for it. So I think every bank will have some or the other checks and controls. But the important thing is that you build some more authentication, some more behavioral checks, some more profile-based checks, which is what I'm calling as happy friction.
We are running completely out of time. I'm sorry, there are too many hands being raised, but unfortunately, because of time, we have to be fair to the next panel. This gentleman, please, quickly. That's the last thing, and then I'll just round it up. Please.
Thank you, sir, for giving me the opportunity to speak out. I'm Mr. Subir Mehta. My father became the victim of the fraud, and 1930 is not very helpful.
Okay.
The reason is that we had gone to the police station. It was a fraud by email, and my father got trapped in that. And after the fraud happened, they said that there is a consent, that you have given the consent to the person.
Okay.
So I don't think 1930 can be really helpful.
Okay. Unfortunately, that's a comment. Thank you for drawing our attention. Unfortunately, we are running out of time. So Nitin, just last thing. So essentially, the fraudsters are always ahead of us. But the best weapon is, AI, ML, everything will use, but best weapon is the education. Meaning like financial inclusion, we had education, the campaign, etc. I think PM had started already talking about this in Mann Ki Baat. So we need to educate ourselves how to prevent that. So my last thing, just if you can tell you one sentence on that, where the buck stops, who will take the responsibility? Is it the central ministry? Because there are so many components, telecom authorities, Reserve Bank of India, one fintech SR we have got and all. Is there anything in that landscape you think of, a lighthouse kind of thing which will actually guide us, the combination of multiple entities or one single entity or Reserve Bank of India? Who should take the initiative and actually see that educating us and everything else needs to be?
I think we are a little away from deciding as to who should be that one entity doing that. But what is for sure is that it is a collective and a collaborative effort to begin with. And I'll just give the...
Who are the entities?
So I don't want to take the name of entities in our context, but look at the example of, let's say, building of highways for transportation as an example, right? There are so many parties involved, but you still need to be a good, sensible driver to be able to make use of a good infrastructure, good policing, good traffic police, good civic sense, etc. If that is missing, there is going to be an accident, and you can attribute it to whoever you want to. But in reality, the buck always stops at the person who has willingly shared such kind of things. You can always keep adding more and more guardrails. Always do that.
No, that's what this gentleman said, that he said his consent,
that
because his father probably unknowingly has blurted out some number, something,
Correct.
I don't know.
Correct.
Without knowing this, I said that. Incidentally, I also became a victim of a fraud 3 years back, 2020, 21, yeah. So this is one subject we could have gone on and on, but unfortunately it has all good things need to come to an end. He's always available on the sidelines. You can grab him and discuss with him. And if you are happy with whatever we discuss, give him a big hand. Thank you for your patience, man.
Thank you for that educational session. Can I request Mr. Tamal Bandyopadhyay to present Mr. Nitin Chugh with a memento? I think a supremely informational session, and for all of those who are interested in attending the Banking on Technology session, it's happening in Narayanan Vagul Hall. You may like to go there. Right here, right now, we are actually navigating a panel discussion that will unravel the aspect of secure payments in the digital age, mitigating fraud risk. That's the panel discussion that's going to unravel here in a few moments from now. But I think an exceedingly educational session navigating aspects on social engineering and cybersecurity, the information of mule accounts and how they are actually recruited, the aspect of happy friction, and the fact that we can reduce these cyber crimes if people are more aware about deepfake and how they can actually stop giving these private numbers, which is emanating from a sense of fear and psychosis that a near and dear one may be in danger. So I think awareness and education amongst people is a great way to make sure that we get protected from these cyber crimes. Ladies and gentlemen, as digital transactions surge, so do the complexities and threats in financial security. Our next panel discussion and our set of experts will be exploring the evolving landscape of financial crime, examining the latest tools, strategies, hacks, and regulations to actually combat fraud while ensuring seamless user experiences. This session actually brings together industry experts and virtuosos who shall be sharing their insights and anecdotes on how to tackle this tricky and murky situation. To navigate this conversation, may I call on stage our moderator, Ms. Nivedita Mukherjee, Executive Editor at Business Standard. And joining her on stage are going to be the following panel members, beginning with Mr. Karan Sapra from Google Pay, Mr. Ramesh Lakshmi Narayan from HDFC Bank, Mr. Ashok Hariharan, founder at IDFI, Ms. Natasha Jetnandani from Kaleidofin, and Sivaraman Kauta from Zeta. So I think we're all set. So can we have all the panel members join us on stage? Ladies and gentlemen, can we give them a huge round of applause? And may I remind you that after this panel discussion, we are all set to tickle your funny bone because we'll be joined by a renowned comedian who is really going to enamor us with his anecdotes and storytelling. But for now, Nivedita, over to you.
Thank you, Ridhima. So welcome everyone, and we are going to continue with the discussion on fraud in digital payment. That was what the fireside conversation was all about, but here we've got so many experts from diverse areas, so they can tell us how exactly can digital payment be safer. So let's begin with Ashok. And how do you think, our lives can be safer in terms of digital payment?
Yeah. First of all, whenever I hear about fraud, it excites me because that's the business I'm in, is detecting fraud. So when fraud happens for HDFC or something, I make more money. So it's interesting because at one end, we are trying to protect, and the other end, I'm actually a beneficiary of fraud happening, and because we try to solve this. In payments,
just to tell our audience, Ashok is from ID5, so which is all about identification. It's about KYC. It's about background checks. Everything.
It's about mule accounts. The problem that Nitin had talked about. We have solutions for that. The thing which we have to remember is like when digitization increases, fraud increases in general, right? And what happens is, remember KYC or any of these things about in 1990s, you had to be recommended by someone to open a bank account. That guy will show up with you to the branch and then you open it. And that was the way that they handled fraud, because now if you meet a person physically, that you know the face, you know that this is the guy. So it's easier to control fraud when it is largely physical. When it's digital, suddenly the attacks increase, right? Having said that, there are ways and methods to solve this problem also. Let me give an example. Right now, let's say if a payment fraud is happening, there are two things which have happened. One is, first of all, a fraudster never commits fraud in his own name. He has taken over somebody's account, or he has created an account in somebody's name. Because if you're going to get caught. And if you get caught, that's it, right? So that is number one. So the first step is to actually stop it at the source. That is better KYC. And I have a huge problem with this word called easy KYC. There's a reason KYC exists. The reason for KYC to exist is to control for fraud. We don't make that easy. Make it easy, but that's not the term to use, right? Like make it like, happy, like he said, make it a happy friction to some extent, because friction allows you to control for fraud. And as UPI has increased, that's where it's coming from, right? Social engineering happens, he takes over your account, or he has colluded with me, and I have opened the account on his behalf. Then I probably, if you just try this, take any bank's thing, go on YouTube, type the bank's name and say customer care number. About two or three videos down, you will have a number which is actually not the bank's number. And these guys are actually posting this on a daily basis. So I know some of the banks actually try to bring them down by reporting it. But eventually, these guys are just creating new numbers. And this is your first way, right? Somebody calls that customer care number, and they start to process that. I can talk about this for hours, but in the interest of giving people time.
Yeah, but when you do your background check, have you found that these cases have increased manyfold in the recent past?
Yeah, I mean, the amount of fraud has increased significantly, right? Like last year to this year, it's almost 100%, 200% increase in percentage terms. And that has happened over the last 5 years. 5 years ago, which was negligible. Like, I mean, it would have been in the 3 to 4% range. Now we are finding a lot more. And in background verification specifically, but background verification is a lot deeper in terms of checks. But if you look at bank KYC, etc., that it's definitely increased, right? But yeah, one thing I want to just give out as final answer on this is, increasing and higher ticket size transactions, it's okay to increase friction, add a face match on top. You will actually prevent some fraud there. Instead of just an OTP. OTP is not good enough. People can social engineer OTP, but they cannot social engineer a face. There are enough checks and balances to figure out liveness of a person at the point of a transaction. So I think some friction is okay. Anyway, I'm going to stop because I think I ate up about 4 minutes.
Oh yeah, that's going on. The ticker is on. Natasha from Kaleidofin, yours is a lending platform. So on lending, what is the kind of fraud that you notice at what level?
I mean, again, there are so many types of fraud that happen. So I think I totally agree with Ashok. It's like the more you do, the further ahead fraudsters are. So we see, for example, tons of, there are loan application frauds. So it ranges so many things, identity theft, applying for a loan in other person's name, combining fake data with some real data to try and again trick the system. A lot of cases of ghost accounts, right? Trying to create a loan account for a fictitious borrower who doesn't exist. Again, just to get the loan money. There's tons of also fraud in terms of loan disbursements. Again, very often also tricking businesses into, transferring disbursements into particular bank accounts, right? Large bank accounts, which can then, so it could be also insider-driven fraud, right? Within a company. There's lots of loan repayment frauds. So this one is actually, especially for the kind of customers we work with, very tricky because a lot of them are not very tech savvy, not very familiar with new technology. So you can have a phishing attack where somebody's saying this is, you need to make this payment. You can have a fake loan app that somebody, you can really make it look quite realistic. And now somebody is following up with you, an app is following up with you, it looks super professional, it's asking you for a repayment. you make the repayment, not only do you lose your money, your loan account, your actual loan account goes unpaid and your credit score gets affected. So the fraud for the customer affects him or her in like a huge number of ways. So I think the breadth of frauds just span the entire credit life cycle also. It's not only just at the application stage.
Natasha, your Kaleidofin office is in IIT Madras. Is it within the campus of IIT Madras?
So it's in the research park attached to IIT Madras. So IIT Madras has done this amazing thing where they have actually invested very deeply in this research park, which encourages a whole bunch of innovation in different areas, financial inclusion, which is why we're there, but also, climate change, a variety of different areas, right, which are pushing the front, space tech. So a lot of interesting other organizations who are also doing a ton of innovation.
So is there any collaboration between IIT and
Yeah, there's lots actually. So we've had the opportunity to work on 2 different data science projects with 2 different IIT professors, just to give an example. And these are super interesting because a lot of the work we do on our credit scoring, which helps with risk management. We have a product called Chi-Score. We've actually been able to collaborate with some of the professors there to push different fronts to really see how we can make that risk management more predictive and therefore get access for customers.
Interesting. Shivaram from Zeta, you have very interesting thoughts on authentication. So it'll be good to get your views on OTP, or what is your sense on OTP? How good is it to really prevent frauds?
Sure. So yeah, so Zeta is a next generation core banking and services company. So we of course work exclusively today with banks and hope to also extend it to NBFCs. In the Indian context, when we look around, we are both excited about the opportunity that digital wave brings, but extremely worried about the state of our security. I mean, look at all 3 methods. I think both of you mentioned some of them. You asked OTP. OTP on SMS is using a communication protocol to establish identity, right? So it's of course extremely prone to phishing. I think you both have spoken about it. It's extremely dangerous, right? Even passwords and pins, right? Basically trying to do authentication based on what you know, a password, a pin. 99% of our country is security unaware, right? Most of us here would have most probably used the same password in every site that we use. So a compromise of that, and by the way, we will choose birthdays, combination of birthdays. I mean, it's fairly easy to break, right? And getting compromised there will not only compromise that account, but it probably compromises your entire financial and digital life because it's the same password or the same PIN. I mean, my student roll number is what I use, and I use it everywhere. You can compromise. Or the new thing that's coming is biometrics, to say, oh, biometrics are secure. But the problem even with biometrics is all biometric authentication depends on transmission of biometric. The moment you're transmitting that biometric, it means it can be stored at an intermediary point or at a fraud point, which means it is, again, even a face ID, right? So if it is being transmitted, technology is coming to a place where, yes, I can mule it, I can imitate it. So unless we get homomorphic encryption and algorithms to affordable place, we simply have to move away from transmission of biometrics, right? So we are excited about some of the developments, but I think the industry as a whole has to do a lot more.
So in short, what is the way out really?
So some things that are there, which we should adopt more aggressively. Silent mobile authentication, which is of course our network operator supported protocol, provides a fair amount of protection. It is relatively phishing proof, but at the same time, India has unique characteristics. Almost all of us have dual SIMs. So there's so much friction, the customer has to choose which phone number, etc. It's not working. I mean, we are trying that, but a lot of education is required. What may be better is for the network operators to take a more active role and give operator-provided apps. So an Airtel, a Vodafone, a Reliance could all provide their apps, and they control that environment, and they give that as a service. But ultimately, the only reliable phishing-proof thing that we know of today are what you have, FIDO compliant devices, right? So today they're considered expensive. But if the industry as a whole focuses on saying we are going to bring these devices out to the masses, look at what happened with Bluetooth devices, right? What it was maybe 10 years ago, today you get a Bluetooth device for less than $1,000. The same could happen to these FIDO security devices. So moving away from what you know, because that is so compromisable through social engineering, to what you have is going to be a fundamental pivot that I think the industry has to go to. Unfortunately, we are worried because we primarily work as a technology operator. We would like to play our part, but we don't see enough stress being put in the industry on trying to move this agenda forward. So maybe something big will happen and then we'll get there. Hopefully we'll get there without something big happening. But yeah, that's how we think about it.
Ramesh, from HDFC Bank, everyone is looking at you because it's, you know, when you do banking, main core banking, you detect so many frauds. And are you worried? You know, has digital really troubled you?
No, I think first of all, I think most of the people on the panel itself help us to do what we are, what we are discussing, right, in terms of prevention of fraud, starting with Ashok and probably, all the way up to Karan. I think Nitin spoke about in the earlier session. It is a disturbing trend. Okay. Now, how disturbing? I think last 9 to 12 months have been difficult for the banking industry. While the numbers are not published openly, but the reality is that it is quite I would say omnipresent at this point of time. What is happening is different types of frauds that we spoke about, and it is, it's a combination. It's not just payment financial frauds, but a lot of other things like money mule is a very, very big challenge that the industry is facing. In fact, to the extent that the way the modus operandi has been shifting from bank to bank. These are like swarm attacks that happen. They figure out which bank to look at it and then kind of, use that and then move to the next set of banks. And unfortunately, banking system is prisoner of what I call as a very legacy tech approach to a lot of these things, which what I mean by that is that we're still bound by rule-based engines for detecting frauds. Okay, we're still, looking at profile data in static mode. So there are lots of technology that's still not kept up to the pace to kind of, manage this kind of a menace, right? And that's where I think, and there was a lot of discussion on AI, ML. Yes, AI, ML will play a role. But I think there are also a lot of, what I would call paraphilic technologies that will make this journey complete. It's not just about AI, ML, but how do you deliver the AI, ML to effective use? And that's where, real-time streaming, graph databases, time series databases, and so on, some of the new technologies that have emerged along with AI, ML. And then banks have to really adopt it at scale and very fast, actually. So
you mentioned that 9 to 12 months have been quite disturbing for the banking industry. So what exactly are banks doing to, bring its human resources up to speed to handle things?
Yeah, so I think there are multiple things banks are doing. Like one, definitely from the government perspective, there's been a lot of initiative, especially around money mule today. Apart from that, like I mentioned, two things. One, the whole fraud management apparatus. Largely, the banks were very driven by payment frauds. If you look at it, that's what the Now, when the focus shifted to money mule kind of a fraud, it's the entire game has changed. What do I mean by that? Like I mentioned today, earlier it's only the credit or the risk management department would largely drive a fraud alert and kind of work upon it, do a callback, which is a classical way of kind of looking at things, right? I mean, every time you will do a transaction, you get a call. But how do you do that in a money mule account? Because the fact is that in money mule, just to give you a little more context, you can see thousands of credits and a single debit in a less than 15-minute kind of a period. What do you do with that? The decision, and you can also probably stop a good account, mind you, because there could be business accounts which could have that kind of a churn. So how do you look at it? Now the front line has also started getting involved, which means the RMs have to be alerted on a particular account going on to mule, and a decision has to be taken real time. The AML unit in the bank, for example, has to then look at profile patterns. Has the person, when he got boarded, like Ashok said, what are the onboarding parameters and how do they match with initial transaction period so that the early warnings are set up. So there are more set of departments that have come into play rather than a centralized credit department as in the payments fraud. And the technology to drive, like I said, a lot of them need real-time blocking. For example, WhatsApp, based, intent-based, kind of decision, triggers that have started coming in. So I think the game is dramatically changing in terms of the ecosystems getting involved and the kind of technology tools that are coming to drive that.
Karan Sapra from Google Pay, do you lose sleep over such menace about digital fraud? Do you lose sleep? Do you lose sleep?
Yes and no. See, it is a menace for sure, right? I think all the panelists spoke about the fact that it's multiplied, but I think it's also important to see these things in context. There was a world not too long back when people used to cut checks and wait for 3 days for money to transfer. It's real time. I think UPI is processing over 500 million transactions a day. It's multimodal. There are multiple ways of payment. Systems are interoperable. Everything is real time, right? So does that open a lot of vulnerabilities to the fraudsters? The answer is yes. I think the other big shift which has happened is as the country grows and progresses, more and more segments of society are getting included. The ones which are the latest or the freshest to inclusion are the most vulnerable as well. And Calodafin, you must be seeing that quite a lot, right? The big challenge where we lose sleep is the most vulnerable is where all of us have the highest responsibility to protect, right? Because the country will progress not just when digital gets adopted, but if you're able to preserve and nurture the safety and security of the system and which underpins the ecosystem. The third reason why it's become even more complicated, Nivedita, is I think even commerce has become multimodal, right? Transactions don't necessarily originate. Payments are not necessarily linear from account to account. I might start booking an app. I might be on a gaming site trying to buy next level rewards. I might be trying to buy something from e-commerce sites. Which are frauds? Which are the genuine ones? Where does a transaction originate? You often do not have a control on, right? And the users get engineered to actually genuinely, authentically make payments which they shouldn't have, right? And the biggest issue which we are grappling with globally, but as Google we are heavily investing in, is on making the mobile ecosystem safe, right? Because again, earlier the checkbook was safe in my locker. Now my payment app is on my mobile, and mobile is open to so many security risks, so many apps, right? And there's a huge amount of work that's going in. So it's keeping us awake on multiple angles, yeah.
But is UPI the safest digital mode of transaction now?
It's relative. I think it is very safe, right? I think where it gets misused is when people get engineered into sharing pins. For example, collect requests, and it's so often, I have actually tried to sell on an e-commerce site where people actually try to send you a QR code, say, please put your PIN, and you will get money. The collect request scams and all, right? I think the layer of defense, which again we are heavily, and we can talk about it subsequently, investing on is, on the first level of defense is in educating the users, right? If I willingly give my PIN, frankly, the system, it's not a bug, it's a feature. If you put your PIN, the money will leave your account, right? So I think a new feature in UPI which got launched in GFF was UPI Circle, the delegate payment. I don't know how many in the audience have seen it. It's about to get rolled out by UPI apps as we speak, where I can delegate to someone trusted in my family a certain amount of money to be used in a certain period of time and so on and so forth, right? So a lot of people, okay, one more interesting trivia, right? Still in India, even with UPI proliferating, almost one out of two people who have mobile internet don't have access to digital banking, right? So UPI Circle actually allows the elderly, my kids, to get a delegated mandate from me to spend. This is how we're expanding the safety, the circle of trust and safety. But yeah, does it remain vulnerable like all payment methods to engineering? Yes. Do we have to be aware? Yes. Can we do more? Everyone can, yes.
You know, the Prime Minister, Narendra Modi, he had to come and clarify that there is no such thing as a digital arrest. So does the Prime Minister have to make such clarifications? What is to be done about social engineering frauds?
Is that to me?
Yes.
Okay. So I'll give a story which is actually quite personal. So my father-in-law passed away last December in our house. A day later, my wife gets a call. So she's obviously emotional. She's in an emotional state. And the caller said that, "Beta, आपके पापा ने मेरे साथ 50,000 रुपया दिया था, you know, and I want to give it back. So, you know, pass the account number or whatever else." And so Mukti's like, UPI mein kar dijiye, whatever, right? And so there's a fake SMS that comes in from a mobile number, and it says 75,000 rupees. Then he calls and he says, "Beta, मैंने ना ज़्यादा pay कर दिया, आप 25,000 वापस कर दीजिए," right? Now, what the fraudsters are doing, there are three things they have done. One, they have a bank account, which is probably not in that guy's name, right? It's a mule account. Second, they had access to the death certificate data, obviously, because they attacked at a moment of weakness. Third, they are using emotional states, so they are actually doing data science far better than the banks are doing, right? Let's be very honest. They are completely profiling the person, deciding when to attack, and going after them, right? Like in this scenario, and this is exactly what digital arrest is. I think a lot of you guys, I don't know if you've heard of FedEx scam. The drugs have been transferred to Thailand, and now that's how they usually do this digital arrest scam. And the reality is there is money going into the banking system from one account to the other account. There are lots of players who are intermediaries here. There are the websites which are where these fake accounts get updated. You know, there are enough people in the system who should have done something. I do agree that education is important, but I also feel like there is a responsibility for platforms to protect citizens, and there needs to be something done here, because it is going to increase. And the moment transaction, when it becomes real time, checks and balances are harder. When there was a clearing house which took you 2 days to clear, banks could easily put checks and balances. Now you can't. You have to make that transfer immediately. You can do whatever you want, but the fraudsters are going to get smarter and smarter. And education, how much are you going to do? Right?
Can I quickly add to what he said? I completely agree with him. Just some numbers. I think in terms of the real-time payments, and you know, Ramesh touched upon AI and ML, I think that's where it kicks in if done right. Right. I mean, at Google Pay, we have models which are best in class, and between last year to now, we have saved 13,000 crores of fraud. That's a number which we have validated internally, right? Over 41 million real-time alerts given, real-time, within milliseconds, seeing the sender, seeing the receiver, seeing patterns, juxtaposing with multiple similar patterns which would have happened, and nudging the user saying something looks off, is what technology can do.
Yeah, and just to come in here, I think, because it's an interesting conversation, just keeping it open, I think this is where a lot of focus on real ML and AI comes in. I mean, a lot of times we just get pulled out by saying Gen AI will do this, chat will happen, but there is a use case to solve for, you know, at scale, real time. So I think while both points are equally valid, but as a responsibility that we can bring in is to keep fine-tuning and investing more and more into this kind of a technology, rather than trying to kind of, you know, be divergent about it. So banks have to realize that putting money out here is far better than trying to actually do a Gen AI case, which will never probably give a you know, benefit immediately. So you have to be very judicious about these things, you know.
So is HDFC Bank spending lots on this?
Absolutely. In fact, like I said, we work with a lot of partners out here. And I spoke about Money Mule. Today in India, Money Mule is a T+1. UPI fraud for many banks is T+5 minutes. We don't have 5 minutes today. Because frankly, the 5 minutes is gone. I mean, like Ashok gave a case, I can quote many cases which we keep getting. And that is where, like I mentioned, a very, very clear, real, and what is the problem here? Like I mentioned, one is of course the fact that the ecosystem has to play. Second, like the legacy technology of the banks. Because when you hit a core banking, the ability to pick up an event real time matters a lot. Like that is the biggest problem. And most of the banks, and including us and a lot of us, we have kept building on single core, what we call as monolithic core. And just taking a transaction out there, pushing into an event, that science and that technology is where, for example, we are very, very invested now. We've recently kind of come up with where we could pull transactions out. So when you hit a core, within a millisecond, you're able to push that event out into another table, and then you can run an ML on top of it and then alert. Now, this kind of a technology construct is more and more we are seeing as the platform that will drive the responsibility that he spoke about, actually.
How much has your investment gone up by, on this area?
I wouldn't be able to give you a number per se, but today 20 to 22% roughly, of the tape and the capex spend. There is again OPEX and capex here, but yeah, roughly I would say anywhere between 15 to 20 to 23% is where banks are spending their spend on security budgets, actually. The number
compared to what 5 years ago?
Compared to probably less than 5% compared to 5 years back.
How much was it?
Less than 5%,
less than 5%,
actually. So it's
okay.
substantially gone up, So
I have a comment. Like we work with HDFC, so fraudsters usually don't open bank accounts in HDFC, right? They go to the weakest bank and open there. So they know the KYC systems. They know where these accounts are going to be vulnerable. But once he has a UPI number, he can start accepting payments. The other one is mobile phones. The telecom KYC in this country is horrid. I don't think there's any checks or balances being done. If a guy has a number, fraud is going to happen. I don't think it's a banking problem alone. It is a multi. It's the telecom world, it's the banking world, as well as the social platforms like OLX and Quicker, for example.
Yeah. No, Ashok, I think bang on, but the point is, even from a government, like you asked, SIM swapping is one of the first points of an early warning. He will also tell you the same thing. Right. But there is no way for you to figure out, when the SIM swapping trigger comes, because the telecom guys don't provide you that. I mean, if you can have a online dispute resolution on UPI, I'm sure there is a way to figure out a SIM swapping, early warning indicator. So it's an ecosystem play.
Right.
I couldn't agree more. I mean, I think it's in many ways what you said, right? I think you have to think of security and fraud right at the start of engineering the systems, right? Like bringing different aspects of data, like you have to detect, okay, is the person in a different location? Is the person transacting too fast? SIM swapping. There's so many pieces to this data that go way beyond the financial transaction that you need really that data to be stored in a common place so that you can actually build models and use. The problem is not the ML. ML is usable. It's about bringing all these disparate pieces of data into one place, right? What's the customer like? That's another big aspect, right? Which customer do you protect in what way? Just to speak to what Karan said, right? You need to do very different things for less, tech-savvy customers than for high transaction customers.
So I want to ask all of you, why are we discussing so much about cybersecurity and payments fraud here in India? Because isn't this happening globally also? What is so different in India that we are so disturbed and worried? Karan, we can begin with you.
Very interesting question. I think two things which come top of my mind as I think about this. One, I think that the rate of growth of digital in India is nowhere to be seen in the world, right? I think the way it has got democratized, the way Indians, irrespective of age, education, strata, have digital on mobile and ability to transact, I think it's nowhere in the world, right? There are statistics which are published. India has the highest digital adoption in the world. So I think higher the adoption, higher the vulnerability, one. I think two, as the country progresses, people's ambitions, and we, on a very similar note, we have been running a campaign called DigiKavach, where recently we spoke about, and with HDFC Bank as one of the partners, right? Where we say, scam lage to mauka gawao, right? So basically, Indians have a very inherent cultural thing of seizing the moment, where we say the best opportunities are sometimes the ones which you don't take. So I think in a growth economy where people have ambitions, and as they're coming into the fold, they are more vulnerable to getting scammed, fear, greed. There's so many vectors on which kind of fraud happens. I think these two, to my mind, are the biggest ones.
Ramesh, any learnings from the global banking industry?
I think Karan covered it quite well. I think the other aspect is probably the fact that the digital education, and I do truly believe that the education aspect remains, well, DigiKavach is interesting. We did Vigilante, similar campaigns, right? I think it should start very early in the cycle of education, if you ask me. In fact, like you said, why would Prime Minister Modi speak about? But I think it has to be spoken about in the 5th class or 6th class, because that's where you're starting today to look at digital transactions. Because we are very open to giving your card to your, 10-year-old daughter also today. You're giving payment options to your parents. So I think that is one part of which I think, and it's again multilingual, because it's not one language. So you have to figure out creative campaigns to educate. And while we'll spend all the money on technology, which we should spend, but I think we'll have to crack this thing from a systemic level of how to educate digital frauds at a very early stage and put that in the mind of the people, I think.
Right. Shivram, is it so serious globally, internationally, or is it different in India?
Yeah, so I mean, I'll combine the previous one also. Yes, digital has, in my view, definitely, I mean, the growth is high, etc. But it's also the way in which we have progressed on digital that is creating this. Nowhere else do we have a setup like UPI. It's just unbelievable that if you were to set a password for an email account, you're required to do 10 digits, 12 digits, multi-character, etc. Yet your savings bank account can be accessed with phone numbers that UPI today allows, etc. I mean, there is not even a debit physical card, debit card also. It's just one number. And till I think the Supreme Court intervened a few years ago, the proliferation of PII data, the personal information of users, Aadhaar, the PAN data, is so distributed and so prolific that it is straightforward. Today, you don't have to be an abuser. If I want to get your PAN number, I just need to spend an hour looking for it and I will find it. And same for Aadhaar and so on. So with near complete universal proliferation of our personal information out there, we've now given everything to the scamster. He's got all the ammunition. All he needs to do is now guess that 4-digit. And this OTP business, I spoke about it earlier, but I mean, we're literally using a protocol that was created in 1970s to allow people to, or maybe even earlier, I don't know, to allow people to talk to each other, to establish identity, right? So that is the extent to which we are now moving away from security being that. This is not the case with the rest of the world. I mean, so in the rest of the world, yeah, sure, payments are not so easy. You cannot just walk in and 2 taps finish it. But that also means that you don't have that kind of risk. The social security number in the US is not as easily accessible. So I think fundamentally the industry has moved at a pace which some of the other controls, etc., have not matched, right? And the direction we have taken is this high-risk approach today.
Natasha, has Kaleidofin collaborated with global companies, agencies to figure out, how lending fraud can be prevented?
Yeah, we've actually done a lot of work in India, but we've also been working with organizations in East Africa, Bangladesh, and a few other emerging markets. I think a lot of our focus is on trying to use chi-score to detect patterns within the scoring, the loans data, the risk management products we build. And to do exactly what we're talking about, right, is flag potentially high-risk accounts, flag, just patterns that are not looking normal, essentially help lenders, help, ultimately help the customer really identify these. So it's a very core part of what we do, is to really build out that pattern detection. And I think it's really interesting, I think, our journey in this, because you start off saying, okay, you have large volume of data, you can build it, but it really is a matching of how do you use that large volume of data, but really put your mind in the mind of that fraudster, right? Or the many different ways in which it could happen, because that's what it really takes to figure out what to look for. So just like credit risk, I think fraud risk also, the intuition is super important. And then encoding that into your modeling, I think, is the next step.
Ashok, your final words.
Yeah, so we started in India largely because at least I felt there's going to be a moment when India will have a lot more fraud than other countries. And I stand by that, right? Like if you think about fraud that's happening, social engineering fraud that happens in the US, it actually originates in India in about 3 cities. I will not name the city because it's just like, people start judging the people from there, but that's sort of where we have kind of, I think India, and because they covered the rest of the topic, so I'm going to give a little bit of a more hilarious note to this. Indians are entrepreneurs. We figure out how to make money. I know at this point, knowing how fraudsters behave, I kind of wonder whether I'll make more money by being a fraudster than to catch fraudsters, because we are the most ahead in financial sort of technologies in the world. Like there is no such thing as UPI. There's no such thing as account aggregator anywhere else. There's almost all countries cannot do instant transaction bank to bank. They have an intermediary or they have a clearinghouse, right? India is the only country. That's why fraud has gone up. But are we supposed to say that, hey, we shouldn't have these technologies? Then how do we do inclusion? So you can't do inclusion if you don't do it. So you have to do it, and you have to build the checks and balances to control it, right? Fraudsters will always try to figure a way. It will be a catch-up game. We'll fix it. Some other hole will open. But that's the battle we have to keep going at. Yeah.
This question was asked earlier and there was no clear answer. Where does the buck stop really? Who is really responsible? Maybe your quick thoughts, one-line answers, starting with Karan.
I don't have a one-word answer for this. I think it's everyone. I mean, I know it sounds like a platitude, but there are lines of defense everywhere. From a user, should you be more aware? Should you keep your eyes and ears open? Yes. Should the systems be built with the highest level of trust and safety? Yes. Should the enforcement agencies catch 100% folks? Yes. So I think it's distributed, and I don't think it's just one place where the buck stops. That's my answer.
Okay, Ramesh?
I think it's the same out there. It's very difficult to pinpoint, but I do think that time has come, and Nitin alluded to that in his earlier speech, that we need some kind of a framework that allows you to do, a collective participation, so to say, real time. I think that's a very missing part. I mean, we just done UDIR today on, which is not real time. It's an ability to only raise a dispute. But can you stop a fraud? Which means can you kind of, make it like community driven, which means every single ecosystem is able to provide you triggers and you're able to inform the other party in the chain real time. I think that to me would be the real way to kind of, take the accountability and move forward collectively.
Yeah. Do you agree?
Yes, I definitely agree. Having said that, while I think it should be collective, everyone should participate, there are two methods, right? How do you set the game and how do you play the game? How do we play the game? Yes, we need to have data coming in, etc. But today, what is missing is a set of ecosystem level framework on how to play the game. It is possible to define, there are regulations for how a bank should behave, how a payment aggregator should behave, how a payment gateway should behave, so on. But by the way, they contradict each other at some points. Just putting down, and just is not that it's trivial, it's extremely non-trivial, but having the industry participate collectively and defining a comprehensive framework that defines how an end-to-end ecosystem needs to play. Yes, right on top should be, banning of OTP at all. And I'm personally at least glad that the RBI 25 vision does identify the OTP and they are talking about phasing it out, etc. And I think and hope that they're actually going to move it in that direction. So if there's a comprehensive framework and each of the participants, because there has to be a set of rules, because otherwise incentives are not aligned. Why should a front-end player bother about what's happening on the back end? The fraud is going to be borne by Ramesh. Why should I bother? And so on and so forth. There are realities of how the businesses get done. Versus if there's a constant framework, it's regulation, get it done. So I would add that the need is for a unified end-to-end comprehensive framework to be defined, probably by the regulator, but with collective participation.
Natasha?
So I agree on the need for some kind of ground rules and a framework, but I have a slightly different take or an additional take on why. I think an organization like HDFC, Google Pay, these are like big players, right? Like you can put in massive teams to build fantastic fraud detection, but there are tons of other financial institutions in the market, right? You have everything. You have cooperative banks, regional rural banks, you have MFIs, you have smaller NBFCs, right? I think it's super important to also enable the entire ecosystem to protect all customers, right? I'm an HDFC customer. I have much more faith, but I'm just wondering, how does, our customer in rural Bihar get the same level of fraud detection, right? And I think that's the other super big value add that comes from investing in framework, and I would go beyond the rules, right? Let's actually create some kind of available source for this for organizations that cannot build this from scratch, because it's not easy stuff, or have players that provide it, right? That can really enable this, yeah.
Natasha, sorry, just a quick one on that. We did represent on creating a public infrastructure. Okay, just like we have created public infrastructure in credit and payments, a public infrastructure in security, starting with telecom operators, banks, and everybody participating. We have represented, but it's kind of a discussion that's still not so I'm sorry, I just wanted to respond to that.
Right. Ashok, so where does the buck stop?
I think they all said it. There's nothing really to add. But I do think, so one of the problems is fraud happens and the regulator reacts after a year. So regulations doesn't catch up to frauds. And so what we have to realize is the ownership of controlling fraud is with the fiduciaries and not with the regulator. Regulator will react later. So as long as we realize that and say that, hey, if you're catching fraud and there's patterns, there is no reason to wait to see if there's a new regulation which says you must catch it like this. I think that, so I would say it's not as important that the regulator says this, but how as fiduciaries we are behaving in the org. Yeah, that's why.
Thanks. The screen in front of me says that absolutely we've run out of time completely. There's no time for question from the audience. There's one hand. Okay, maybe one question.
Thanks, gentlemen, and obviously ladies, for sharing insights. Myself, Pawan Goyal, ex-banker, worked into the industry for 15 years. Just want to share a live incident which happened with the wife of one of my friend. And
just ask your question.
Yeah. My friend's wife got digital arrest. money got transferred to the tune of 30 lakh rupees in the 4 accounts. 2 of them are HDFC Bank, just to point of Ashok that fraudsters don't open the account with HDFC Bank. HDFC Bank, and don't ask me the source of the information, the account was opened on 30th.
Don't get into specifics of the banks. What is your question?
My question
Do
is,
you have a question for the
my
panelists?
question is, when the banks are saying we are doing so much of information, KYCs and all, their accounts which are being opened, the amount of transaction in 15 days is north of 2 crore rupees. Within a day, the amount is more than a CR. Ignoring those things on the name of mule account or KYC being on someone other's name and then not AI ML being done, how can you build the confidence of customer that
so the question
accounts
is
are
question.
being KYC? Or
So let me just
what
take
are you
that
doing
question.
to give confidence?
I'm not getting into the specific
Thanks.
case, but this is exactly the problem that I was talking about. Unless the banks get to the level where, like I mentioned, you could have, account takeover. Nitin spoke about account takeovers and money mule. But the fact is that and it's done very sophisticatedly. It's a little longish answer, but I'll answer because it's a very important question. I mean, the kind of account takeovers we are seeing, that the account is active for 10 years, and you're offered a job employment scheme with an authorized letter and a KYC done as an interview. Okay, very difficult to kind of push this. But the fact is that when you onboard the data and then when you transact, both have to be very clearly correlated using a machine learning model. That's why I was telling you, in fact, like I said, we are very seized of this fact, and like I said, we moved from today a T+1 cycle. If you go to a money mule account today globally, even globally, I'm not talking about India, it's a T+1 cycle. Because as I mentioned, the core banking is not opened up. It takes you one day to realize in many places that you had so many velocity transactions and the profile came in a different way. That's why I think banks, like I mentioned in my chat, that they have to start thinking about technology at a very different scale. There is no other way. Well, we can talk about education, that's the first line of defense, but the reality is that the technology of the banks have to get upgraded. And we are doing a lot of work in this area. It's a work in progress. By no means I'm saying that it's sorted. But technical, bit by bit, we have started seeing this coming down. And just like I said, I don't want to share a data point, but we have seen a dramatic improvement in the last 6-7 months since we have introduced this platform. And we're further kind of narrowing it down to say whether can we go real time on some of these cases.
Right. So it's a work in progress. We've run completely out of time now. Thank you, everyone. Thank you so much. Thank you.
All right, thank you so much, panel members. Can I request Ms. Nivedita to present our panel members with a memento? All right, ladies and gentlemen, can we give this panel a huge round of applause? Eclectic insights, astute observations about the future, solid anecdotal references, candid outlook, comprehensive and perspicacious actionable based on proven strategies and sound genesis. That has been the overall experience of the 2 days of India's biggest BFSI summit called the BFSI Insight Summit. We are sure that you're left with a lot of reflection so far. We still have day 3 tomorrow, which will give you some food for thought in terms of pragmatic insights, plans for futures to really prosper. And we are sure that with this, we have slipped your grey cells into tizzy. And to make sure that you recover from all of that, we have an interesting act unfolding on stage in a few moments from now.